index from 25% to 18%. The 5-day AI Impact Summit opens in New Delhi with PM Modi inaugurating the event. Anthropic CEO says India is the second largest market for the company's chatbot Claude, and business run rate has doubled in the last 4 months. The AI giant expands India's footprint with an office in Bangalore. Hello, good morning. You're tuned into CNBC TV 18. You're watching Power Breakfast with me, Vinny Motiwala. Thank you so much, as always, for tuning in. Now, today, in terms of the Asian markets, most of the Asian markets are shut, whether you look at the mainland China market, Hong Kong market, Singapore, Taiwan, South Korea. All of them are on a holiday today because it's Lunar New Year. So they will not be indicating in terms of any price move. US markets were shut yesterday because there was President's Day that they were celebrating. But US futures, that's an indication we'll keep an eye out on. As of now, Japanese market Nikkei, that's open. That's down and muted day of trade there. Topix is also down 0.2% almost, as well as the Australian index, ASX 200. That's trading with some bit of a gain. So most of it is muted start. Australian index is the only one that is indicating a high start. Gift Nifty on Nifty implied open. Let's look at that. That's indicating a downside for the Indian market as well. Again, red on the screen is what we're keeping an eye on. As of now, Nifty implied open is down 90 points. But let's get to the important cues that you should keep an eye out on for the Indian markets today, as well as important stocks to watch out for in the trading session as well. First up, we have Gaurav, who's here to tell us the important cues that you are watching out for this morning. Good morning, Gaurav.
Well, good morning. As you suggested, Vinny, we are getting limited cues from the global market because if you look at the Asian markets, most of the Asian markets are shut. We've got Singapore, China, Hong Kong. All of these markets are shut on the back of Lunar New Year. And apart from that, from the global market, if you look at the US market, a main data point that we will be watching out for is the ADP employment change. Now, that is something that we will be closely tracking to see if there is any overhang that can be there from the global market point of view. But if you look at Indian markets, now, yesterday we saw Nifty rallied almost 0.8%, and it was actually a good start of the week, given that last week was actually a bit weak for Nifty. We got top gainers like Power Grid, Coal India, HDFC, Adani Enterprises, and at the same time, if you look at the option data, today is the expiry, so it suggests that Nifty can be range bound in 100 points up and down, with support level at around 25,600 and resistance at 25,800. Apart from that, if you look at sectoral performance, yesterday we saw Nifty Realty, Nifty Energy and Nifty Banks all gained more than 1%. Remember, Nifty Energy and Nifty Realty were also the top losers in Friday's trading session. Apart from that, from the Indian market, we have got the January's trade deficit data. It has actually increased, and at the same time, if you look at unemployment data as well, now it has reached 5% level. So let's see if it has any overhang on the market. Lastly, if you look at the FII DI data, yesterday it was a sell-off from FIIs, but the quantum of selling was actually lower. The selling was in the tune of 970 crores. So let's see if there is any push from the FII market in terms of selling in the market today. But all in all, as Gift Nifty implies, it suggests 90 points of decline. But let's see how it settles and how it goes for Nifty in a day today.
Okay, thanks so much for that, Gaurav. But now let's go across to Ria, who's here to tell us the important stocks that you should be keeping an eye out on today. Good morning, Ria.
Well, good morning. Let's start off with Cochin Shipyard first. They have been declared as the L1 bidder for the construction of the next-gen survey vessels for the Indian Navy. The total order value is at rupees 5,000 crores, and the order book at the end of Q1 of FY26 stood at roughly 21,100 crores for the company. Tex Macro-Rail will also be in focus on the back of an order win. They have received an order worth roughly 210 crores from the Mumbai Railway Vikas Corporation. JSW Infra will also be in focus. They are going to be holding a board meeting on the 20th of February to consider a fundraise. Embassy Development has received RERA approval for its first project in Alibag. The estimated GDV for which is rupees 400 crores, and the launch is planned in Q4 itself. For Lupin, they have signed a license and supply agreement with Spectus to commercialize a novel antidepressant called Deslaflex in Canada, and TVS Supply Chain will also be in focus. They have signed an MOU with Italy-based ALA Group to enter India's $28 billion aerospace and defense supply chain market.
Okay, thank you so much for that, Ria. But in terms of cues from the F&O space, let's go across to Sudarshan for that. Sudarshan, again, in terms of FII flows, there was a bit of an outflow. We've seen muted trade continue for more than a week now. Today, what are we keeping an eye out on?
Good morning, Vinny. Remember, yesterday we were talking about the Nifty was in oversold zone and PCR was around 0.6, between in the range of 0.60 to 0.70, and there was an expectation of the recovery, and that's what we saw in the market yesterday amid low volumes in the absence of FIs, because majority of the markets were shut yesterday. Even US was shut, and today FIs will be back. Today it's a weekly expiry, and Nifty is trading near very key support level. Nifty has closed just around 100 DMA of 25,688, and the closing figure was around 25,682. So we'll have to see how exactly it pans out. It all depends on which direction FIs take. Now talking about the FIs flow in the index futures amid low volumes, the buying figure was just 440 crore. In the stock futures, buying figure was 35 crore. In the long positions, if you talk about, they have added long positions of around 2,000 contracts, reduced short positions by around 480 contracts. Long exposure remains around 20% on the short side, though they remain heavily shorted as of now, and the exposure is around 80%. Come to the options data, 25,500 and 25,600 put options, so very active. They have seen maximum increase in the open interest, and on the call side, 25,600 call and 25,500 call. Both these call options have seen a fall in the open interest because of the recovery that you have seen in the market. So support, first support 25,472, that's the 20-day moving average. If we fail to hold that, next support comes around 25,350. Resistance will be 25,765, that's the 50-day moving average. Two stocks remain the best, SAIL and Samant Capital. Keep it on persistent on all the other IT names. Today, Infosys is holding an AI summit, and in that, both the chairman and the CEO will say exactly what's their plan on the AI front. And second, Muthoot after Q3 earnings has been seeing fresh shorts, and yesterday also has seen fresh shorts.
Okay, Sudarshan, thank you so much for that. Given that you highlighted its expiry day as well, which is important, we'll see that yesterday's recovery after a couple of weeks of beauty performance, is that going to continue? As well as the names that you specifically in the IT pack will be key to watch out for, given Infosys Investor Day. But thanks so much for that, Sud. Let's move on, and India's penchant for gold ETFs has pushed the trade deficit to a record high of just under $35 billion in January. The value for gold imports almost tripled compared to last month. Lata Venkatesh is joining us now to give us more in terms of details on the widening trade deficit. Lata.
Yeah, this is some kind of an all-time high in terms of a monthly trade deficit, coming in at $34.68 billion. We normally do around $20 billion to $25 billion. The rise is because imports have jumped a lot. The January imports have come in at $71.24 billion, good 12% higher than what it was in December, which was around the normal average of $63.5 billion. Exports, meanwhile, have done a little worse. Remember, that is the month of 50% US tariffs. So it is $36 billion versus $38 billion that we did in December. And the biggest culprit for the higher imports is gold. Gold imports rising to $12 billion, again some kind of a monthly record, compared to only $4 billion in December. The January gold imports being higher was something people would have smelt, because last week the Association of Mutual Funds of India announced that India saw a record rise in gold ETFs. Investors were putting as much into gold ETFs as they had put in equities. That was one of the details that came out from the AMFI data. It was about 24,000 crore rupees that had been invested in gold ETFs, and exchange traded funds or gold ETFs have to be backed by physical gold, and that may have led to the record gold imports of nearly $12 billion in January, leading to the higher trade deficit.
Thank you so much for that. But India and Indian trade negotiators will now be visiting United States next week, and this is going to be to finalize the agreement for the first tranche of the trade deal. The team will pursue reduction of tariffs from 25% to 18%. Let's go across to Abhimanyu Sharma, my colleague, who's here to give us more details on that one. Abhimanyu.
India's chief negotiator Darpan Jain is expected to visit the United States next week to finalize the legal agreement for the first tranche of a BTA. Now, India is expecting US tariffs to drop to 18% by as early as this week itself. However, if that does not take place, there is a likelihood that the Indian visiting negotiating team may take up the issue in person with the American officials. Both the sides are looking to sign a legal agreement by March 2026, though the Commerce Ministry indicated that a deadline cannot be ascribed to the same. On the import of pulses and varieties of cotton from the United States, more clarity is awaited on market access in the legal agreement. So it remains to be seen what would be the exact details which are going to be mentioned in the legal agreement, which both the sides are looking to sign by the March of this year. Now, digital trade barriers also are something which both the sides are going to decide, even as there has been an indication from government sources that digital trade barriers will not be a part of the first tranche of the BTA. As far as India's import diversification from the United States is concerned, the US is being looked at as a potential source for a diversification of imports in not just energy, but even for parts of data centers, as well as for several precious metals, in which India is looking to increase its overall imports from the United States as part of increase in bilateral trade. As far as cotton is concerned, India is already importing US cotton worth $250 million, and since the demand for cotton is expected to rise within India by virtue of an increased market access within the American market and also in several other FTA partner countries, there have been indications as per government sources that more imports of cotton may be undertaken to ensure that there is no shortfall of cotton in production within India.
Thank you so much for that, Abhimanyu. But on that note, we're going to slip into a very short break. After the break, we'll get you the highlights from day one of the AI Summit in New Delhi. Stay tuned in. Welcome back. Thanks for staying tuned into Power Breakfast on CNBC TV 18. Now, let's get to the latest highlight in terms of day one of the AI summit that is underway in New Delhi. The CEO of AI giant Anthropic, Dario Amodi, is in India to attend the summit, and he was in Bangalore yesterday to announce the company's new office. He said that India is the second largest market for the company's popular chatbot Claude, and added that Anthropic's business run rate has doubled in India in just 4 months.
Anthropic's business, its run rate revenue within India has doubled over the last 4 months since I last visited. On Claude Code may have grown even faster. We're just going through the ability to kind of build software with AI and build as kind of developers on top of AI, and build new applications. And I think again, just the kind of efficiency of the market here, the energy of very large numbers of people wanting to find something and build something, I think that greatly exceeds what I've seen anywhere else. You shouldn't build for where the AI models are now. You should build for where they are in a year or two. If you're a large enterprise, if you're a big effort trying to build something, it's going to take a while to actually deploy and test things. So you should be imaginative about where the technology is going to go. Don't build for step 4 out of a 10-step workflow. Try and do the whole workflow, even if the AI model isn't quite capable of it yet. The companies that have understood that, the kind of users that have understood that, I think have gotten much further ahead than others, and they kind of see the future because they're able to use models in ways that correspond to a product that we haven't released yet.
That's the word coming in from the CEO of Anthropic. But a quick programming note: Sam Altman, OpenAI CEO and one of the key architects of AI revolution, will speak exclusively to CNBC TV 18 later this week. Sam Altman will be in the hot seat on CNBC TV 18 as we ask him to chart out the AI future. Okay, on that note, we're going to step into a very short break. After the break, we'll get to cues in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now, let's go across to Manisha Gupta, who's here to give us the update in the world of commodities. Good morning, Manisha. Today, most of the Asian markets are shut, but what's happening in the world of commodities? What are we keeping an eye on? Gold, silver, crude? What should we watch out for?
Well, absolutely. Many countries in Asia, including China, are shut for the Lunar New Year holidays. Yes, the U.S. markets were shut. So there are very thin trading queues that we are getting in the Asian markets right now. Having said that, in the overnight space, we've seen most of the commodities actually decline. So you had gold prices down 2%, second day of decline for that one. Silver fell 2% as well. This is as most countries are shut. Markets continue to go in for profit taking, and then the street will watch out for the U.S.-led negotiations between Russia and Ukraine that start today. It also is about U.S. and Iran talks that start today as well. Having said that, ahead of all of this, Iran on Monday launched a maritime drill in Strait of Hormuz, and U.S. has deployed a second aircraft carrier in the region as well. Is the reason you're looking at the crude oil prices steady ahead of that second round of U.S. and Iran talks. It is profit-taking across metals as well. Copper fell 1% overnight. Nickel is trading at a one-month lows, and zinc and aluminum also continue to extend declines. The U.S. natural gas price is now trading at a four-month low as well. So all that euphoria that we saw in the month of January seems to be fizzling out in Feb for many of these commodities.
Thanks so much for that, Manisha, to give us the latest update in the world of commodities, as always. But on that note, let's move on and get to the latest update. What's happening here in Mumbai is going to be that the French President Emmanuel Macron has arrived in Mumbai now for an official visit from the invitation of PM Modi to participate at the AI Impact Summit. Maharashtra Governor and Chief Minister Devendra Fadnavis received their President and First Lady Brigitte Macron late last night. Later this afternoon, PM Modi and French President will hold bilateral engagements at the Lok Bhavan in South Mumbai, and then will inaugurate the India-France Year of Innovation 2026 and address a gathering of business leaders, startups, researchers and other innovators from both countries. As he boarded the flight for India, Macron posted on X saying en route to India to take our strategic partnership even further. He is being accompanied by business leaders and economic industrials, cultural as well as digital players. So interesting to get more updates there as well. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Nifty implied open still indicating a red start for the Indian markets. Let's watch out for that. But with that, we'll wind down this edition. Thank you so much for tuning in. Up next, your Pazar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. No US cues. US markets were shut last night, but there is enough to sort of take it forward based off where we left off in a very interesting way on markets here. IT very much in focus once again. Lots more to discuss. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. Well, Asia is in a complete holiday mode. So barring Japan, that's the Japanese market, Nikkei, the rest of the Asian markets are shut on account of Lunar New Year. So whether it's China, Taiwan, Korea, Singapore, all done, all out. So today we're on our own.
Well, that's right. And we're working hard, but participation was lower. Could be one of the reasons why yesterday we saw such bombastic gains. So let's see whether or not we can hold on to, because participation was relatively lower. We'll get to that in just a bit.
Absolutely. And, let's just take it from the top then. I mean, not very much by way of fresh cues or anything of that sort. It's a holding pattern in that sense, right? So you got US markets which weren't trading for the President's Day holiday. And so no cues. I mean, futures were trading, but I think for half a day. So no big sort of, signal from there. Oil basically is up about 1.33% or so. And by the way, there are talks today, right, between US and Iran conducted naval drills in this region of the Strait of Hormuz, which is, of course, an important pass-through point for oil tankers in that region. And today is the sort of meeting between US and Iran. I mean, because it's been going on for so long, and what happens is sometimes because, there's some headline or the other, but there is no real breakthrough one way or the other, markets kind of get complacent. Well, this is going on at the back of the mind. But it's an important one. I mean, think about it. If there is a deal or there is no deal, and there's if it goes the other way, President Trump, of course, has been dangling both the carrot and the stick, right? With the stick, of course, is all the armada and the carriers and the aircraft carriers and all the fighter planes which he's positioned in the region around Iran. So, I mean, I think it's in that sense an important one, especially for oil prices, but I think for risk assets otherwise as well. Now, we got French President Macron, who's in India today, and he's going to be meeting Prime Minister Modi. And I think there's going to be, I guess, a fair bit of discussion around, deepening defense ties. And we'll sort of, keep a track of this. There is an event later today in Mumbai near the Gateway of India. And I think we'll hear from both leaders then. Now, I'll just quickly come to the levels because, I mean, beyond that, there's not very much. So yesterday, actually, the Nifty played out exactly in terms of the levels that we put out yesterday morning, right? What were the levels? 25,700 on the upside and 25,450 on the downside. So we bounced from the support of 25,450, notwithstanding, of course, the intraday breach of that level. We got below 25,400 intraday, but then, I mean, not on a closing basis, and that support in that sense, 25,450 remains. We got to the resistance of almost 25,700, I think 3 or 4 points short. And we kind of sort of, ended near those levels. So two numbers from here on the upside. I mean, the downside remains the 25,450 level. So we got to get past 25,750. And then the next stop, I mean, if we cross 25,750 is about 26,000. 26,015 is the precise level. I'm not going into the details here, but these are the two levels. If we fail here, which is 25,700, 715, this zone, I mean, I think a retest of the 25,450 levels is possible once again. So in that sense, this is an important kind of area. And we'll see what happens. I mean, I think the cash market positioning, etc., is not all that encouraging. I mean, I think there was a glimmer of hope with foreigners starting to buy, but I think that started to turn negative once again already. GIFT Nifty on your screen gives you a quick sense of how we likely to start, and we'll move it from there. So 100 points lower on the GIFT Nifty is the implied open. So we'll see in the next hour or so how that moves. Nigel has walked across to the wall with what the F&O positioning is looking like. Nigel, over to you.
Well, since the GIFT Nifty is down by close to 100 points, the temptation yet again would be that maybe, in fact, this market is providing you a bit of a dip. Maybe a little bit of a wider dip is what the bulls will be looking forward to. And then they'll be looking to buy into that dip. At least that's what's been the trend. And they'll be hopeful that today more of the same does play out. In terms of institutional flows yesterday, the institutions were net buyers to the tune of more than 700 crores. That's the FI and the DI number put it together. The FIs, they were sellers, close to under 1,000 crores. But actually, the gross volumes from the FIs were 45% lower if you compare it with the February averages. So they were virtually absent in trade yesterday. They were not at full power in yesterday's trading session. So that could explain one of the reasons why we actually had a very, very good trading session, because the big seller was actually away. What did they do in the F&O market? Well, they went ahead and they added some long positions, close to around 2,000 contracts or thereabouts. The short position continues at around 80%. On stock futures, they added more longs than shorts, but that's a bit of an arbitrage play that takes place out there. Cash as well as stock futures is what you need to look at together. In terms of writing index options, well, in yesterday's trading session, those calls that were written earlier, they got bound out. You know, some of those call writers, they packed their bags. They said this market is moving in too much of momentum, so they wanted to move out. While on the put side, there was a good amount of writing. In an uptrending market, you want to see put writing. And because of the kind of put writing and call unwinding that you saw, the PCR had mentioned yesterday, it was at the lower end of the range. And that was one trigger to see that, you know, you do see a bit of a dip and then you see buying from lower levels, because that was at the extreme level. And normally at 0.6, 0.64 odd, you'd have seen a bit of a bounce. Now it's back to around 1.1. So one strike that was active, though, the 25,500 put, the premium, well, it crashed. It came down to around 30 rupees approximately. So there's aggressive writing that we're seeing at this particular strike, which brings us to the levels then. You know, if you look at a reference point, then yesterday's low becomes a reference point. Ballpark 25,350 or thereabouts. So you have the 200 DMA as well as yesterday's low. That's the important mark. You don't want that to breach on the downside. A little higher from there is the 20 DMA. But that's the important level that you don't want to breach. Until that holds out, you'll still be betting your chances that maybe, in fact, we see a bit of a bounce. But the tech index, you know, the good news yesterday was it made a higher low after a while. So yesterday's low, in fact, was higher than the previous day's low. So till that level holds out, you'll be hoping that you get a bit of a tactical bounce, because the tech index has got absolutely bombed out. So I'll keep an eye out on the tech index, because yesterday as well, the signs were encouraging. Towards the end of trade, actually, it recovered from the lowest points of the day. Maybe, in fact, it got some bit of a relief rally that's due for the tech index. Let's see how that goes.
We'll find out today. Thank you very much, Nigel. For that, let's invite Neeraj Seth, founder and chief investment officer at 3R Investment Management, on the show now. Neeraj, thank you very much for joining in. Limited global cues to discuss today. US markets will open after an extended weekend being shut yesterday for Presidential Day, and Asian markets also largely shut on account of Lunar New Year. So let's begin with the AI scared trade, because we've seen a massive sell-off. Like, global tech names have lost nearly $2 trillion in market capitalization in the month of February. In India, the Indian IT index is down 13% in the last fortnight. So at 3R Investment Management, what are you all doing? Do you own tech stocks? And what is the view now after the weakness?
So sure. First of all, we're more focused on credit across the region. But from a broader market perspective, I do want to highlight two aspects of AI which are actually playing out. And we have talked about it in the past. The first is the investors are questioning the AI capex and the potential return on investment on that capex. And you're seeing that playing through some of the direct players in the AI market. And the second is the second order effect of AI, specifically in software and services, where you're seeing a significant pressure on a number of software companies, not just in India, but across the globe, with what's happening in AI and how that evolves from the standpoint of the business model of the software businesses. And I don't think we have seen the end of it. So this is certainly something that will continue to keep some caution and pressure in the markets.
You mean in the US Mag 7 perhaps under a bit of fire going forward? That's what you mean, Neeraj?
I would say more differentiation. Even in the Mag 7, you don't see the performance to be actually similar across those 7 stocks, let aside the rest of 493 in the S&P 500. So the point is, you have seen the market have started to differentiate in terms of trying to predict who the winners and losers will be, or how to think about the return on investment from these large capex announcements, because not every announcement from a capex perspective is actually giving the boost to the stock, which was the case last year. So I think you will see more differentiation, and you will see obviously that, in a way, good thing that it will lead to broadening of the investors' portfolios with regards to diversification.
All right. Hi, good morning. Good to see you in. I wanted your view on the dollar index. You know, I was looking at a Bank of America survey that suggested that the shorts on the dollar index, that's the highest that we've seen in the last 14 years or so. Now, there's a lot of talk that maybe much of the easing is behind with regard to what the Fed has to do. And the optimism has cooled off with regard to the cuts that we'd like to see this year. In that sort of a backdrop, do you think the dollar index is nearing a bit of a base formation, or do you think it gets weakened further from here on?
So I look at it in two horizons, the near term and more medium to long term. In the near term, you're absolutely right. I think there is a consensus positioning building up. And with the CPI where it came, the markets are pricing more than 2.5 cuts now from the Fed, which I think is on the higher side. I don't expect another more than 1 to 2 cuts at most, which means in the near term, dollar can actually strengthen. But longer term, looking at the fundamentals, the balance of payment, and the expensive nature of where the dollar is, I still think in the next few years, dollar still has room to weaken further, which is good news for the emerging markets. But near term, I'll be cautious on being short dollar here.
You know, Neeraj, what I want to do is, and we'll cue this up, and we're going to just play out these sound bites. And you might want to hear it. I just wanted your thoughts on this, right? You spoke about the dispersion in U.S. tech stocks and, you know, what you expect. I mean, the market's not responding to the news flow around the big U.S. tech names the same way it used to last year when these big investments, etc., were being announced. So we had, you know, of course, we have this big AI summit in Delhi. But the CEO of the AI giant, Anthropic, is, of course, also in India to attend the summit. He was in Bangalore yesterday to announce the company's new offices. And this is what he had to say. It's basically saying that India is the second largest market for the company's popular chatbot, Claude. You know, he says, well, you know, the use of Claude in India is basically for highly technical purposes, which was interesting. I just want to play that out.
Anthropic's business, its run rate revenue within India has doubled over the last 4 months since I last visited. On Claude Code may have grown even faster. We're just going through the ability to kind of build software with AI and build as kind of developers on top of AI and build new applications and I think again just the kind of efficiency of the market here, the energy of very large numbers of people wanting to, find something and build something. I think that greatly exceeds, what I've seen anywhere else. You shouldn't build for where the AI models are now. You should build for where they are in a year or two. If you're a large enterprise, if you're, a big effort trying to build something, it's going to take a while to actually deploy and test things. So, you should be imaginative about where the technology is going to go. Don't build for step 4 out of a 10-step workflow. Try and do the whole workflow, even if the AI model isn't quite capable of it yet. The companies that have understood that, the kind of users that have understood that, I think have gotten much further ahead than others, and they kind of see the future because they're able to use models in ways that correspond to a product that we haven't released yet.
Okay, and now, of course, Dario is going to be in Delhi on 19th. There is the big panel in which there's Sam Altman and Anthropic and Microsoft and others, etc. Neeraj, any thoughts? Indian IT services. I don't know if you have any feedback at all.
So two points on that. The first, I would say, we are now moving from the very basic AI application hardware infrastructure story to the beneficiary story. And it's going to move from the point solution, which is the productivity enhancement at individual level, to a system redesign, is what you heard in the points he made. And the second is, I am actually quite optimistic in the long term in terms of India's ability to pivot and position itself as one of the service providers with AI for system redesign, not point solution, which brings me back to 1990s when the whole IT revolution started. So I think there is a potential for the IT services companies, specifically the ones who can pivot, to position more alongside AI, helping the underlying businesses to benefit on the productivity side. We haven't seen that as yet, and hence the market is nervous. But I'm very certain on one thing: not all software or services companies are going to go away in the next 10 years. It's going to be a more who is able to pivot and actually provide the differentiation in terms of the services. And I think it's going to happen. I'm quite optimistic in the medium term on some of the better quality IT services firms in India.
Yeah. Absolutely. Thank you very much. And good chat there, Dheeraj. Thanks for your time. Let me just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. 8:35, we've got the management of Galaxy Surfactants to discuss the company's December quarter earnings. 9 o'clock, we have Ragvesh of JM Financial to put the spotlight in capital markets. 9:20, Gautam Shah of Goldilocks Research. He's a market master. 9:35, the management of Happiest Minds is going to be with us to talk about the F527 outlook and, of course, the state of AI. The management of Tenneco India will be speaking with us at 9:45 on their third quarter earnings. Towards the end of the program, Lata in conversation with Siva Ramakrishnan of Gokuldas Exports on life after the US, India-US deal, the framework deal, and, of course, what's happened with the EU as well. Stay tuned.
Welcome back. Let's talk about stocks now. This is CNBC TV 18's list of top stocks for the day. And this time it's Ria compiling that list for us. Ria.
Well, good morning. Let's start off with Cochin Shipyard first. They have emerged as the L1 bidder for the construction of 5 next-gen survey vessels for the Indian Navy. The total order value is rupees 5,000 crores, and the order book of the company as of the end of Q1 of FY26 stood at roughly 21,100 crores. Tex Macro Rail will also be in focus today on the back of an order win. They have received an order worth roughly 210 crores from the Mumbai Railway Vikas Corporation. JSW Infra will be holding a board meeting on the 20th of February to consider a fundraise. MSC Development has received a RERA approval for its first project in Alipag. The estimated GDV is at rupees 400 crores for this one, and the launch is planned in Q4 itself. Lupin has signed a license and supply agreement with Spectus to commercialize a novel antidepressant called Tesla Flex in Canada. And lastly, TVS Supply Chain will also remain in focus today. They have signed an MOU with an Italy-based company called ALA to enter India's $28 billion aerospace and defense supply chain market.
Okay, thank you very much for that. And keep your eye on the Infosys AI Investor Day. That begins at 11 o'clock, and the first track is going to be Nandan Nilekani, who's going to talk about why AI transition is different. And then it's going to be followed by the CEO, Salil Parekh, who will talk about the AI services opportunity with CNBC TV 18. We'll keep getting you more on that, but that starts at 11, and I think it ends at about 4:30. But let's talk about the macros now. India's trade deficit hit a 3-month high, and the big culprit, besides falling exports to the US, was the very high gold imports. Gold imports rose almost 3x compared to the prior year. Lata joins in with the details. Lata.
Yes, it's a 3-month high trade deficit at almost $35 billion. I mean, we have done worse in October when, again, gold was the culprit. People buying gold for Diwali. And this time it's gold again. Let me just give you the overall data. January imports were up 20% YOY, about $71 billion, a large part contributed by gold. And Jan exports were almost flat year on year, up about 0.5% to $36.5 billion. Like I told you, the culprit was gold. Gold imports were $12 billion. I don't ever remember reporting such a large number. This is 3x what it was, in fact 3.5x what it was a year ago, January, at $2.7 billion, and also 3x compared to this December. So month ago, year ago, both it is about 2 to 3x. Higher gold imports were partly because of the very high ETF demand. You remember when the AMFI data came, we were all preening that gold ETFs are almost equal to the flows into equity mutual funds. It was about 24,000 crores, a record. And what we learn is ETFs have to be backed a bit by physical gold as well. And that may have contributed to this extraordinarily high gold import. Just to speak about the other exports, what did well for India in exports was actually engineering exports, up about 10%. And what was perhaps, I hope it is not the start of a worry, electronics exports, always a winner for us, were flat. Just about $4 billion as it was a year ago. I hope this is a one-off trend. Textiles fell, and that's not surprising, but unsurprisingly, marine exports have done well. As we know, they have been able to diversify out of the US. Overall, April-Jan exports have been up only 2.2%, whereas April-Jan imports have been up 7.2%. To speak about US itself, month on month, the US exports fell by 22% in Jan. But if you look at April-Jan again, we are still running at a positive 6%.
All right, Lata, thank you very much for that. I mean, absolutely right. I mean, for all the ETFs, I mean, the financial instruments, I mean, rules say that you have to have that, it's got to be backed by physical stuff here in India, and I think that's contributed to that big jump in the import number there. Well, let's talk about, stick with commodities for a bit longer. Manisha is here with a roundup of the action. And of course, I think oil is in focus, but what else? Manisha, morning.
Well, absolutely. Thank you for that, Prashant. Oil is what I'll start with as well, because a second round of talks between US and Iran starts today. Iran on Monday, in the meanwhile, has launched a maritime drill at Strait of Hormuz. This comes in on the back of US deploying a second aircraft in the region. So even as we're looking at talks on the ground, both the countries continue to increase their war machinery there. And US-led negotiations between Russia and Ukraine also start today, so there are two events to watch out for, only for crude in that sense. In the meanwhile, you have IEA and OPEC both talking about a surplus situation in 2026. OPEC also says that they might be resuming supply hikes for the month of April. Well, that decision is something that the OPEC will take in the first week of March. So plenty happening in case of crude oil prices there, and we're looking at steady prices ahead of both of those very important talks coming in. The other metals have gone in for a bit of a profit taking. Gold has declined for a second straight day. We are trading below $5,000 an ounce onto this one. And silver fell 2% overnight. Well, there is a situation of weak liquidity as many markets in Asia are shut, and that perhaps seems to be bothering. In any case, you also have Fed meeting minutes, US GDP, US inflation data, all of that number also coming in this week. So ahead of that, it's a bit of a decline that we are seeing in this space. And not just gold and silver. Copper fell 1% overnight. Nickel is trading at a one-month lows. We've seen profit taking in zinc and aluminum as well. So metals as a segment seems to be going in for some more profit taking.
Got it. Okay, all right, Manisha. Thanks a lot for that. Well, let's hop across to Sudarshan. Wakes up early, goes through a lot of brokerage notes and gives us an insight on a few of them. Morning, sir. Hope you're feeling good.
Good morning, Nigel. So I have few stocks. First one is L&T CLSA maintains outperform call with a target price of 4,842 rupees per share. And this note comes after the company has executed the agreement to sell Nabha Power to Torrent Power. And because of this, CLSA believes that company will get rupees 26 per share and it may announce special interim dividend because company remains focused on achieving ROE of 18% this fiscal. And because of this exit from Nabha Power, this will add to the ROE of the company. Next one is Fortis Healthcare. Over the weekend, company had announced earnings and yesterday it held investor call. And that one commentary looked largely positive and most of the brokerages remain positive in the stock as well. Citi maintains buy call with a target price of 1,120 rupees per share. It mentions few catalysts. First, existing hospitals showing strong traction. Brownfield expansion at high occupancy facilities set to improve the margin for the company, and newly acquired facilities are performing well as well. And parent company IHH remain open to further equity infusion. Last one is Tata Motors Commercial Vehicles. HSBC maintains buy call with a target price of 534 rupees per share. It believes that M&HCV demand remains strong and it's being led by capacity additions by small fleet operators, replacement demand from large transporters, and upside risks. First one, introduction of new engines. Second, Iveco stability, and third one is recovery if it sees in LCV. And valuations as compared to Ashok Leyland and all the PE players remain at discount for Tata Motors Commercial Vehicle. That's the reason HSBC is positive.
Yeah, no, absolutely. So thank you very much for that, and we'll sort of get some more views on this one as we go along. Well, let's take a quick commercial break here. Mayuresh Joshi of Mark Smith India is going to be with us for some fundamental stock conversation. We also have the management of Galaxy Surfactants to discuss their numbers and the outlook going forward. So K. Natarajan joins us for that. Stay tuned.
Well, let's welcome the first management on the show, Galaxy Surfactants. That's in focus on the back of their Q3 numbers. To discuss the past quarter, what's the way ahead, we're joined by Mr. K. Natharajan, the Managing Director and CEO at Galaxy Surfactants. Good morning, Mr. Natharajan. Always good to speak to you. Hope you're doing well this morning. Well, the past quarter's numbers we have, a bit of a soft quarter with regard to margins. But let's look ahead. What's the guidance for FY27? Considering there could be some respite in the industry, India and US have got into that trade deal. So give me two numbers. Volume growth that you'll end this year with, and on that base, what kind of growth will you be looking at? And the EBITDA per ton as well. What could be the broad range? Please go ahead.
So this year, I think we have met multiple headwinds and we have managed to put a good set of numbers. The flat 9 months volume growth rate, and also but then yes, we've been able to show growth in a EBITDA per metric ton. 20,000 and all this quarter. Now, for 27, I would probably look at ending the year with a slight volume plus. Okay, it all depends on how things goes in this quarter. And EBITDA per metric ton, I'll stick to my range of 19,000 to 21,000. We would have done a good job if we are closer to the higher end. But yes, we need to see as to how the balance portion of this quarter goes.
Just to confirm, sir, volume growth for this year will be, and next year? I didn't get that number.
Volume year for this year, I said, will end flat. Okay. For next year, I would like to wait probably till May when the India numbers pick up, because it's expected as the commentary of all our customers in India that they're seeing some green shoots because of the GST rationalization. But we need to wait at least till May to be able to have a clear picture on what the volume growth will be for FY26-27.
Okay. Sorry, sir, we still couldn't quite catch the volume growth guidance for FY26. What is it going to be?
I said, see, our 9 months has been flat.
Okay.
Okay, and then I said we would be pretty happy if we are able to report overall slight volume plus growth for the 12 months. But yes, we're keeping our fingers crossed.
Okay. So volume growth flat, maybe just a minor single-digit kind of a growth for the full year. But in that, your specialty care volumes have done particularly well. That's seen a growth of 35%. Was that a one-off, or can specialty, care volumes continue to see this kind of growth rates?
No, it is a combination of certain projects in pipeline that matured and we were able to start the business in Q3. But it also, as our response to the US tariffs, we had initiated certain aggressive market placement of volume. So that also aided. So I would expect it to be a good growth, but it's not that we'll keep continuing to 35% growth. But what is important is that with the US tariffs getting taken care of, we do see all our projects in pipeline that got suspended in our North America market getting revived. And that would help us getting into the next financial year.
Mr. Natharajan, morning. Just one quick point. This is the specialty stuff you sell into Europe mostly, right?
No, it's rest of the world. Europe and North America and Latin America are the big markets.
I see. So it's kind of evenly spread out. It's not just, it's not skewed.
It's not just, no, not exactly, because Europe, we have been having challenges since the time, it has been battling its own problems. So we do have a lot of projects that are in the pipeline, but some of them are not getting progress the way we want it to be because of the challenges that some of our customers there in Europe are having. So we need to pivot across. We need to pivot across North America, Latin America, and Europe. North America, we had a headwind in terms of the tariff. That having gotten taken care, we do hope things will look better in the coming quarters.
For the US, that for the specialty chemicals you produce, the tariffs are dropping, are going down, because you'll have to go line item. When the agreement comes out, right? But you think for you tariffs are going down?
No. First of all, there are two things. It has been announced that the 50 goes to 18. The 50 has suddenly gone back to 25. Because the Russia crude penalty has been removed. Okay, so 50 comes to 25. The question that we need to wait for when the details emerge is whether the 25 remains 25, 25 comes to 18. But that's too early to say. But 50 to 25 itself is a significant relief.
I see.
So how big is the US market for you as a percentage of your revenues right now?
So there are two aspects. One is US market. We look at what our subsidiary Trike does there, okay, which is a huge business within US. So that obviously is not as much impacted by the tariffs. But then what we do from India and Egypt put together, we're talking about 10 to 12%. Okay, and we do see there's some products that really got impacted in a very huge manner, which we do from India. That would start getting better due to the tariff getting reduced.
Okay. So your volumes in AMET, that's Africa, Middle East and Turkey, saw a double-digit decline. A, what led to that? And two, has it bottomed out? Can we expect some improvement?
I'd say that the struggle in AMET continues because two of our biggest markets, Egypt and Turkey, are battling significant currency depreciation as a fallout of the huge inflation that they have. Now that has impacted consumption and also the significant amount of competitive intensity with certain players in the end market who also are backward integrated. Now, I'd say that this seems to have bottomed out. Okay, we do see certain better numbers emerging, but we'll have to probably wait for 2 more quarters to see how it sustains.
Okay, just one more question. I think you spoke about in one of your major tier 1 client, there was a volume loss due to some change in formulation. Has that been resolved, or have you received commitment from the large client, or will it continue to drag?
No, the reformulation obviously has happened in terms of the way that the oleochemical prices and the crude petroleum derivative prices have, significantly expanded in terms of the pricing. So that is something that continues to be a challenge because fatty alcohol prices don't seem to be relenting. It continues to be at a high level. So we do see the customer does tell us that they're looking at if it softens, we'll see probably whether there is some reformulation happening to our advantage. But as of now, we're preparing to see how we are able to participate in the reformulation by coming up with our own line for the alternate surfactant.
No, absolutely. Thank you very much. Good luck as you sort of execute.
Thank you.
I appreciate it. Mayuresh Joshi is with us, Director Research of Mark Smith India. Mayuresh, good morning. Good to have you with us here. Thanks for joining us. Just a quick word, Mayuresh, on this, of course, what was the big story yesterday with regards to the RBI circular on prop trading and capital market exposure with regards to banks. The one big hit, of course, was BSE, which came off the lows, but, it's clear, and I think the HDFC Securities CEO put it plainly. He said, you look at what the STT hike is telling you, you look at what the RBI is doing, you look at what SEBI is saying. I mean, they're all kind of synchronized towards, bringing down speculative activity, essentially in the F&O side. So just your thoughts here, Mayuresh, and what would you do with the stock?
Morning, Prashant. No, I think, as you rightly pointed out, I think the regulatory moves are pretty clear. The STT hike, what RBI has done yesterday with the final conclusions that it has come to, it is pretty obvious that speculation and speculative trading is something that both the regulator and the RBI probably wants to put a cap on. And therefore, are there more regulations coming in terms of SEBI norms? Is it something that we should look out for? But with the existing norms, it's pretty clear that speculative activities are definitely under the radar. Having said that, I think asset managers, Prashant, within the capital market theme is always one space where we believe at Markets with India that the kind of consistency that one really expects over the next few years, both in terms of equity and debt flows happening through SIPs or direct investments, and wealth management as a theme. The number of individuals who will probably need wealth management solutions or the households are actually expected to double over the next 5 years, which means you will need specialized professionals to probably manage and diversify your entire wealth management perspective as an asset class. And therefore, I think asset managers, HDFC Asset Management, is something where the rating rankings look absolutely fine as we speak. And therefore, within the space of capital markets, I think these players are where the rating rankings look very, very strong at once.
Hi, Mayuresh. Good morning. Good to see you, Ben. What about Ola Electric? There's another downgrade that's coming. Nimesh just sent us a note, I think, from Citi. Yesterday, there was a Kotak note as well. The story is going horribly wrong. What's your view on the stock? I recall just after listing, the stock went dancing away to around 140 rupees. Then it came down and then it had a big relief rally actually, with a lot of funds tanking up. Now I believe some of them have sold out. The stock is up 30 rupees. What's your take?
Morning, Nigel. I think we've always stayed away from this stock, even from the listing day itself. I think our perspective was that the bigger players in the same space have done the right things. Obviously, they are diversifying as we speak, and they've got better capabilities in terms of both sales, service, and distribution as well. And that is where I think the strategic advantages lie with the bigger players, even when it comes to the entire EV ecosystem. For a large part of the upcoming EV ecosystem or the startup market, I think both the aspects in terms of dealership and distribution and service is something where they might require specific amount of resources and capital to be pumped in, which the bigger players have at their disposal as we speak. And therefore, our take was always that the bigger players are always better positioned as time elapses. And a lot of the launches that we've now probably seen from the bigger players in the ecosystem are happening at the right price points. They are happening with the right perspective in place as well. And with fewer complaints, so as to speak, with a straight comparison to what Ola has been facing on all these aspects put together. So I think the bigger players in the ecosystem might continue.
The deal which got concluded overnight, Torrent Power, has announced the acquisition of Nabha Power from L&T. And L&T, according to CLSA, is going to cash in 26 rupees per share, and therefore they're looking at a special dividend that's coming in from L&T. And for, Torrent Power as well, the acquisition makes sense. Valuation appear to be reasonable. Have you all analyzed this deal?
Didn't get a chance, Rima, honestly, to probably look at that. But I think from a strategic perspective, I think L&T is one stock that we continue holding in our global portfolios. I think when you talk about CapEx and when you talk about the flag bearer of CapEx in India, I think L&T probably comes to mind. And obviously, I think the kind of divestments that L&T has been doing in its non-core assets or businesses where they at least feel that they're no longer interested in carrying out on a very positional or strategic kind of scale. I think they're probably doing the right thing. Having said that, I think the expectations in terms of the overall order book, in terms of the overall working capital, in terms of expectations of ROEs, I think that should have a steady state improvement. So in my own sense, didn't have a chance to look at the deal, but L&T still remains one of our top holdings as far as leadership stocks are concerned in our global portfolio.
All right. Myresh, I know you follow a healthy living, so I don't think you're a smoker. Tennis as well is something that's normally, one of your favorite sports. But what about ITC? The stock has seen a sharp pullback. Now, over the last few days, you've heard of price hikes. I don't know the exact quantum, but they're trying to evolve the business model as well with regard to introducing different sizes of cigarettes as well. And I believe there are some price hikes that have come about. The stock has got slammed. Biggest underperformer post that duty hike. Your view on the stock at current reckoning, is bulk of the bad news in the price? Would you look at it?
A large part of it is, yes, in the price, Nigel. But again, I think in terms of pure demand and elasticity, I think the kind of numbers that the cigarette business will throw out in terms of an absolute revenue or an absolute EBITDA might not have a significant dent with the price hikes they've probably taken. My only concern with ITC is the announcement that they've done 3-4 quarters back in terms of foraying into different products. And you've seen this in the past when they got into the other FMCG business. It took quite a time for that business to properly scale up and a lot of capital investments, which probably kept both ROEs and ROCs on a consolidated basis under check. And that is where the concern lies, in my opinion, at least, with the kind of capital investments that can go in terms of developing new products, exploring new markets, and ensuring that they become 100 crore plus products in terms of market size over the next few quarters. ROEs and ROCs will probably remain far more stable or under the radar as we speak. And therefore, I think a sideways time correction is what we believe ITC might go through. Within the FMCG pack, our take again is that Nestle India probably has been a standout as far as numbers were concerned for the quarter.
Okay, all right. What we're going to do is take a quick commercial break here. So stay tuned. We're back with some volume buzzers from yesterday. Sudarshan and Mitesh also, of course, joining in with some technical trading ideas. So coming up in just a bit. Okay, welcome back. Sud is back with us with the big movers from yesterday and, stuff which moved around with heavy volumes, notable volumes. Sud, over to you.
So amid the recovery that we had seen in the market yesterday, we had few stocks that saw huge trade with healthy volumes. First one on the list is Precision Wires. That company had announced earnings over the weekend, and those earnings looked very strong. And on the back of that, we saw a huge move in the stock. Stock is currently at a 52-week high. Yesterday, it had moved 14% higher. And volume yesterday was of 2 crore shares versus 10-day average of just 6 lakh. And if you talk about the earnings, profit is double in Q3, and EBITDA was up almost 80% YOY. Next one is Indus Towers, which has been seeing buying by promoter, that is Bharti Airtel, since the start of this month. And this stock too is at a 52-week high. And delivery percentage was above 50% for 9th straight session, and Bharti Airtel, which is the promoter, has bought 45 lakh shares since February 5. Additional 12 lakh shares were bought on 11th, and that was reported to exchanges yesterday. Last one is the auto ancillary player. Normally we don't talk about this stock, but off the late this stock too has been buzzing. That is RACL Geartech. Yesterday that stock was up 50% and volume was at 10 lakh versus 10-day average of just around 23,000. This too had announced earnings over the weekend and revenue was up 21%, and margin too company has managed to hold above the level of 21%.
Yeah, no, absolutely. Thanks very much, Sud, for that. I mean, that was a big one, right? And on very large volumes as well. Figure in the top 15 odd volume led gainers on the NSE yesterday. Mayuresh, of course, is with us with, what he'd want you to do as we sort of, look ahead. The Infosys Investor Day, Mayuresh, is today, right, in the morning. And it's what a time to do it, right? Because everybody's talking about what all these models will do to Indian IT companies, analysts and writers, and but except the IT companies themselves. So I guess today we will hear from the IT company, a top IT company themselves. What's your sense? I mean, what would you like to hear, really?
Prashant, I think two things. One, I think the AI competition, if you want to call it that way, I think is serious, and it is something which IT companies need to take cognizance of. But it's not just some kind of inorganic acquisitions that is probably going to aid or help or abet them in terms of this journey, but some serious introspection in terms of how these companies are probably going to adapt to this entire AI ecosystem as we speak. And therefore, I think gearing up to the challenges faced by the AI substack, as we see it, I think there has to be some serious roadmap over the next few years in terms of how IT companies are probably planning this. Second, I think the entire model itself will change because in the past, what we've seen in terms of the entire outsourcing, outprocessing model that IT companies have traditionally been doing, if they probably have some element of a capex done, both in terms of upskilling of their employees or having a dedicated capex in terms of creating these units, that might take some sheen away in terms of both the core margins itself, as well as some elements of buybacks and dividends that these companies have to announce. So I think how these companies are going to probably navigate through these challenging times, which is a need of the hour over the next few quarters, as I say, is something that the markets will like to hear, because other investments done by major platform and product companies in the US are massive as we speak.
Yeah, absolutely. We'll be interested to hear from them today. And then we'll sort of course, report on it as details start to emerge. Thank you very much, Mayuresh, for joining us here. Now, the Indian trade negotiators will be visiting the US next week to finalize the agreement for the first tranche of the trade deal, that is India-US. The team will pursue a reduction of tariffs from 25 to 18%. Remember, 50 to 25 and now 25 to 18. Abhimanyu is here with some details that he picked up. Abhimanyu, over to you.
India's chief negotiator Darpan Jain is expected to visit the United States next week to finalize the legal agreement for the first tranche of a BTA. Now, India is expecting US tariffs to drop to 18% by as early as this week itself. However, if that does not take place, there is a likelihood that the Indian visiting negotiating team may take up the issue in person with the American officials. Both the sides are looking to sign a legal agreement by March 2026, though the Commerce Ministry indicated that a deadline cannot be ascribed to the same. On the import of pulses and varieties of cotton from the United States, more clarity is awaited on market access in the legal agreement. So it remains to be seen what would be the exact details which are going to be mentioned in the legal agreement, which both the sides are looking to sign by the March of this year. Now, digital trade barriers also are something which both the sides are going to decide, even as there has been an indication from government sources that digital trade barriers will not be a part of the first tranche of the BTA. As far as India's import diversification from the United States is concerned, the US is being looked at as a potential source for a diversification of imports in not just energy, but even for parts of data centers, as well as for several precious metals, in which India is looking to increase its overall imports from the United States as part of increase in bilateral trade. As far as cotton is concerned, India is already importing US cotton worth $250 million, and since the demand for cotton is expected expected to rise within India by virtue of an increased market access within the American market and also in several other FTA partner countries. There have been indications as per government sources that more imports of cotton may be undertaken to ensure that there is no shortfall of cotton in production within India.
Thank you. Very important details there. For now, we'll slip into a break. On the other side, we'll come back with the pre-opening rates. We'll also be joined by Raghvesh of JM Financial to put the spotlight on the capital market stocks. Welcome back. Yesterday, market staged a strong rebound. We saw buying through the day and ultimately ended at the day's high around the 25,682. Today is also the Nifty weekly expiry. Where are we headed from here? Let's get in our experts, Sudarshan Sukhani and Mitesh Thakkar, on the show now. Gentlemen, good morning. Gap down opening is what the GIFT Nifty is suggesting. Does that throw up a buying opportunity? What is the call for the day? Sudarshan, go first.
Yeah, good morning. Unfortunately, no, the gap down doesn't suggest a buy on dips opportunity. Best case scenario for the Nifty is that the Nifty starts consolidating around these levels, say somewhere around 25,500, up and down a little. And that makes it choppy. Choppy markets are not good for trading. This is very rare. The Nifty has been an avoid for the last 3-4 days now, which is very unusual. But I don't think we should be looking at the Nifty at all. We will see choppy action, and we have to wait patiently for a consolidation to complete and show us direction. So avoid.
Okay, all right, got that. Avoid the Nifty is the call from Sudarshan. Mitesh, what do you think?
Yeah. See, on the index, yesterday's bounce back was slightly more than what I had anticipated, but I also mentioned that till we get past 25,750 levels, we will not be sure of this being a convincing turnaround. So I think today that might not happen, and we will again fall below the intraday and the daily moving averages, which means that the upside level of 25,700, 750 remains, and the overall structure is slightly on the weaker side. So I would believe that there could be a retest of 25,450, and maybe even lower levels could be tested. But this will hold as long as we don't get past 25,750 on the upside. So yes, on the index, from a day's perspective or a 2-day perspective, no trade available with the gap down. But yeah, we'll trade with stock-specific prices.
Okay, gentlemen, morning. Mitesh, what would those stocks be? What would you want to trade?
So I have a mix of buys and sells today. Morning, Prashant. One of the buys is Exide. It's been consolidating in a very tight range of about 340, 142 to about 330, 332. A breakout about 343 should suggest a target of 352. So buy about 343, take a 4.5, 5 point kind of a stop loss at 339, and a target of 352 on the upside. Then a sell on Angel One with a stop just about 2,600 for targets of 2,505. Sell on Hero Motors. Hero Motors in the short term could decline to about 5,400, 5,390 levels. So sell with a stop at 5,550. And Fortis looks like, the stock is turning around after a good correction. So this could be a trade on the long side with a stop at 896 for a target of 955.
Sorry, Mitesh, missed it on Angel One. Is it a buy or a sell?
Angel One is a sell call.
Angel One is a sell call. Okay. Sudarshan, what would your calls be?
Before my calls, yesterday Prashant was asking if there is an ETF for the IT index. There is. It's a very popular one. It's called ITBEES, ITBEES. It's a high volume ETF. And I would suggest investors who are looking to buy this sharp correction in IT can consider start nibbling into it and buying small lots. It's a separate part. I have Bank of Baroda as a buy with a stop under 285. Cummins Industries as a buy with a stop under 44.45. Two shorts, Colgate stop above 2160 and BPCL stop above 380. So it's a mix.
Yeah, no, thank you for that. Sudarshan, and the IT. I think on it had it's liquid, and I think that is important in that sense. So widely sort of traded and used in that sense. Thank you, gentlemen, for that. That's Sudarshan and Mitesh with their trading ideas. We'll go back to them for their 9-10 calls in a bit from now. But let's get in. Ragvesh now, who's with us. He's of course with JM Financial. And he tracks insurance and capital markets at JM. Ragvesh, good morning. Good to have you with us here. Thank you for joining us. We can calculate the impact in terms of P&L because of the prop trading thing, which has happened, the RBI circular. There is understanding that is a segment which is hit. HDFC Securities yesterday morning, same time, told us about 40% of volumes is from prop, F&O. And they expect about a 15-20% hit to F&O volume starting the 1st of April. So two questions. One is earnings impact and consequently stock implications in your coverage universe. But second, something again which the HDFC spokesperson said, that it seems like everyone is very focused, all RBI and government, etc., to bring down volumes, speculative activity in that sense. And that is kind of hard to model in right now. We only know what we know. But there may be other stuff coming. I don't know. So how does one account for that?
Yeah. Good morning, Prashant. First of all, thanks for having me on the show. So yes, rightly put, hard to model it out. What will be the impact on the volumes? My sense is on the retail volumes per se, if we look at a retail investor, the risk reward, what a retail investor can gain from F&O still remains significantly higher than a cash transaction. For the prop volumes, yes, we do expect some impact coming in, like your guy mentioned a 15% kind of impact. We'll have to essentially wait for it to play out. But when I look at the companies I cover, say an Angel One or a Grow, significantly dependent on F&O volumes, around 50% plus of the total revenue for both of these guys comes from F&O. But on the retail, I'm not expecting a very significant impact, at least on the retail side, where these are largely focused. In my coverage, say a Nuvama Wealth is largely dealing with the segment which is more HNI prop oriented. But over there, the total portion of the revenue which comes from this is not more than 10 to 15%. So again, I don't see a major impact on a name like Nuvama Wealth. Now, broadly, if we look at it on a structural basis, financialization is here to stay. While SEBI has over time, raised concerns on retail investors losing money in F&O, they will find newer avenues to make money and play the India growth story. In fact, for the names Angel One and especially Nuvama Wealth, I would see the current disturbance, the current weakness in stock prices as a good buying opportunity. Another name I cover, 361, it's relatively less exposed to F&O. Hence, the impact has also been limited on the stock price. But I would definitely consider buying Nuvama at these levels.
Yeah, you would buy Nuvama at current levels, right? So that's a one actionable kind of sort of item from all of this at this stage.
Yes, even Angel One at current valuations looks good to me.
Yeah.
Of course, there will be the odd action from the RBI, from SEBI, from the government of India. But at valuations of around 15x on FY28 earnings, I think these are pretty well factored in.
Yeah. Ragvesh, the Jain and the Jump and the Citadels of the world, they use their own capital, right? They don't use banks, obviously, and not Indian banks. Am I correct?
Yes, and that is my sense as well. I have not looked at their balance sheet, but it's pretty obvious they will not be using Indian banks.
Indian banks, got that. What about something like a BSC and, of course, the yet unlisted NSE? What's the impact on exchanges because of this?
So I don't track the exchanges space, so I'll not be a good person to give my views there.
I see. We had someone yesterday who said that, and this is a theme, right? Financialization and more savings into markets, financial products, basically, and the intermediaries are all these brokers and everybody else in the value chain. Is that as a theme? Is that thesis unbroken, or you think perhaps you got to account for some of this there? I mean, if you got a long enough timeline, long enough investment horizon, Ragvesh.
See, the key is which are the products which have a longer runway for growth. Like what we are incrementally seeing is, say a couple of years back, people would be fixated on a lot of sectoral funds. Say a specific stock idea which can say double in a year. Now what we are seeing when the markets have been choppy, if we look at the mutual fund inflows, they are incrementally going more towards the flexi caps, more towards the hybrid categories. So people are essentially entrusting their fund managers to make that call, make the stock call, make the capital allocation call for them. So I would look at a space where you're not just focused on, say, stock ideas, but where you're offering a holistic wealth management solution to the client. Hence, structurally, I'm very positive on the wealth management space, 361, Nuvama, AMCs which have established and are getting significant inflows. Like if I look at the AMC space, say 5-6 years back, the inflows as a percentage of the opening AUM would be somewhere around 7-8%. Now that number has increased to, it was 17% in FY25. Even this year, we are expecting it to be somewhere around 12-13%. Now, 12% in inflows. Say structurally, the equity markets give you 12% odd returns. So we are looking at an AUM growth in equity plus hybrid of around 24%. With some pressure on pricing, 20% is my top line growth. Expenses typically don't grow beyond 15%. So there would be short-term disturbances, but we are looking at a structural story of around 20% earnings compounding in names which are well established, have a decent track record of 20, 25, 30 years of performance. So broadly, I would be looking at more of the AUM-linked businesses, which are offering a holistic solutions. Like I mentioned, 361 Nuvama. In the AMC space, names like HDFC, AMC, and Nippon Life.
Okay, got that. Thank you very much. Very useful, Raghavesh, just in terms of how to think about some of these areas and pockets, because of news flow, which we got, of course, over the weekend, and beyond this as well. Well, I think it's now 9:10, so let's get Sudarshan and Mitesh back with us. Sudarshan, what do you have?
It's Bank of Baroda. Buy Bank of Baroda with a stop under 285.
Okay, BOB and Mitesh?
I'll go with the buy on Exide if it starts getting past those levels of 343.
All right, let's talk about IT, because everyone is trying to figure out where IT sector is headed next after the sharp 13-14% correction that we've seen just in the last 2 weeks. The question is there more pain ahead, or is value finally emerging? So this is some brokerage views that we got earlier today. Now, UBS believes the sell-off may be a near-term overreaction, but they do warn that questions around long-term growth cannot be ignored. They're saying for Indian IT companies to defend growth will require IT companies to move beyond just pricing and delivery, and they have to move up the value chain. So now it's over to the IT companies to adapt. On valuations, they say the large caps are trading at 16, 21 times earnings, which is below historical averages. And even the valuations imply terminal free cash flow growth of just 4 to 6%. That said, so valuations are attractive, but they're still saying that there is a question mark on what the long-term growth will be. For UBS, in the near term, they see a gradually improving environment supported by macro tailwinds and rising AI readiness spending. Nomura, on the other hand, calls the current correction a front-loading of pain, where markets are pricing in the death of the old business models even before AI-led gains emerge. Valuations are now below the long-term average, and they believe the current dividend yield, free cash flow, could create a near-term floor. They're giving you 3 scenarios. Scenario number 1 is a very low growth environment where IT companies grow by 2 to 3%, maybe even no growth or negative. At that point, PE valuation multiples slip to 10 to 12x, which means massive derating if the IT companies grow at 2 to 3% or below. The second scenario is if growth gets back to the long-term averages, which is high single digits, 7, 8%. In that case, valuations stabilize near the early 20s. The bull case is that, these Indian IT companies become AI orchestrators, completely AI ready. And in that case, we're talking about, some PE re-rating. So I think the nutshell is from both UBS and Nomura is valuations are below the long-term average. But what we don't know right now is where the growth will settle for the Indian IT companies. If growth trends down due to disruption, there could be pain ahead. But if growth recovers as Indian IT companies pivot, reset, then perhaps there is value at this level. So that's the view coming through on IT now.
It's very interesting, Rima, and we'll track how they open up once again. Yesterday, of course, about 1/3% higher on the Nifty IT index after the recovery that we saw on Friday from the lows. 2 minutes out, IPCA is what we want to focus on once again. Vinny is here with details. Vinny, morning.
Hi, good morning. So IPCA Labs, in terms of the con call highlights, numbers were okay in line with expectations. But interesting highlights came in the con call, and post that we've seen some upgrades coming in terms of the target price. Firstly, Nuvama is highlighting they're maintaining the buy rating, they've increased the target price, they're delivering strong margins. And they've delivered the strongest margins in almost 4 years. The branded business, that has contributed around 50% during Q3, which is doing well for the company. And that has increased in terms of contribution on a year-on-year basis as well as on a quarter-on-quarter basis. Now, obviously, India business continues to do well. Africa side, Latin side, they've seen strong performance coming in on that front as well, which is supporting the growth for the company. Access Capital also, they said that the business mix is something that improved the profitability for the company. And in terms of the important highlight, Unichem performance, which is there, that is expected to start normalizing in the next 2-3 quarters. And post that, we'll start seeing an improvement in terms of margins over there as well. They anticipate the EBITDA margins for that to come up to 15%, post that as well. So now, companies also evaluating some GLP-1 in-licensing opportunities, and that is why Axis Capital also has raised their EPS target by 1 and 3%. Axis Capital has raised the target price from 1,480 to 1,610, and Nuam also has increased the target price to 1,750.
All right. You got market open coming up anytime now. There we go. And how are we starting? It's absolutely flat, slightly sideways, about 0.25% down, I think. Yeah, 26,615. So it's what, about a 70-80 odd point cut. The Nifty Bank is down about 1/3% right now, 60,760. The mid cap index is down 100, 59,615. Small cap index is coming up on your screen, and there as well. It's flattish, I mean, right? 15 odd points higher, 17,065 at this point. So it's not a bad looking screen at all. And 25,600 is where we are at, about 1/3% down to begin this particular trading session. Heat map should come up in terms of how the 50 stocks are opening up. And then we will look at some individual movers. Asian Paints and BEL on one end, there's Infosys in the green as well. And on the other end, you've got Hindalco, Eternal, Shriram Finance, and a few others. But it's all, I mean, what, 12 odd names which are higher than everything else, which is starting in the red right now. Garima.
Well, the Nifty defense sector is the one which is holding up in the green. That's up nearly 1% today. Remember, geopolitics takes center stage as French President Macron will meet Prime Minister Modi, and where they will discuss defense, technology partnerships. So defense is in the limelight. IT names, as Prashant pointed out, are rebounding a bit. Again, the rebound is meager. The Nifty IT index is up 1/3 percentage point, but Infosys is holding up well, 1% up. HCL Tech seeing buying emerging. TCS is now back in the green. So BEL, some IT names. Asian Paints is moving up well. That's got a gain of nearly 1%. But on the way down, you've got softness coming through in Reliance Industries. That's the heavyweight dragging. Metal names are subdued. Hindalco, Tata Steel under pressure. Hindalco is the top Nifty loser with a cut of 2%. Eternal is sliding, and now it's dipped below the 50-day moving average. Eternal currently at 281, 50-day moving average 283, so sliding below that level. M&M, Trend, Nestle, Shriram Finance, Grasim, Cipla. These are some stocks that you can spot on the way down. But it's a quietish opening. I know we've got a negative bias going. We're down close to about 0.3%, but volumes could be on the lighter side today.
Well, that's right, Rima. You mentioned earlier today, right? There are quite a few markets that were shut, and that's why, in fact, participation could be lower. And we saw that even in yesterday's trading session. Let's run you through a few stocks, though, that are bucking the trend. Kochi Shipyard, they have bagged a naval vessel contract worth 5,000 crores. The street likes it. Up and about in today's trading session. So big move out there. TVS Supply Chain, they are partnered with Italy's Ala Group for aerospace and defense. They're saying it's a big opportunity out there. For now, the street is enthused. That stock is flying away in trade. Texmaco Rail, they are bagged an order worth around 220 crores for the Mumbai Rail Vikas Corp. That stock as well, moving on rather high volumes on the upside. You have a couple of more stocks that are actually moving around. JSW Infra, this will be an interesting one. They have a board meet in the next couple of days. I think there was a bit of a buzz with regard to this, and they're going to be considering a fundraise. So JSW Infra as well is a stock in focus. And Stylim, we saw a large trade that took place earlier today. I think it's part of the broader deal. So Stylim is a stock that comes up for you in this trade. Net, we're a little bit lower. Par for the course, one would say. A good rally yesterday. Participation relatively low. Expiry today. That's what will add some spice towards the end of the trading session.
Absolutely. And it's what is slightly sideways right now, right? 80 odd points, 25,600. And you've got the Nifty Bank, which is sideways and slightly lower as well. Gautam Shah is with us. He's founder, Goldilocks Global Research. Gautam, good morning. Great to have you back on the program. Thanks very much. So looks like we're once again in the range, a little higher, a little lower, but eventually by the end of it, point to point, not very much to show for it. What's the top-down view, and then we'll get into it in terms of sectors, and IT is something we want to talk about. But the top-down Nifty, Bank Nifty view.
Good morning, Prashant. Yes, it's been 5 months that the markets have really gone nowhere. You know, it's been oscillating between greed and fear. Every time we move to levels of 26,000 and beyond, there is a feeling that we will do well and we will break out and we move in sync with the rest of the world, but it just doesn't happen. And every time there has been a dip, including the budget day, I think the markets have found support at lower levels. So I think it's just been oscillating in a very large range, and in the global context, this is really underperformance, because while in absolute terms the markets would not have seen much weakness, but in relative terms, India continues to underperform the rest of the world, whether it's Asia, whether it's US or large parts of Europe. There is still nothing very exciting on the charts, because the problem is there is no leadership. The technology index is in a big mess. Reliance refuses to contribute, and there is too much responsibility on the banking sector, and many of the other sectors like capital goods or auto or pharma, haven't gone anywhere in the recent past. So in this environment, and with the Trump card already being used by the bulls, some time back, it's very difficult to believe that the Nifty can break out immediately. So I think we will meander in a range for some more time. 25, 450, I think, is the immediate support. If you break that on a closing basis, there could be more near-term weakness, possibly towards the budget day low, and only if we get past levels of 26,000 are we going to see strength. So in a nutshell, I think it's going to still be a range-bound market with a very volatile and possibly a bearish bias. However, this is still a very theme-specific and stock-specific market, and I do believe for the rest of the year, the broader markets will do much better than the large caps in the top 100.
Good. Gautam, you've at Goldilocks Research, you've consistently maintained a bearish view on the IT sector. And you've tweeted that that stance is now validated. But after this kind of a fall, technically, where is the Nifty IT index or individual stocks headed? What is the call now?
Yes, Seema, I think 6 or 8 months back, we saw the first glimpses on the charts where we believed that AI is here to disrupt a lot of what is happening in the country with companies, and that seems to have been validated by the markets with the kind of fall the IT index has seen. It amazes me that an index which was at 40,000 comes down to 30,000 in a matter of 8 days. So there is just no time to react. There is no time to think. Markets do what they have to, and they're doing it very quickly. I do believe that the IT space is in a multi-quarter kind of an underperformance, and this is going to continue. We are still not recommending any sort of bottom fishing. 31,000 is an important support for that index, because it's been the low for the last couple of years. And if that were to break, I think you're going to see much more downside. So I still don't see any positives for that index. For that matter, if you look at global tech, it continues to do quite well, whether it's some of the tech stocks in China, in US, and for that matter, even in Europe. But Indian tech, for some reason, hasn't fared. And I think this underperformance is going to continue.
All right. Hi, Gautam. Good to see you again. You believe the underperformance could continue on that one. What about gold? Has it paused for breath? Or do you think, it's looking a little bit weakish? It could pull back a little bit more?
I think it's paused. I think it did what it had to. We witnessed a beautiful blowout rally at the highs, and thereafter we saw a very large correction for silver. Gold saw a more normal correction. I think the bullish momentum has been broken. It was a very, very overdone. Retail had got into it, not just local but global retail, and I think it was being extrapolated as the next big thing. And when you come to that stage, you just know that all the positives are in the price. So I think gold and silver will get into a volatile phase of consolidation. They will not go up much. I think levels of 46, 4700 will now act as a base, and levels of 51, 5200 will act as a ceiling. And silver also, I think it's just going to stay in that band of 65 to 95. So I don't see any big opportunity for gold and silver, but there is a huge opportunity in global equities as a basket, because there you are seeing massive trends in the last 6 months.
Yeah, no, I mean, the biggest gainer right now, just to go back and turn our attention to what's happening, apart from what we mentioned, is Cochin Shipyard. Cochin Shipyard is up 6% on very outsized volumes right now. So number one volume-led gainer on the NSE, that's Cochin. There is K Fintech, which is having another good day. K Fintech went up sharply. So from 950 to 1050 between yesterday and today. Texmaco Rail is another one, right? I mean, I think 8.5% is coming up with large volumes for this point in the day. Praj Industries is another one, about 7.5% gains. Go Digit Insurance is up about 4%. You got Shakti Pumps, which has been absolutely pummeled. It's at about 576. It's up about 2% with volumes, but that's it. I mean, go down the list, volumes start to thin out very quickly. if I look at the gainers kind of screen. Vedanta is down 2%. And Vedanta, with that 2% cut, is also the number one volume-led loser on the index. Eternal is down about 2.25%. There is Hindalco, Hindustan Copper. Ola is down another 3% right now at about 27, 28 odd rupees. So just sort of, with 5 minutes into market opening, taking a look at where there is where this is showing. Gautam, the other, I mean, at least in terms of news flow, etc., right, which I think many have pointed out, a secular kind of theme, etc., is defense. I mean, you can make all kinds of fundamental arguments for it. But stocks got re-rated in a big way because of all the ordering over the last 3 years. Now, I think next 2-3 years, it's all about execution because the orders are in. And stocks have reflected that. Well, how do you think about playing this one? Or you think they're also the big opportunities, maybe some of the global players? And just talk to us about that, Gautam.
Well, Prashant, I think markets discount orders and not execution. I think markets are way ahead and these days too smart, and probably most of the positive and the news flow around the orders are already priced in. Many of these stocks are trading at very, very expensive valuations. So honestly, I don't see an opportunity in defense or railway, and I've maintained that stance for almost 6 months. Barring a couple of stocks that have done well, like a BEL, I really don't see many other opportunities. But the real opportunity in my book is the entire PSU space. And I think I've highlighted this couple of times in our earlier interaction as well. The market loves value. The market is looking at value. And you've seen what stocks like SBI and some of the other PSU names have done well. So whether it's oil PSU, metals PSU, coal PSU, infra PSUs, I think this entire basket looks very interesting for me. And I think while the Nifty goes through this very challenging phase of underperformance, I think money is going to be made in PSU, and smart money and domestic liquidity that seems to be coming in on a daily basis is going to hide in that pocket. It's probably one of the safer pockets in the market. So in my book, it's just financials, PSU and metals. I think these are the three themes that we like, and we feel that one should only commit on the long side in these three sectors.
PSUs, metals, and which one, Gautam?
Financials, metals, and PSU.
Financials, metals, and PSUs. PSUs and metals, of course. I mean, PSUs especially big outperformance last year, and I think this is PSU financials, ex-financials, everything, right? The CPSE's basket.
Absolutely. I think the entire space, I see a very large move. I wouldn't be surprised if the PSU index appreciates by about 25% from here in an environment where Nifty is going to find to even deliver 5 to 7%. So I think that's huge underperformance if you can align yourself and if our view turns out to be true.
And the best way to capture that is what, CPSE ETF or something, or some stocks out of that basket. And anything you like, you want to point out, Gautam?
Well, passively, I think CPSE ETF or similar ETFs are obviously the best opportunity because I am told that the PSU index has about 20 stocks. It's not a very large set of stocks that you're really betting on. And if you can just focus on those 20, and if you can get a quality outperformance out of, say, 7 or 8 out of them, and many of these stocks are at a dividend yield of 6, 7, 8%, and now capital appreciation seems to be kicking in. And we've seen a lot of initiatives by the government from the PSU space, and the charts are beautifully aligned, and you're also seeing a lot of relative strength, versus all other sectors in the market. So it looks like a happy place to be in.
All right, Gautam, let's talk about a couple of stocks. Then SBI. If I remember correctly, we had a chat earlier, and you said that this is one of your top bets. You can correct me on that one, actually. But if ballpark the stock was around 1,000, 1,020 or thereabouts, it's given a quick fire of 15%. Good for more, or has it run its course?
I made this comment, I think it was on your channel sometime back, that I prefer a 10-11 PE banking company than a 60 PE paint company. And I think that's really been validated by the market in the last 6 months. And honestly, you didn't need to be really smart or use rocket science tools to understand this beautiful trend that has played out. SBI has been a favorite, no recommendation. And I think we continue to like it as a story because I think it is still very, very cheap on an overall basis. I speak as a fundamental analyst and also as a technical analyst, because both of it is aligned quite well. If you look at the PSU index, the PSU banking index, if I'm not wrong, a few days back, it was at lifetime highs. And I think there is clearly more to come. So be where there is relative strength. You don't need to buy something cheap, because cheap is getting cheaper and cheaper and cheaper in today's market. And that's a dangerous place to be in.
Any view on the big boys? HDFC Bank showing signs of coming back to life, gone through a bit of a time-wise correction. The other burger is Reliance Industries. I'm just asking you because these are like indices by themselves, with 8 to 10% weightage on the index. So view on particularly HDFC Bank as well as Reliance Industries.
Unfortunately, there's nothing positive coming on out of both the charts. They have been consolidating and they've been trying to come out of a range for almost 5 months now. And I guess the FI selling that has been happening, consistently will obviously, attract money into some of these stocks in the top 10 or 15 stocks. So in that sense, I think the Nifty looks it's difficult for the Nifty to really break out on the upside. And because of domestic liquidity and the global market strength, the markets might find it difficult to break down as well. So I think the best thing that can happen for Indian markets is they stay in a range, it become a stock pickers market, be in the right pockets, and that's where value will be created.
Okay, got it. Thanks a lot, Gautam, for joining in. So the broad point is the headline index stays in a bit of a range. The broader markets could outperform. There'll be opportunities coming in, particularly from PSUs as well as the metal index. And in fact, select stocks look good. And SBI was a stock I think we spoke about last time around. That's had a beautiful, beautiful move, that we've seen. So, that's about Gautam's view. But let's talk about Ola. Can't keep the stock out of action. Sudarshan has joined in to tell us about how the numbers are looking and what our brokerage is making as well. Sud.
So as we were talking about yesterday, that the company had reported Q3 FY26 earnings, and those earnings were very weak, and stock was under pressure. Yesterday also it had fallen almost 7%. Today also stock opened with a cut of almost 3%. And in the last 2 months, say in 2026, so far the stock is down more than 20%. It's at a record low. Now, if you talk about yesterday's volume was 8.5 crore versus 10-day average of around 4 crore. And brokerage downgrades continue. Today, Citi has come out with a note, has downgraded the stock to sell from buy, and target is cut to 27 rupees from 55 rupees per share. Lowest target price on the street is rupees 20 per share. So further downtick we can see in the stock price, and considering the weakness that we have been seeing in the earnings for the last few quarters. What is Citi saying? EV penetration in Indian two-wheeler sector has been sluggish. Company has lost market share. As of January 2026, company's market share was less than 6% versus 25% that company held in the early 2025, say in January of 2025. Citi is saying management's efforts to improve product and service quality could take some time to fructify, but healthy gross margin trends and better operating leverage could boost EBITDA. But negative cash flow, that is, as of 9-month FY26, free cash flow was in negative of 1,530 crore rupees. That could result in the concerns related to the balance sheet. It has cut estimates and target EV to sales multiple to 3.5 times versus 4.5 times. Now, at the start of FY26, after basically Q1 earnings, company had given the guidance for FY26. Now, let's see where exactly company stands after 9-month FY26. So, on the auto business EBITDA margin, company had said that in FY26, that margin may increase and may be above 5%. As of 9-month FY26, that is at minus 6.4%. On gross margin, the range was 35 to 40% for FY26. Currently, it stands at 29.6%. Volume target was in the range of 3.25 to 3.75 lakh units. So far in FY26, they have done just 1.5 lakh units. Revenue target was in the range of 4,200 to 4,700 crore. And as of 9-month FY26, or say FY26 so far, they have done just rupees 2,000 crore. So it's reflecting the weakness that we have been seeing in the earnings, and that's reflecting in the stock price.
Thank you very much. Very helpful. And some details starting to come through, right, with regards to Infosys and the Analyst Day. So Infosys has announced a collaboration with Anthropic to unlock AI value across complex and regulated industries. So that's the news which is coming through. Look at the stock. It's up about 2.5%. And I'll just quickly look at where I think it's climbed now. I mean, I think as the news came through, 9:28 or so. Yeah, I mean, this move is basically not even last 5 minutes. Last 4-5 minutes or so. The stock's climbed steeply. You're not able to see that. But yeah, it's all since that news broke, I guess. Almost 3% higher on Infosys at this stage. So 1404, 1405 on Infi. and this collaboration with Anthropic to unlock AI value across complex and regulated industries. So more on this one in terms of what this would mean, etc. I guess at the Investor Analyst Day and beyond that as well.
Just one quick word on the index. You know, the tech index on Friday made a panic low of around 31,350. It's up 2,000 points since then because of the oversold levels, because of some kind of glimmer of good news, case in point being the announcement that's on the screen. And also the index is heavily shorted. You know, it fell one way down. So let's see whether or not it can sustain this. But otherwise, the last few days for those that, you know, were gutsy enough to buy it on Friday, it's up 2,000 points.
You know, there's, of course, I mean, all kinds of players making the market, Nigel. But on Friday, as you said, on Monday as well, there were some insurance companies who were buyers. And I think yesterday as well, Monday as well, there were some insurance companies. But of course, I mean, there would be other players who perhaps could have. And of course, a covering element as well. So 2.75% on that Anthropic news and Infosys. Now, the India AI Impact Summit 2026 is underway in Delhi. And Ashmit joins in with more on, I mean, you know, what we should expect. Ashmit, good morning.
Hi, good morning, Prashant. I'm joining to you from what is the nerve center of the AI Impact Summit. That's the CNBC TV18 Edge studio from right here at the Expo. We have been covering, we saw day one as well. It was a little chaotic, but that was what the minister, in fact, the secretary government officials have been calling was a roaring beginning. What we saw was basically a whole host of leaders descending upon the national capital. Again, the big numbers, what they're telling us, they're expecting over 2.5 lakh attendees. Big faces expected, the likes of Sam Altman, Jensen Huang unfortunately could not make it. Sundar Pichai would be here, Demis Hassabis, Dario Amodai. They will be all here as a part of the conversations at the AI Impact Summit. What's also important to watch out for is the nature of what those conversations are. One aspect that, in fact, we have been talking about in great detail has been what this dynamic is between AI, between automation, and what that means for white-collar jobs, what that means for the IT sector. That's clearly going to be front and center. Another aspect that will be front and center will be the nature of investments that we can expect. This is not an investment summit, so that is not the focus, but nonetheless, what officials tell us is that there's likely to be announcements with respect to investment commitments going forward. Mind you, the likes of Amazon, Google, Microsoft have already committed to over $70 billion for the AI ecosystem here in the country. Another aspect that will be up for conversations, and this will be a big step up as far as India is concerned, will be launching of India's own sovereign models. Now, that has been a key focus area for the India AI mission, the 10,000 crore rupee outlay that we've seen over the last year or so. What's important is that there will be Sarvam, the Indian AI company, will be releasing its 100 billion plus parameter sovereign Indian LLM. That is not the only one. Companies like Gnani AI, which have been in fact picked under the India AI mission, will also be releasing their sovereign models. And this, importantly, was a key thrust area for the government. In an era of tech sovereignty, there was a big thrust by the Indian government on ensuring that India has its own language models. India has its own architecture where it can compete with the best in the world. And to that end, we will be seeing those announcements as well. As to the other themes, we've visited pavilions. The likes of Geo Pavilion is here. We went to the OpenAI Pavilion. We went to the Microsoft Pavilion as well. A whole host of robotics are on display. We'll, of course, be getting you a sneak peek as to what this marriage between AI and robotics look like. That will be a key area that will make some very interesting content in terms of what the future holds with respect to what some of these companies are manifesting, are displaying here at the AI Impact Summit. So clearly, a whole lot of content, a whole lot of conversations to unpack here from the AI Impact Summit. And of course, we'll be getting you all of that and a lot more from the CNBC TV18 Edge AI studio, right at the heart, at the nerve center of the AI Impact Summit.
Indeed, conversations there will continue. Thank you very much, Ashmit, for getting us a ground report for now. In fact, it's a cue to invite an IT company. Joseph Anantaraju, co-chairman, CEO of Happiest Minds Technologies, now joining in. Thank you very much for joining in. Joseph, I think the question that people are asking now with the rise of agentic AI is that, one, are clients pausing large transformation deals because they're reassessing the strategy? And two, there is a change in the way clients are negotiating pricing. They're asking for more in terms of efficiency and productivity. If you could share what is happening with Happiest Minds and your clients on these two fronts.
Sure, Prima. Let me first take on the agentic AI. If you look at agentic AI, I think you can apply it in 2-3 ways, right? If you're an end customer, the first is you look at your own workflows and how do you really embed, an agentic AI approach into your workflows, and that needs a little bit of re-architecture, re-looking at how your applications are designed, and how the data is collected. And so we're seeing, some of the customers going down this path. The second one is looking at your internal operations and seeing how is there some way to optimize customer service or help desk and other things using an agentic AI approach. And and the third one is using it in SDLC. And here we are seeing two different trends, right? If you look at more of greenfield development or add-on development, it takes a little bit more, I would say, effort to really use this approach. But if you're looking at modernization or addressing tech debt, where there's a code base already that that your AI can understand and then apply, there we are seeing customers beginning to look at the opportunities that this presents. So I think Agentic AI actually is making customers take a step back and look at, can we do things differently? Can we do things more? And can we do new things? And that's what we are seeing, And when you come to pricing, if you look at, AI and productivity tools, if you look at it from a broad construct of three models, right, that the Indian IT industry uses. One is more of people-based, whether it's external engineering or staffing or whatever you call it. Second is fixed price, and third is outcome-based, which is still on the lower side, but I think we need to move in that direction. I'll come to it in a minute. But if you look at it from a people-based, there's a rate that you get, and there's no impact from a pricing perspective. What you can do is go back to customers and say that, hey, we have these AI-trained engineers, whether it's Cursor or Agentic AI or Copilot approach, and look at getting a little bit of premium, and we're beginning to see that. Second is on fixed
Joseph,
price.
if I can, sorry, there's a lot to take in. If you can break it up a little bit. Good morning, and thanks for joining us.
Yeah.
I just wanted to, and we'll come to some of what you're saying, and very useful. This specific point, I just news breaking that Infosys is tying up with Anthropic. You must have seen just 15 minutes back, the news broke. Now, what would it really mean? Is it an official acknowledgement of what is already happening across companies? Because the release itself says that they already, the founder of Anthropic is in the press release saying Infosys is already using this. So this is a formalization of that tie-up? And would this also, what would this entail? Some revenue, are there any revenue implications in terms of revenue sharing of some sort? Or this is a cost out to Anthropic for them to use? But that was already happening, right? Because it's Infosys would be paying Anthropic to use Claude and other things. So what? And will we see more of this, more of these announcements by IT companies quickly?
Yes, I would think so. Because Anthropic is just one of the options that you have, Claude. And in a short while, you'll see an announcement from Happiest Minds as well, where we'll be leveraging Agentic AI platform for helping our customers. But end of the day, if it's, let's say, a Claude or some other agent, it's as good as having a developer. And what companies like Happiest Minds and other IT service companies will have to do is to construct a hybrid model, leveraging the coding agents and your physical agents, physical developers working together. At the next level is some of the abilities that
Sorry, Joseph, coming in again. You're saying in a short bit we will see an official announcement with regards to an AI partnership at Happiest Minds?
Happiest Minds, that's right, yeah.
And this is a partnership, right? So we just want to be careful as we put it out.
Something similar to Anthropic, but it's a platform, an AI platform that we would be leveraging to deliver services to our customers.
Okay. No, the Infosys bid, right? Are these tie-ups consequential? My question is it formalization of the agreement already, or this would entail, as I asked you, I mean, would this be revenue sharing? I mean, what would this mean really?
I mean, how Infosys has structured it, I'm not sure.
Because you're also structuring something similar. So I'm just saying, is this an acknowledgement of what's already happening or something else?
I think it's an acknowledgement of what's happening, and I would say that it will be, the path that we would be going down wouldn't be revenue sharing, but I would be, we would be open to that as well if the upside and the opportunity that we get is more. I think all of us have to be very agile and make sure that we make adjustments and to our execution and commercial model depending on how the technology evolves, partners evolve, and what customers ask for. And that's what we want to do. And if you look at the tagline that we have, AI first, agility always, that's what reflects it. Because I think AI is the way forward, and you need to be very agile in terms of how you operate, how you construct your commercial models.
Joseph, these would not be exclusive.
Joseph, just one thing. You said we would be willing to go down that road in terms of revenue sharing as well. That's what you said?
We would be willing to go down revenue sharing as well as to outcome-based models with our customers if the construct makes sense.
Okay, if the construct makes sense. Got that.
Absolutely.
Got that. And that's an interesting...
To be very agile. That's what we are very clear about internally.
The partnership that you're announcing now today is outcome-based or revenue sharing?
Not today. We're not announcing today. We're going to announce shortly is what I said.
Shortly.
Yeah.
Got that.
And yeah.
And these would not be exclusive partnerships with... These would not be exclusive partnerships. Over the course of the year, do you think you will be... Because it's out... Go ahead. Yeah.
No, you cannot have exclusive partnerships, Rima, because the technology and the underlying models are evolving and changing so rapidly. I think you need to have flexibility and leeway in how you operate. You can always have preferred partners. I think that is desirable as well, but that should also be based on a little bit of planning and having some visibility into your markets, into your GTM, and into your capabilities.
Okay.
Hi, Joseph. I think my colleagues have gone on a fair bit and understood a fair bit with regard to the AI talk. Another question that shareholders are asking is, what is the promoter entity's intent? I think you saw that coming. The promoter holds a little more than 40% in the company, and various reports suggest that he's looking to sell either full or part of that stake. In your discussions with him, is that a possibility, or do you want to completely rule it out and deny these rumors?
So, that is a question for Ashok to answer. But, whatever discussions we've had internally does not come up. As you know, sometime back, Ashok did divest a little bit of his stake for Happiest Health. But, the AI First initiative that we announced, Ashok reached out in spite of, the new structure that we put in place. He's very excited about the potential of AI and the impact it can have on the company. So Ashok will be leading our AI First initiative, which is a 3 to 5 year strategy that we had put together. We had advertorials and shared a lot in the press conference that we had just last week. And so Ashok's going to lead that initiative. So he's very committed to Happiest Minds and to the growth. And so he'll be driving this initiative. One of the reasons was, I have enough on my plate, the 10 transformations that we had announced. So Ashok felt that if he could help with this initiative, it could really bring various parts of the company together.
Joseph, I mean, I got the strategy and, the part that Mr. Ashok wants to play. But his holding has come down, from around 53% to around 44%. Do you think he'll be open to, pulling down stake a little bit more, continue to be involved with the company, but maybe, in fact, selling a majority stake?
See, that is a question for Ashok, actually, but in our discussions, that's not something that has come up. And what I'm encouraged by is, the fact that he's willing to take up something like this as a ownership and something that he's committed to the board to drive through for the next 3 to 5 years. And that shows the commitment that he has to the company.
Yeah. Joseph, sorry, just one last question.
Sure.
Apologies on this. You know, you said this revenue sharing versus outcome-based revenue models. You're open to both. Do you think the future across IT services companies is outcome-based models? And if it is outcome-based models, is that not a big shift away from how companies charge customers right now?
So, I would love to have that, but in the past, whenever we've got into outcome-based models, and we've done this 4 or 5 times, I think when the customers, when they start off discussion on outcome-based, they're quite excited. And then it also means that customers have to relinquish control over what happens and, hand over things to their partner. And very often customers are not comfortable. I think in the AI era, where there's a fair bit of productivity and other gains to be made, I think as a IT service company, I would like to shift, or we would like to shift some of our revenues at least into outcome based, so that we can partake of the upside from the productivity enhancements that we get from AI.
I would thought, sorry, I'm reducing everything to a binary, but that's only because of lack of time, and we can have a longer chat. But I thought it's net negative if you move to outcome-based pricing. Am I wrong?
No, I don't think so. Because when you get into outcome-based, you can price in the productivity enhancements and whatever value you bring to the table into your pricing model. Again, it'll have to be done. You can't do it across the board, but you can do it, where it makes sense for both parties. And I feel it's an opportunity to actually partake of the upside that you get from some of the gains that we're getting from AI.
Got it. Thank you very much, Joseph. Appreciate you joining us, and really, a good conversation, and we can probably do more of these as we kind of sort of work our way through all what is happening with everything which is going on around AI. Thank you. We'll take a quick commercial break here. Tenneco management on the other side. It's a recent listing. Stay tuned. Coming up.
Welcome back. As promised, let's get straight to the management of Tenneco Clean Air. It reported actually a healthy set of earnings in the past quarter that was driven by advanced ride technologies. And after the recent trade deals, the management also expects their export growth to accelerate with lower tariffs. To discuss this and more, we're joined by Arvind Chandra, the CEO of Tenneco India. Hi, Arvind. Good morning. Always good to see you win. A quick couple of questions, for the year and now. The recent big headline for the nation on the whole was that we got into a deal with the United States, and we have also signed, an FTA agreement with the EU. How big is it in terms of a potential for you? Exports are still smaller as a percentage of the mix, but how do you view both these two in terms of how you can compete? Please go ahead.
Yeah. First of all, very nice to see you, Nigel. Hi, Rima. Hi, Prashant. Very nice to be here. Very good question to start off with. Our exports have been historically kind of low as a percentage of sales. We've only been 5% of sales exports, as historically speaking. Our order book right now is coming in at 20% of the total order book, which is fantastic news. Now, this is before these new announcements. So this new Indo-US trade deal, which reduces tariffs from 50 to even lower than 25, now 18%, is going to make us more and more competitive, right? So India already has the labor cost arbitrage. Again, our factories are cutting edge, state of the art. So along with the labor cost arbitrage, we think that our order book will only grow from an export standpoint, will be more competitive. So we welcome this. I think this is good for us, good for India. Okay. And we're obviously standing on top of the India situation with the auto sector. So we're very, very excited.
Arvind, just to get those numbers correct, as a percentage of revenue, it's around 5%, and a percentage of your order book, it's around 20%.
Recently, the last several months have seen very high order book from an export standpoint. And when I say exports, by the way, it's not just Tenneco India exporting to third-party OEMs. It's also Tenneco India exporting back to Tenneco Europe and Tenneco US. Because we have labor cost arbitrage, and also many OEM customers are also demanding that India become the export hub for the company. So we're enjoying the benefits of both.
Yeah, that's what would be my next question, whether or not the Indian listed company can actually be the hub for exporting to markets like the United States as well as the European Union. And you've answered that. So we got that out of the way. Since you mentioned order book, could you quantify what is the current order book? You won a couple of orders, as I see on the exchanges. Quantify it. What is it right now?
So look, we decided that we would publish order book every 6 months, just to kind of be able to collect all these various order book, because there's tens of wins, right? So we will publish our year-end order book after the end of the financial year. So I would ask you to ask me this question in about 2 or 3 months. But suffice to say, in Q2 for the first half of the year, we had 9840 INR million of order book, which is great. And with the current order book, the way things are going, our 2028 revenues have already been order booked to 100% level, which means it gives us a very clear sight of a nice double-digit CAGR revenue growth, which means we will easily outperform the market by somewhere 9 to 10%.
Okay, so Arvind, 100% revenue visibility through FY28, which positions the company for a double-digit revenue growth. Hi, good to see you. What about margins? You've expanded your margins. Your 9-month margins are now closer to 17.5%. What led to that? And can 17-18% be the new normal for margins?
Right. Very good question. So look, Tenneco is a very, very different company. We believe that our culture is our sustaining competitive advantage. And our culture is so strong, right? We talk about the Tenneco mindset, the Tenneco values, our P3 operating system, which is a very unique model where you have, as you and I are talking today, there are people in our factories that are labeled as continuous improvement people. And their only job is to keep looking for ideas to cut costs, right? Across the entire P&L. And I'm talking about raw material conversion cost, fixed costs, customer negotiation, indirect material, you name it. So this culture over the last 3 years, if you remember during the red herring prospectus filing for the IPO, we said that we were able to improve from FY23 to 25 by almost 400 basis points, right? So our EBITDA improved by 400 basis points. And that continues, by the way. So as we're booking nicely, right? Our order book is coming up nicely. We've got a nice sight, double-digit CAGR growth. There are people in our factories that are constantly looking to attack costs, right? And therefore, we believe that our EBITDAs will not only be sustainable, they will grow. One is because you're getting better absorption from the top line into the bottom line. But the second thing is part of our, what we call the P3, the People Pride Performance Operating Model.
Margins expand from here on.
Absolutely. Well, expand in a gradual way. We want to make sure that also, that also, and again, our cash conversion is very good. So as the margin expands, we think that
we have a number, Arvind, say by FY28, which is, because you have a double-digit revenue growth visibility till then. Where can margins head?
Well, we aren't allowed to talk about our future margins, but I think suffice to say, they'll be sustained and they will likely grow in the future because, again, organic, and we haven't talked about inorganic yet, but I think they'll be sustained and they will grow from this point on.
So you have inorganic on your mind as well. Could you give us an insight into what could the potential acquisition look at? Which geography could it be at? Arvind, I think we're allowed to ask you that. You told us order book in the next 6 months. We're going by that. Next interview, we'll ask you about that. But give us a sneak peek into this inorganic growth plan. How large could the target be? Because you'll be looking at quite a few. And which geography? Will it be in India? Will it be overseas?
So we've always said that, when you asked me the question some months ago, why are you doing the IPO, right? So this IPO gives us currency to be able to tap into capital markets or either a primary or even tap into debt market. So I think now that we've had a very successful record IPO 2 months ago, we think now we are ready to explore inorganic options as well. And again, there are different ways of looking at it. It could be something in our domain, in the world of clean air, exhaust systems, ignition, powertrain, as well as suspension systems. So we would be basically taking the technology roadmap and furthering and looking for the evolution, the next evolution of that technology, right? So that was one kind of acquisition. The second one was like a customer pain area type acquisition where the customer themselves come to us and say, you ought to take a look at this company. But basically what we're looking for is niche areas, niche segments that are sort of powertrain agnostic, so that we don't want to be either ICE or EV. We want to be agnostic to any kinds of automotive powertrain, but also we're looking at industrial. So commercial truck, off-highway, industrial, these three are areas that we would be looking at for potential acquisitions. Okay. And again, these acquisitions can also be, one is third party, just outright buying a third party company, but it could also be acquiring assets of our own let's say sister divisions, which are either underperforming, where we can bring it to India and export back to them at a equal or better margin than where we are. So I think the margin has to be accretive. We're not going to accept anything that will dilute their margin.
Oh, that's good. Good to hear that finishing sentence because, Indian listed company buying from the parent sometimes is a little bit tricky. But as you're saying, it should be margin, it should mean that it makes sense for the Indian listed entity. So I'll take that point on board. Arvind, two big takeaways for me. The visibility is there till FY28, and that's why you're going with good growth. And India could potentially be the export hub as well. Thanks a lot, Arvind, for joining in. From your IPO price, the stock is up close to 40%. So additional responsibility on you guys delivering those numbers. Let's get in Chandan Taparia, though, who joins us on the show. Hi, Chandan. If you bought the morning dip, you would be happy. Markets almost moved into the green. What's your view in terms of levels we're looking at on the Nifty? And fill us in with your picks.
Yeah, good morning, Nigel. Thanks for having me. Yes, we are suggesting to buy the morning dip. In fact, we have the view that market has formed the short-term bottom near to 25,350 to 25,400. If I look at the daily and the weekly chart, multiple times this level has respected and has provided the cushion to the market. So I believe that 25,400 could act as a major support. And with this support, index has potential to see the momentum towards 25,850 to 26,000. Talking about Bank Nifty index, we have seen a massive run-up on the last trading session. Higher base is clearly visible. Till it holds about 60,250. Bank Nifty has potential to head towards its all-time high of 61,500 to 61,750 kind of level. So buy on decline in both the indices with the view that consolidation seems to be getting over and fresh leg of rally can be seen in indices from here onwards.
Stocks, Chandan?
Yeah, so talking about the stock specific idea, first is buy on Lupin, one of the counter which has been consolidating and now has given a consolidation breakout on the daily and the weekly chart. We have seen put writing activity and data setup is quite positive as consolidation breakout of 28-29 days is visible with decisive hold about 2200, 2240. So one can buy with support of 2220 for an upside target towards 2350 level. Second trading idea, that is buy on Union Bank. We have positive view on most of the PSU Bank. However, SBI is our preferred one, which already rallied well. But now for a fresh breakout, recommending to buy on Union Bank. We have seen built up of long position. Sustained put writing is visible. Stock is given a consolidation breakout of last 23 days. So recommending to buy with support of 176. And this PSU counter can head towards 195 kind of level.
Okay, all right. Chandan, good calls and good speaking with you. Talk to you again soon. By the way, you know, the reason why the markets picked up pace from the lows, of course, is IT, right? I mean, I just looked at the Nifty 50 pack. Infosys is adding 32 index points to the Nifty right now. ITC is number 2 with about 17. And then there's a TCS and HCL Tech, which are between them adding another 13 points. So about 45 odd points on the index recovery has come from three IT names this morning. So the index itself is up about 2.25% at this stage. The Nifty flat 20 odd points lower. We'll take a break. Manisha on the other side, commodities in focus. Stay tuned.
Fly Emirates, fly better.
Welcome back. Let's talk commodities now. Manisha is now joining in for more on that. Manisha, what are you looking at today?
Well, I'm looking at EV as a market because we're looking at very strong numbers. The reports for 2025 has started to trickle in finally. And when you look at the overall EV battery metal index, that has surged to a 27-month highs. Everything that comprises of metals that are used in EV, the prices of that, after strong gains in 2025, have continued to gain in 2026 as well. So when you look at the raw material bill, well, that has been surging as well. Only for the month of December, it stood at a tall $2 billion for the first time. That is since 2023. And when you look at the overall 2025 as a market, that is up 13% on an year-on-year basis, gaining almost up to $15.8 billion there. Now, these are the various metals which are used in EV and the raw material itself, and the prices of these have continued to gain up. Lithium, for one, has been an outperformer, up 21% in this year so far. 4 to 5% of gains is what we're looking at in other metals like cobalt and magnesium as well. Nickel prices have gained up by 3% in the meanwhile. If you look at the overall EV global passenger market in 2025, well, that is estimated up by 20% versus 2024 therein. The global passenger EV market is likely to exceed 30 million units in 2025. And within this market, when you look at electric car market, that is expanded by 25% in the previous year. So very strong numbers coming in for this one. Let me remind you that China is a very strong market, on almost 80% of those numbers coming in from China, 12% from Europe, and the rest, of course, in the US, etc. The battery capacity deployment also has been on the stronger side. This is a report from Adamas Employment. Their estimates, they believe that 286 gigawatt is what we were looking at in 2021. 1 trillion is what we've crossed when it comes to 2025 therein. Take a look at the copper prices. That also is a strong EV component and a green energy revolution metal as well. And while we've seen prices decline 1% overnight, it also is down 15% from its record high in the month of January, when we saw 14,500 on LME and $6.5 on COMEX therein. The copper prices and the global exchanges also have continued to see a bit of a decline. But the important number to watch here is that the global exchanges, the stocks therein, is now 1 trillion tons, and this is the highest that we have seen in the last, pardon me, in 21 years. So the combined stock on US, in LME and Shanghai has continued to surge quite strongly there. In the meanwhile, the other market, pardon me, the other thing that you have to watch is the January copper smelting numbers. Those are the lowest in a decade. So what the street is looking at is that the new metal is not coming into the markets, and on the exchanges, warehouses, there is metal lying, which is the highest in last 10 or 15 years. So that is what is keeping the copper prices in the meanwhile in check.
Okay, all right, Manisha, thank you very much for that. That's Commodities in Focus. Time for a quick commercial break here. Well, the much-awaited chat on tariffs and exports with the Vice Chairman of Gokaldas Exports, G. Sivaramakrishnan. Latha will take that conversation forward, coming up in just a bit.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. Traders and investors have been eagerly waiting to hear the one man who knows the impact of the FTAs and tariffs on Indian textiles best. He's my guest today, Mr. Shivaramakrishnan Ganapathy, the Vice Chairman and Managing Director of Gokuldas Exports.
Thank you.
Mr. Shivaramakrishnan, thank you very much indeed for joining us in our studio itself.
Thank you for having me.
The most important voice to hear today. First, give us an idea of how have things cleared for you as far as the US is concerned. Are your buyers queuing back?
I think there's a sigh of relief everywhere. You know, we were, the sort of 50% tariff, the penal tariff of 25% was hanging over our head. And, you know, there were concerns that if it continues for long, you know, people will have to look at alternate sources for buying their products. And, you know, we soldiered on for about 6 months,
Yes.
Made sure that the business was kept within India, despite these steep tariffs. We also had to share the tariff burden with our customers, so that impacted us on our margins. But we were successful in holding them on. There was a belief that eventually this will give way and, you know, the trade will get normalized with tariff getting normalized. So I think that we're seeing early signs of that. We have, you know, most of the brands telling us that now they will again look at stepping up sourcing from India, which is good news. If you look at 2024, there was a survey done of US retailers, apparel retailers, and they said that in 2025, they're looking at India as one of the principal areas to increase sourcing from. So India was very much in the radar, you know, it was top countries to step up sourcing from, and then tariff hit us. So you know, the whole situation went, you know, topsy-turvy.
But has the excitement returned?
It is returning. It is returning, right? It's early days. We've gone down to 25. You know, we should soon go down to 18. And if that happens, I think, and that should happen, I suppose, then we will see the excitement picking up. It is already picking up steam. What has happened is that, you know, most of the orders for Q1 and Q2 of next financial year is almost booked. So effectively, the change will start materializing from Q3 onwards. You know, spring, summer 27 onwards. That's what we'll produce in Q3 of this year.
Was your Q1, Q2 impacted? Because you were doing those negotiations when 50 was on our head. Yes. So, I mean, can you be reasonably sure that this EBITDA of 76.9 crores is gone for good and you will double it in the...
EBITDA will,
in the current quarter itself.
EBITDA will improve, most likely from next quarter. Current quarter, there'll be an improvement, but, you know, it'll improve from next quarter because, you know, half of this quarter is gone with, you know, higher tariff. So that burden share was there. I think next quarter onwards, we should start an improvement. We managed to secure our businesses regardless. So, you know, we have a full order book for Q1, reasonably full order book for Q2, which is still under works, and we should have that. So we managed to keep the business with us, albeit by trading margins. Margins will return back, so EBITDA will grow. And from Q3 onwards, we should start stepping on the accelerator as far as growth is concerned.
Okay. Yeah. Now, in the meanwhile, the good news has come in the form of the EU FTA, which we didn't expect so quickly. Okay. So what inroads have you made there? And therefore, can you give us a composite growth rate in both revenue and EBITDA for FY27?
So
first Europe.
Yeah, first Europe. So I think you know, we've been making reasonable inroads into EU. We've been talking to a lot of customers in EU. We were talking in the meanwhile last year, and as we speak, we are onboarding a new customer from EU. So that journey is on. We currently have about 16-17% of our revenue from EU, which was 13% last year, and which was 8%, you know, almost
without the EU FTA, you all have...
Because we were looking at diversification, and once this FTA came, that in the last 6-7 months is where bulk of that transition happened. And I think that journey will continue. You know, we will stay diversified. As far as growth is concerned, I think, you know, 27, as I said, you know, the real impact of growth will start kicking in from the second half of 27. So 28 will be the bigger growth. But I am very confident that, you know, if you look at our revenue, 12 to 15% is done deal for 27. Anything more than that, you know, will happen in 28. 28 also will be a 28 over 27 will also be in that ballpark.
Okay.
Yeah.
Now, how big a fly in the ointment is this supposed deal with Bangladesh? We don't know the details, but apparently if they put in a lot of US raw material import into their finished good, they get zero tariff.
Right.
What have you heard, and do you feel the heat on the ground?
See, Bangladesh also has zero tariff from EU, which we don't yet have. But we stood our grounds, right? Of course, Bangladesh is much bigger in terms of exports to EU, but we have our niche, our product capability, etc., which where we don't compete with Bangladesh. Likewise, if I look at US, in the past or till recently, we had a level playing field with Bangladesh, barring that 50% penal tariff. We held on our own because there are certain products, we have fabric ecosystem, especially when it comes to cottons, viscose, etc. We have the fabric ecosystem in India where we can turn things around faster than Bangladesh. So there are product types, categories where we dominate. Now, even if Bangladesh gets, let's say, a more favorable deal than us, we can still hold on our own. And what I understand from the government of India is that they're also trying for a similar deal for India. So if that happens, again, we are back to a level playing field. Okay. So am I particularly worried about Bangladesh? Answer is no. I'm glad that, our own situation has improved, that we can resume our business to US, and that growth journey will continue. It's a very large market, right? So,
and you were telling me before we entered that even now, if you use US cotton or yarn in your finished product,
right,
that much is not tariffed.
That is correct. If you exceed 20% of the FOB value, with US raw material, that component is not tariffed.
Okay.
Yes.
Okay. So in any case, we
have that benefit indeed.
Okay. Well, if you can give us some numbers, I know it's a little unfair since things are in the order stage.
Yes.
What may be the growth next year, and what is the kind? You're expecting much more in 28. Give us some numbers.
As I said, 27, I'm looking at anywhere between 12 and 15% revenue growth, and 28 will be about 15% over 27. Okay. That's the kind of revenue growth we're expecting. We have, in this, I'm not factoring in the textile business. There is a merger intended of BRFL textiles.
Yes.
So that I'm not counting in.
The inorganic you're not counting.
Yeah, that's
okay.
right.
Okay.
That's right.
What is the slightly longer term vision? Because we've got this kind of scare. Mm-hmm. Do you think Indian textiles as a whole are scouting for more markets? I mean, there is a spring in the step, albeit out of fear. So do you think our exports can do much better simply because now we are, we've got a warning?
I think yes, right? So the fact that we've got a warning made us a lot more agile, a lot more cost competitive. We did whatever we had to do in terms of automation, cost reductions, etc. Right? We had to perforce do it, and that also always helps us stay ahead and globally competitive. If we are competitive at 50% tariff, obviously, we're much better when it's lower. So in many ways, it was a blessing in disguise. It was a very painful period, but it did indeed help us. What does it do to us? I think, that spring in the step which you mentioned is there, and we should really capitalize on growth opportunities going forward. The one tiny bit is, should we diversify our country of origin so that, we de-risk ourselves from any future
that was going to be my next question.
That probably we should. We already are in 3 countries, like India and 2 countries in Africa, Kenya and Ethiopia. Maybe we would perhaps look at a little more diversification. That wouldn't mean that we are going to compromise on India growth. India growth will continue. And I think we will be adding quite a few factories in India as well as we speak.
So what are your CapEx plans in terms of amount and geographies?
So next 2 years, I am anticipating our CapEx plan to be about 175 crores or even more, depending on how the business flow happens. We'll take the call dynamically, but it's in that ballpark or higher.
Okay. And inorganic?
Inorganic is always out there, so difficult to comment on it, but we will be open about it, open-minded about it.
Okay, no, for the simple reason that since you're capturing new geographies, would it mean that inorganic will be more simply because you may find a small exporter or manufacturer who has already made inroads into new markets? So I'm just asking if the pace of inorganic
It could. In the next 2 to 3 years, we might be open about looking at some inorganic opportunities, or it could even be, buying a factory rather than buying the whole business. So all options will be explored, but these are very early days.
And finally, a word on the textile sector itself. We did have some tearful stories about people being let off at the height of this 50% scare. Do you think textile as a sector now, revives more? Will jobs increase?
I think so. Okay. I think so. So I think government has done a fantastic job in concluding trade deals with UK, EU, and now normalization with US. I think kudos to the government. Now we should see the impact on textiles. It's a very large job creator, and that momentum will come back. So over the next 3 years, you will see that momentum pick up, creating more jobs as well.
I'm going over time, but any one ask from the government?
I think make sure that, the US tariff stays where it is. You never know, right? I mean, how South Korea got a 10% increase. So if that happens, I think rest, the industry will do for itself.
Will take care of itself. That's a very nice thing to hear from you. And the fact that it is a compounded CAGR of 15% that you are expecting for Gokuldas itself. Yes. Pleasure having you with us in the studio. Yes. Well, that's it on this very pleasant edition of It's the Economy. We wrap up on Bazaar. Chartbusters is coming up.
IT stocks, they're the top sectoral gainers. Ahead of its Investor Day, Infosys announces a collaboration with Anthropic to develop advanced enterprise AI solutions. Happiest Mind also hints at an AI partnership announcement soon, and stocks across the sector surge.
Couple of counters are buzz on account of order wins. Kochi Shipyard emerges as the lowest bidder for a 5,000 crore Navy contract. Texmaco Rail lands an order worth 220 crores to design, supply and install signaling equipment.
Shares of KFinTech perk up on brokerage upgrades for the second trade session. The stock's doing well. Jefferies has upgraded the stock to buy with a target price of 1,300 rupees. Additionally, after the resignation of the earlier CTO, the company has appointed Nazish Hussain as the new Chief Technical Officer.
Shares of Ola Electric struggle to find a bottom. Stock scales fresh 52-week low and has plunged 20% in the last 2 months. The pain mounts as brokerage continues to downgrade the stock. Citi downgrades to a sell from a buy, slashing the target price to 27 rupees per share versus 55 rupees earlier.
And among stocks which are gaining, we have TVS Supply Chains up 3% after an MOU with an Italy-based company to enter India's $28 billion aerospace and defense supply chain markets. And the stock higher today.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. All the indices that you can see on the screen is green. So textbook play really. Yesterday we saw the buying from the lower levels got rewarded, and today as well seems to be the same case as playing out, Manglam. And the tech index, that's finding its form. That's the one that's been pulling us back. But today that's up, I think, close to around 1% or thereabouts. So 31,300 has become 33,300 on the tech index. I mean, at least you're feeling a little bit better with regard to this space.
After a 15-16% downtick, you know, the street would have liked for some bottom to find itself. But let's see whether this sustains or not. Sustaining this move would be extremely crucial. Right now, there is a fair amount of excitement around the AI summits and all these announcements that are coming in. Infosys would be the key stock to watch today as its analyst day is underway today as well. Just a couple of other sectors as well, Nigel. You know, the Nifty Bank, which had been outperforming for a while, yesterday as well did a little better. Today was underperforming for the start of trade, and that too has shown a sharp surge, up around 1/3%. Yes, not as much as the IT index, but that recovery has got the momentum back in the market. So you have two heavyweights. We have Nifty Bank as well as the IT index, both of them doing well. And the Nifty Bank actually is led by the PSU Bank index. So if you pull up the PSU Bank index, there's a big surge that you're seeing. And even at the bottom of your screen, the ticker team's telling you, you know, a big surge in Punjab National Bank, IDBI Bank, Canara Bank. You have it, you know, any stock that you look at, Bank of Maharashtra as well, has seen a big surge. So a lot of these individual stocks buzzing around and the market on the whole doing well. Let's see, after crossing the 20-day moving average yesterday, whether the Nifty crosses the 50-day moving average, which is placed at around 25,765. Let's welcome Saumil Mehta of Mirae Asset Share Khan for a quick technical check on the market. Saumil, yesterday we recovered from the lows. Today we recovered from the lows as well. Do you think we have enough to build onto this momentum and go ahead? Or maybe from oversold levels, we've moved higher and now maybe the market consolidates?
Good morning to everyone. We are still around 25,500, 25,700, but that's still the momentum still remains positive. I'm pretty positive in the short term, in the medium term. Crucial supports 25,400, 25,300, and we've been bouncing back from these levels already a couple of times now, and taking support at 20 daily moving average, which is a very good sign for the markets. I think this momentum should continue on the upside. Resistance, as we know, 26,000 is a very, very crucial resistance. Once we cross 26,000, close about 26,000, I think the momentum will strengthen from there. Sectors like PSU banks, defense, pharma are looking good. The good news is that the IT pack has started bouncing back, which is great from here. So overall, view positive, and I'll be targeting 26,000 and above. I'll be targeting above 26,400, 26,500 in the medium-term outlook. But at this point of time, we should more focus on sector-specific and stock-specific action.
All right. So what sector and stocks do you think are tradable right now with the moves that we're seeing?
I think PSU Banks, defense, pharma, three sectors I'm focusing on. I have two calls on Indian Bank and Laurus Labs. PSU Banks are looking really good from here. Indian Bank has been consolidating for a little while now, but I think we've got a very good momentum here, taking support at 20 daily moving average. A flag pattern has broken on the upside. Great setup. Stop loss would be 865 and target would be 925. The second call is on Laurus Labs. Laurus Labs looks great as well. Just taking support at 200 daily exponential moving average, bouncing back from there, trading about 20 and 40 daily moving average. Good setup. Stop loss would be 985 and target would be 1090.
Okay, all right. Thanks a lot for that, Saumil. Well, let's shift focus to our special segment then, where we get you a few ideas for profit from Money Control Pro. Anand Chaudhary of moneycontrol.com joins us to talk about a stock that he's tracking rather closely, Jyoti CNC Automation. Go ahead.
Today we are talking about the third largest player in metal cutting CNC machines, that is Jyoti CNC Automation Limited. It manufactures CNC machines for various industries such as automobiles, aerospace and defense, general engineering and EMS. Company has shown a very healthy growth in last 5 years, driven by rising demand for precision engineering in India. In FY25, company has increased its capacity from 5,000 machines to 6,000. To support the sustained demand, the company has announced another 450 crore of capex to add 10,000 machines, taking the total installed capacity to 16,000 machines by September 2026. It has also recently doubled its capacity in European subsidiary Huron to 240 machines. The management highlighted that European demand is largely defense-led, citing French customers, and noted a broader pickup in defense spending amid recent geopolitical developments. The current order book remains healthy at 4,585 crore. Defense contributes 40% of that, providing a 24 to 30 months of revenue visibility. The management maintained its 25 to 30% revenue growth guidance over the medium term. The existing manufacturing base is operationally at full utilization, making the ongoing capacity expansion a key growth trigger for the company. Successful and timely commissioning will unlock incremental revenue volumes while improving execution flexibility for large and complex orders. The stock trades at 27 times on FY28 earnings.
Okay, all right. Thanks a lot for that. Well, time to slip into a short break. You come back. We continue to focus on markets. We'll also get you some insight onto some stock-specific action. Don't go anywhere.
Welcome back. You're watching us here on Chartbusters on CNBC TV 18. The market's actually come off the highs, so that's something that we'll have to monitor very closely. The Nifty is now below the 25,700 mark, also just above the flat line. So holding in the green by about 4 or 5 points as we speak. And the Nifty Bank actually has come off the highs. It will be very interesting to see whether the IT index has also seen some selling from the top or not. So the Nifty Bank is now just 73 points higher. We have the IT index that should come up for you as well. That's fairly stable, around 1.72% in terms of gains. But pains mount for Ola Electric after what was a downbeat December quarter. Remember, the stock was at a record low already and sees further sell-off where the company's market share has shrunk, losses continue to be elevated, revenues halved, and now brokerages are downgrading as well. Sudarshan joins in with a complete lowdown. Sudarshan.
So another day when stock is at record low. In the last 2 months, stock has slipped more than 20%. And if we talk about the volume front, yesterday volume was 8.5 crore versus 10-day average of around 3.86 crore. And yesterday also we saw that few brokerages are downgrading the stock. Today also Citi has come out with a note downgrading the stock to sell from buy and reducing the target price to 27 from 55 rupees per share. It said that AV penetration for Indian two-wheeler market has been sluggish, and especially Ola Electric has lost market share. In January 2026, company's market share stands at 5.87% versus 25% market share that company used to hold in January of 2025. Citi says management's efforts to improve product and service quality could take some time to fructify, but healthy gross margin trends and better operating leverage could boost EBITDA. Negative cash flow as of 9-month FY26, free cash flow was at minus 1,530 crore. That could result in the concerns related to the balance sheet. It has cut estimates to target multiple to 3.5 times from 4.5 times. Now, in the start of FY26, Ola Electric had given the guidance for Now, on the auto business EBITDA margin, the guidance was plus 5%. As of 9-month FY26, it's minus 6.4%. On the gross margin, range was 35 to 40%. As of now, it's at 29.6%. Volume range was 3.25 to 3.75 lakh units. As of now, company has done just 1.5 lakh units. And on the revenue front, range was 4,200 to 4,700 crore. As of December, company has done just 1,988 crore. So these things are reflecting in the stock price and also in the earnings that company has been reporting.
Got it. Thanks a lot for that, Sud. Well, keep an eye on the markets. We were trading well in the green, 50 points up. The Nifty has seen a sharp decline, and both the pillars of the market, they seem to have slipped a little bit. You pull up the tech index, the heavyweights out there, they have slipped considerably, almost moved into the red. And the Nifty Bank, that's been the star batsman, that in fact from being up 250 points, it's up only around 30 points. So just keep an eye out on both those two. But talking about tech, Rima has been reading on a day-to-day basis, brokerage after brokerage. Rima, what's on your radar today? Tell us what brokerages are making on the tech space.
Well, I think it's a question between near-term and long-term. It's a question between value and the kind of valuation and the kind of growth rate. So UBS says, well, in the near term, maybe there is a bit of overreaction, but the questions around the terminal growth rate, especially over the medium term and long term, cannot be ignored. And therefore, it all boils down to how quickly Indian IT companies can adapt and defending growth from here on. And again, they're not talking about the near term, just FY27. They're talking over the medium term. Defending growth will require not just pricing and a little bit tweaking in the delivery model, it will require companies to move up the valuation change. On the subject of valuations, yes, large caps are trading at 16, 20, 21 times, which is cheaper than the historical valuation. But again, they're saying it all boils down to growth and how quickly Indian IT companies can adapt. Just in the near term, they said that we do see an overreaction. And in the near term, they stick to their thesis that we are seeing an improvement in the environment. Nomura believes that perhaps also the sell-off could be overdone because they seem this to be a case of more front-loading of the pains, where the stock is pricing in an extinction of the old pricing business models before gains from the new business model emerge. Valuations, they say, have corrected meaningfully. Valuations for the large cap IT names, if you compare it to the 5-year average, are down 12 to 39%. Transition periods, they say, are painful. But given the free cash flow yield, the dividend yield, they believe there will be a floor for the Indian IT companies sooner than later. They've again distilled it down to a couple of scenarios. One, if the Indian IT companies' revenue growth stays at 2-3%, maybe no growth, stagnates a bit, then valuation multiples derate very sharply, 10 to 12 times, which means massive downside from here on. But if growth rates get back to their historical levels of 7-8%, then valuations stay around early 20s. But if Indian IT companies can really be the winners in AI orchestrators, then valuation multiples can actually expand from here on and re-rate. So it boils down now to how Indian IT companies adapt and what the growth rates over the medium term will be. And that is something I think very few people on the street still have clarity, because the situation is evolving very rapidly.
Take that point, Rima. Situation is evolving rapidly, not just for the IT space, but also for the markets right now. Moments ago, we spoke about the Nifty being flat. Thereafter, it moved into the red, and now it's formidably moved into the red. When we started the show, all the 4 indices were actually in the green. And now, as we speak, they're all in the red. And while IT and, the Nifty Bank have moved lower, pull up the intraday chart of Reliance. You would see Reliance also weighing down on the frontline index. So the large heavyweight that you have, Reliance is actually at the low point of trade. IT index, while it's still in the green, it's off highs. Reliance, that's the one which is down about 1.2% at the low point, pressuring the frontline index on the downside. And now, as we speak, we are firmly in the red. But let's get you some highlights from the AI summit, which is currently underway in Delhi. The CEO of the AI giant, Anthropic, Dario Amodei, is in India to attend the summit. He was in Bengaluru yesterday to announce the company's new office. He did say that India is the second largest market for the company's popular chatbot, Claude. And he added that Anthropic's business run rate has doubled in India in just the last 4 months itself. A conversation you'd love to hear.
Anthropic's business, its run rate revenue within India has doubled over the last 4 months since I last visited. On Claude Code may have grown even faster. We're just going through the ability to kind of build software with AI and build as kind of developers on top of AI, and build new applications. And I think again, just the kind of efficiency of the market here, the energy of very large numbers of people wanting to find something and build something, I think that greatly exceeds what I've seen anywhere else. You shouldn't build for where the AI models are now. You should build for where they are in a year or two. If you're a large enterprise, if you're a big effort trying to build something, it's going to take a while to actually deploy and test things. So you should be imaginative about where the technology is going to go. Don't build for step 4 out of a 10-step workflow. Try and do the whole workflow, even if the AI model isn't quite capable of it yet. The companies that have understood that, the kind of users that have understood that, I think have gotten much further ahead than others, and they kind of see the future because they're able to use models in ways that correspond to a product that we haven't released yet.
Well, that's the mega exclusive that you're going to be looking forward to. So we'll wait by for that. For the time being, we'll slip into a short break, come back, continue focus on markets.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, the markets are trading more or less flattish now. The Nifty has seen a sharp downtick, was down 50 points, now it's down 20 points. The good news is that the Sensex has moved back into the green, while the Nifty Bank as well has come off from the top, though as we speak, it's sitting with a gain of closer around 50 points. I think the tech index is looking a little bit nervous. It had a 2,000-point rally from Friday's lows to today's high, but some kind of profit-taking creeping in there. But your portfolio could be feeling good. Number of stocks advancing, outweighing the number of stocks declining. Tell you what, we'll wrap up on this edition of Chartbusters.
What I'll say is just hold on for like 5 seconds. We started with all the indices in the green. In the middle of the show, all the indices moved into the red. Let's see whether we can hold on to a bit and see if all the indices go back into the green or not. For now, 3 are okay, but our director says whether the indices go back or not, we got to wrap the show, and that's what we do. All right, thank you for watching Chartbusters. On the other side, the team of Trading Out comes up.
Hello and welcome. Your tune into Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ritu Singh. Very flat for the markets as we speak. It's been quite volatile from the word go. But we do have the Bank Nifty, which is slightly in the green, but largely a flatter start to the market, and the volatility continues as well. The PSU Banking Index is doing well. IT has made a comeback. It did that yesterday as well, and that continues to be the case today as well. In fact, we are getting a lot of conversation. So let's cut across to Parikshit, who is in conversation with former Niti Aayog CEO Amitabh Kant at the India AI Impact Summit. Parikshit.
Monitor the attendance of teachers. You can, really build competition on the basis of real-time data. All this was not feasible earlier. So AI gives you the power to really leapfrog in a very, very big way.
Right. How do you hope India will leverage AI for economic growth? The big conversation in every ministry right now is how to have a Viksit Bharat by 2047. How do we ensure that we use AI to have that consistent, sustained 8 to 9% growth rate year on year?
Actually, it's very important to understand that India can't grow at 8 to 9% per annum or become a $30+ trillion economy without empowering its citizens, without empowering 50% of its citizens, which are either wage earners or living on Manrega, etc. And what's important is that we are able to skill these people in AI. What's important is that we can use their talent and we can use the computing power to spread this. What's happening today in the United States, for instance, is that AI is driving growth, AI is driving investment, but increasingly they'll create a more unequal society. It's very important that we learn from our own lessons of digital public infrastructure, where we created the guardrails and we provided digital identity to 1.5 billion people, and we do fast payment, credit, stock market transactions, we provide insurance, all this to a vast segment of population, tier 2, tier 3 cities and rural areas. And therefore, to my mind, AI will remain unequal if we are not making it accessible, if we are not making it affordable, and if we are not making it multilingual, and if we are not teaching the heart of India's population. India will grow at 8 to 9% if we make AI multilingual, if a person can speak in Malayalam, Tamil, Telugu, in its local dialect and use the power of AI. And more than the power of multilingual, but use the power of voice on text and really ensure that it is both accessible and extremely affordable. And that is what some of our young startups like Sarvam AI are doing, making it multilingual. So I think that is where the real power is. Secondly, I would say that it's important that, what is very critical is that AI is also a huge energy guzzler. So if America is driving it on the back of fossil fuel, India should really demonstrate its great ability to drive it on the back of clean energy. Today, AI is consuming more energy than what Japan consumes. If we have got a 70 to 75 billion worth of investments in data centers, it's critical for India to drive it on the back of clean energy, renewable energy, back it with small modular reactors, but really upgrade its transmission, its grid, its cooling centers, really to ensure that we are able to use. India is climatically blessed. No other country has this ability, which India has. And therefore, to drive these data centers on the back of clean energy. But for that, you need to upgrade your transmission and grid and make it really smart.
Mr. Kant, do you feel that we're having enough focus on that? We're focusing on driving AI investments, driving investments in data centers, but making sure that they are running on sustainable fuel. Do you think we're talking about that enough?
So that's critical to my mind. It will be very difficult to do this without renewable energy. It's critical that we back it up with small, and government has taken several far-reaching measures. For instance, opening up the small modular reactor sector. But allowing private sector to come in small modular reactor, India must take the first mover advantage. Secondly, it's very, very important that we...
All right.
That is the Impact AI Summit that's happening in New Delhi, where we'll continue to get you big voices from the AI space. So speaking of AI, the big news today, of course, was Infosys tying up with Anthropic, and the sentiment gently turning. I mean, you're seeing the IT pack after a long time lending some support to the markets. It's in fact, the strong gains in the IT pack that is helping the markets today offset some of the losses that we're seeing in the metals and some of the other stocks. Apart from that, the PSU Bank doing pretty well in trade today. It's up about 1.5%, led by names like PNB, Union Bank, UCO Bank, Central, and others. Realty, Energy, Auto, these are some of the names that are still trading in red. But all in all, for the markets, the Nifty still down about 20 points as we speak, but the Sensex is in the green. But the good news is, the advanced decline ratio, the market breadth, still in favor of advances. That's where we have it. You have about 2 stocks that are advancing for every 1 stock that is declining. So let's get in Ria, who's standing by with a list of top stocks for the day and why they're reacting to some of the news that's come in to focus on. Ria.
Well, let's start off with Cochin Shipyard first. The company has been declared as the L1 bidder for 5 of the next-gen survey vessels for the Indian Navy. The total order value for this is rupees 5,000 crores. And at the end of Q1, the company's order book stood at rupees 21,100 crores. The next one is Texmaco Rail. This one is also performing well in today's session on the back of an order win. They received an order worth roughly 220 crores from MRVC for the Mumbai Suburban Railway Line construction, the execution period for which will be 36 months, and the order book for the company at the end of Q3 stood at roughly 5,660 crores. The last stock is TVS Supply Chains. This one is also up roughly 3 to 4% today. They have signed an MOU with Italy-based ALA Group to enter India's $28 billion aerospace and defense supply chain.
Okay, all right. Thank you so much, Ria, for joining us with those stocks on your radar. Let's talk about Ipca Labs now. Nuvama and Axis Capital, both of them are upbeat on the stock. Let's understand their rationale. My colleague Winnie is here with the details.
Hi, good morning. So yes, Ipca Labs today, that's the stock that is moving around in trade, and this is mainly after the con call highlight. Earnings were in line with expectation. Actually, revenue was a bit of a miss, but the margins as well as the profitability, that's where it was better. So overall, inline set of numbers. Now, in the earnings con call, there were key highlights. One, they said that, the branded business, that contributed 50% during the Q3, improving the contribution by around 400 basis points on a year-on-year basis. Nuvama also is maintaining their buy rating. They've increased their target price to 1,750 rupees from previous target price of 1,610 rupees. This is the strongest margin that the company has delivered in almost 4 years. The Africa business, Latin business, that's doing well. India business, that's also seeing a healthy growth, and that is shaping up well for the company. Now, Axis Capital is saying that mainly this time the business mix, something that has driven the profitability of the company. Unichem performance is now expected to start normalizing in the next 2-3 quarters. That means the margins over there will start improving and supporting the margins of the company overall. For Ipca Labs as a whole, the company has also highlighted something very interesting, that they are evaluating in-licensing opportunities in GLP-1, and on the basis of all of this, Axis has also raised their FY27, FY28 EPS by 1 to 3%. They've raised the target price to 1,610 rupees as well from previous target price of 1,480. So some upgrades coming in here for Ipca Labs.
All right, Vinny, thanks very much for taking us through those details. Let's do one thing. We'll slip into a very short break. But up next, we'll focus more on the markets, the bond markets, and of course, we're standing by for the Infosys AI Investor Day conference. Welcome back. Infosys is holding its Investor AI Day 2026 today. Let's cut across to the chairman of the board, Nandan Nilekani.
This is a much more fundamental change to the way businesses will operate. So this is not a layer of technology. When we had, when smartphones came, we could build applications where instead of having a PC, you did it on the phone. It was like putting a front end to an existing application. When cloud came, we could do a lift and shift. You could take the app from your in-prem and move it to the cloud. So you could do a lot of things to get going. But this time, it's not that. This is a fundamental change in the way we do things. Obviously, there's a technology dimension, and it's all about having AI-native architecture. But there's a whole business dimension to this. We cannot run business the old way. And businesses have to change. The customer journeys have to change. All those things have to change. It's a huge challenge for talent. Talent will have to deal with a world where writing code will not be the goal. It'll be actually making AI work, orchestration, and those kind of things. So the jobs will change. And operating model, how do we make this at scale? How do you get a firm with hundreds of employees to change all the things and make it work? And of course, our mental models have to change because we worked. Technology was always deterministic. You said A plus B equal to C. So no matter how many times you said A plus B, the answer was C. In this AI world, every time you give a prompt, you'll probably get a different answer. And therefore, how do you deal with this non-deterministic world? But how do you make sure what you build has the robustness, reliability, and resilience of the deterministic world? That's what the challenge is for everybody. So this is a fundamental root and branch surgery of the way business is done, which is why this technology transition is so dramatically different from anything else that we have seen. Now, one clear learning we have is modernization of legacy systems cannot be deferred anymore. What happened over the last 60, 70 years is people would not replace the legacy systems, they just added to it. So if you go and look under the hood of a large enterprise, they will have mainframes from 1960, they'll have mini computers from 1980, they'll have LAN from 2000, they'll have all kinds of things, and all coexisting in silos. That is over. If you really want a firm to take advantage of AI, you have to fundamentally clean this up. So this is a massive, massive cleanup job which everybody is dealing with. There are reasons for that. One is the financial drain. Many large companies are spending 60 to 80% of their IT spend on maintaining systems. There's no business value out of that. They want to go from 60% or 70% maintenance and 30% new systems to 30% or 40% maintenance and 60, 70% new systems. They want to flip the way they spend money. But they can't do that with that fundamental cleanup they need. Moreover, many of these systems were designed in an era before you could have online attacks and so on. So security breaches, which you see every day, are just going up everywhere, and there are more state and non-state actors who are getting better at it using AI. So security is a huge problem for everyone. We have seen so many cases in the last few months. And because the data is all in silos, you can't even innovate fast. You don't have to be. So there are fundamental structural issues today we have. So demand side is absolutely demanding modernization. But the good news is for the first time, because of AI, we have the tools now to do modernization fast and very quickly, and at a much more economic way. So we have a huge demand, and we have the ability now to do it, and perhaps our team will talk about that. So fundamentally, accumulated tech debt over decades must be paid. You no longer have the option to defer this. And this is a huge, huge requirement, and obviously it's a huge opportunity for us. Now, the other thing which is there is as AI becomes a bigger part of the spend, the balance of advantage is moving towards build rather than buy. And that is actually what is, if you see some of the concerns about what will happen to SaaS companies and all that, it's because of this, that building applications has become so simple
that very often you may just build, or you may replace something that you have which you bought and with something to be built. And so we are seeing, and that again actually benefits folks like us, because about building, who's going to build it for them? It's going to be us only who will build it for them. So fundamentally, it's good for us. And the other thing which is there is that our view is that foundational systems will increasingly become systems of record. But the interface will be agentic, because agentic interface makes a lot of sense. Agentic interface allows people to produce something which is designed pro-consumer or pro-user, and agentic interface enables you to take out the complexity and hide it behind the agent, so the agent is simple to use. It's a very simple idea. Now, enterprises will therefore want to put agentic layers on top of all their applications, even if they leave the system of record the same. And that is something which will be a combination of bought-out agents as well as building their own agents, because finally, the agents have to be composable in a customer journey which is seamless, which is a mix of agents which are your own or from somebody else. Again, that requires orchestration and work which somebody has to do. So there's a huge amount of work required once they go towards build rather than buy. Now, the other thing is the pace of change is something which obviously we have not seen. We all know about the trillions of dollars being spent and all that. But even the technological change, 2023 Foundation Frontier model had 100 billion parameters. Today, it has 1 trillion parameters. There are only 10 to 12 agent networks. There are 60 agent networks. So this is only going to go up. In the US alone, there are at least 5 frontier models. In China, there are big 4 or big 5. So this is only going to go up. In India, we have seen so much action, and you'll see some big announcements this week on Indian-based sovereign models. So I think this is something. Now, there are certain implications of this, because if I'm a businessman and I have to choose my technology, how do I make sure I don't make the wrong choice? Because something which I invest in today may have fallen behind tomorrow. Already people are facing this reality. And therefore, how do you architect your technology so that you can deal with this rapid change is a very fundamental and structural need for enterprises. And again, they need help on that from somebody who has done this in 2,000 locations and understands the pros and cons of every approach.
Okay, all right. That's the word coming in from Mr. Nandan Nilekani. We'll keep dipping into that conversation, the presentation at Infosys Investor Day. For now, we'll slip into a short break. Up next, we'll focus on the bond market with Manisha Gupta on the other side.
Fly Emirates, fly.
Welcome back. Markets are back in the green. And for now, let's just cut back across to the chairman of Infosys, Nandan Nilekani, talking about the AI transition.
How do you make sure that AI investments lead to real performance and productivity and not just some make-believe stuff? This is something which is very important. So what still matters? First principle thinking. One of the things when we train people is they have to learn to do this without tools. Because all of us learn to do this without tools. So when we got the tools, we knew how to use those tools better. But if you start by teaching them tools, then everything is a black box. Then, it's like the guy who never knows how to calculate because he was born with a calculator. So first principle thinking is very important. All the more important as you think about strategic transformation of large enterprises. First principle thinking is very important. Second, understanding enterprise context. Every company is different. Every company has a different legacy. Every company has different systems. Some of them have come from acquisition. Some have come because they have 5 business units all buying their own version of technology. All kinds of reasons. Everybody has a complex estate of systems. And context is essential to being successful at AI deployment. And each context is different. And it's the dealing with these contexts that is the hard part, which is where, again, we believe we have a way of doing that. I'll give an example. The self-driving cars. The first DARPA challenge was 2004. The first time they rolled out was 2007, 20 years back. Then everybody said, oh yeah, by next year we'll have self-driving cars. It's 20 years later, all we have is a few cities in America where there's self-driving cars. Because the context is different. Every city is different. Every road is different. And by the time they come to Bangalore, it'll be 2047. Because they're dealing with Bangalore traffic, it'll be a different level of context. So enterprise context is so important. And that is something which cannot be done by a tool. It has to be done by capturing implicit knowledge and making it explicit. Agnostic design. Again, what I mean here is don't get locked into a tool, because that tool may no longer be, it may be obsolete in 2 years. So how do you design for agnostic that you can choose any system? Getting the house in order. We talked about removing technical debt. We have to go make the house in order for this whole thing. And then massive change management. You're changing organization, business structure, people. I mean, this is like unbelievable change management. So unless you have leaders who can do effective change, nothing is going to happen. It's also about strong collaboration across firms. So firms have to, because all the knowledge is implicit in the heads of different people, how do you make that explicit in one customer journey? Focus on productivity. It's not about using AI tools. It's about productivity out of those tools. Otherwise, you'll get false productivity, which leads to more complications. And then this is an engineering game. AI engineering is a whole way of doing things. And that is part of your change management and transition that you have to do. And that's a big thing. So my view is there is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues. And I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk. It's an execution risk. You get it? And therefore, the balance of assessment is how do we know that each firm has the execution plan ready to get to where they have to get? Are they able to do it well? Are they able to do it with speed? Are they able to do it with scale? Are they able to do it with new mindsets? That is really the question of the day that all of you need to ask. So I'm hoping that today you will hear from our team and it'll give you some reassurance that we are on the right track. Thank you very much.
Thank you, Nandan. For our next session on the AI services opportunity, please welcome Salil Parekh, Chief Executive Officer and Managing Director, Infosys.
So good morning and welcome. I think with that session from Nandan, I'm sure you have a lot of clarity and a vision of where the industry is going, where AI is going, and what are the real issues that one needs to look at. I want to share in the next few minutes where we see the opportunity today in AI services and how we are planning to go after it. In fact, already how we are going after it, and give you examples of that. So first, one of the things we've learned again and again is what we see from our clients is that our clients trust Infosys in driving and delivering AI work. And throughout the day, we want to share with you several client examples. Here are a few quotes. The first one from the CEO of a large telco, where we are doing extensive amount of AI work, and how he sees the value that Infosys brings. Another one from a COO, another one from a CIO. And these are the sorts of examples that drive how we have built our approach, how we are executing on the AI journey. So today, we are doing AI work for 90% of our large 200 clients. So this is not something which is just here and there in pilots. In terms of the scale, it's across many things. It's small and large parts of large programs with large clients. What we have now done is introduced a way to look at what we are doing through an AI-first value framework. And this framework we are putting together in this hexagon, which I will share in a few minutes in some detail what we are driving through with it. We essentially see 6 large areas where there's growth opportunity for AI services. And I'll go through this in a little bit. We will also have each of our different leaders from their different perspectives give you specific examples in each area. First, AI strategy and engineering. This is really the area where we do a lot of strategic work. You will in fact see one of the client examples I shared where a CEO is engaging with us. There are several others we will share later. And you will see some videos of this as well. So we are doing a lot more AI strategy work. Infosys is a lot more engaged at that level because AI is central in that sense to all of those conversations. But the building of agents, the orchestrating of what the platforms are, what the agents are which are built by Infosys, which are agents built by clients, which are agents built by third party, and how to make all of that come together. Second is data for AI. Data is absolutely critical, as I'm sure most of you already have seen. Each large enterprise is protecting its data. No one in the enterprise world, unlike in the consumer world, is sharing data broadly with the AI foundation models. Everyone is building their own data, and there's a lot of work to be done to make enterprise data ready for AI in this new era. The third is process, where a lot of business process that exists today, whether it was technology enabled or whether it was not, is being driven by agents into new worlds. One of the biggest areas we see here, of course, is customer service. And the customer service business case is driving huge change in how process is going to change with the AI world. The next, again, you heard from Nandan, the legacy modernization piece. This is a massive, large opportunity that we are seeing. In addition to customer service, one of the largest opportunities, where we are essentially taking large legacy organizations. We'll actually share a couple of examples of this, of the work we're doing at scale, and bringing them away from the legacy landscape into the modern landscape. Physical AI is something quite new where AI software is embedded into devices, and that is becoming a growth area because everything will have AI built into it. And then AI trust, which is both about the trust and cyber, but it's also about responsible AI, which is something where Infosys is leading in making sure that things are built with a view to keep responsibility in mind in the scaling of IT systems. So these are the 6 new areas that we are seeing. This is a large opportunity set, and this is where we see a lot of the growth coming. Now, here are some examples of clients we are already working with. Throughout the day, in a little bit more depth, each of the leaders from Infosys will share 1 or 2 client examples. We will also have some videos to sort of have the client share from their perspective how Infosys has supported them in this AI journey. So what I'm showing you in the hexagon in the AI value framework is not theoretical. This is things that are actually happening on the ground with Infosys. This is what we are executing. And this for us today represents 5.5% of our revenue in Q3. And it's growing at a robust pace. And this is something which is extremely dynamic. It is something that is working extremely well with our clients. Now, this at the high level of 6 big blocks is something that we have as a visual of hexagon. But within the company, we then break it down to 30 offerings. And then those get broken down to 100 sub-offerings. And each of those are things that are being enabled with our engineers and with agents, built on Topaz, which we will talk a little bit more about later on, and with partnerships. You saw one of the announcements this morning, but we are working with each of the large AI players in very close coordination to make our clients more successful. And all of this is the way we are now going to our clients. So each client discussion today is focused on the hexagon plus the 30 plus the 100. And what is it that we can now work with you as a client executive to make it real for you, the AI benefit, whether it's for revenue growth, whether it's for cost optimization, whether it's for innovation. So our entire go-to-market team, all of our segment leaders, all of our practice sales leadership are working with clients with this format to make sure that the AI becomes more and more embedded into the work that we're doing with clients.
All right, that's the word coming in from the CEO Infosys. We'll keep getting you more updates on this investor meet, which is focusing on AI. For now, we'll slip into a short break. Up next, we'll discuss the market fundamentals with Rupal Bansali of Double Duty Money Management. Stay tuned for that conversation.
You want to talk business? Meet me in the on-board lab.
Welcome back. You're still tuned into Trading Hour. Markets have recovered a tad bit, and we have been getting a lot of commentary on AI at the AI Summit and Infosys AI Day as well. But what's happening with markets? Let's discuss some fundamentals as well. Rupal Bhansali, founder, CEO, and CIO, Double Duty Money Management, is joining us now. Rupal, good morning. Thank you so much for joining in. And interesting times. We've been talking a lot about AI, how it has impacted the IT services stocks, and generally whatever we've been seeing in last couple of months, it's a lot about geopolitics. How do you view India in that way?
So I think AI is actually a huge question mark in my view. I think it's going to be far more binary than bankable going forward. And I think India is actually not well placed potentially from that standpoint. From an investment standpoint, though, I would much rather own companies that are AI resilient than AI victors. I think that trade is behind us. So, for example, if you think of Latin America, commodity exporter, AI is not going to grow wheat. It's not going to unearth copper. And I think those sorts of things are more bankable. And those markets are very cheap. So I know that's not really talking about AI per se, but I think actually AI is going to have very far-reaching ramifications. We don't know how to handicap it. I don't want to pretend here to say that, we know exactly how it's going to shake out. I mean, the market's going to be very volatile in terms of winners and losers. So I'd much rather just sidestep the whole trade.
Okay.
And focus on what's resilient from AI rather than winners and victors and victims.
So you're not bearish or you're not bullish on the AI theme at all. It's not something that you're looking at all. But do you think that will continue to be a risk for Indian markets? The way these stocks fared in the last couple of weeks, what is now the attraction point for, say, FIIs or investors to buy into India?
I must confess, I'm not convinced that India is a buying opportunity. I know the markets have been weak for a couple of years. I know that the Indian market certainly feels, Indian participants in the market feel it should go up. But markets don't go up because you want them to. They have to go up based on fundamentals and valuations. And to the extent that you ignore those two things, you're going to be kind of challenged. And the last 2 years, we've seen a lot of earnings downgrades in the Indian market, which is quite astonishing. Because the prior cycle, we saw a lot of upgrades. And so when you have downgrades and you've already paid up, for a very rosy outlook, then you have a valuation reset. I was just checking the valuations of the Indian market. I mean, even despite the correction in the mid caps, the Nifty, et cetera, has held up sort of relatively okay. But in the mid cap space, you're still looking at 31 times trailing earnings. People are forecasting 23 times, but all of these are very punchy multiples. So you really need to have the underlying fundamentals, live up to those valuation expectations. I fear disappointment.
Okay.
Okay, Rupali, hi. This is Ritu. You're saying it's a bit of a disappointment. You don't really see a big opportunity here. India has corrected, but you say it's still not attractive relative to what you're seeing globally. What will change your outlook from here? What's really missing? Is it valuation comfort? Is it earning visibility? And, in your note, when you say dividends are likely to be the dominant source of equity returns going ahead, are you effectively saying price appreciation is going to disappoint from here on?
Riddhi, you said it all. I can only echo. Look, I'm an independent thinker. I'm a contrarian. Does not mean I do the opposite of what everybody else does, but you have to have an independent point of view that you can validate. And I think for the next decade or so, you see, the last decade has been a lot about price appreciation. And that's kind of, what's really driven the returns of the market. I think the next decade, dividends are going to take on the larger responsibility, the center of gravity. And remember, over the 250-year history of stock markets, which you all sort of like to quote and talk about the high returns, a very large portion of those returns have come from dividends and reinvesting those dividends. So I think the attention has to skew towards dividends. In fact, it's something that's available all over the world. Sadly, not much in India. The Indian stock market has a dividend yield of about 1.2%, whereas some of the portfolios that we manage, have close to, 6+% dividend yields. Now, I'm not saying that, that's the only thing to consider, but I do believe the baton is going to be shifting to the dividend yield strategies. And I think they also act as a buffer, to the extent that markets don't perform, you can count on dividends. Dividends tend not to get cut that much. They tend to be far more stable. Again, provided you do your homework, it's not all dividends are not stable. But I would say, yes, that's a very big call I'm making. The global markets, there's a lot of opportunity from that vantage point.
Rupal, you've been championing non-consensus investing as sort of the only way to deliver outsized returns and what we're seeing globally today. But what we see is most allocators looking into crowded growth and momentum trades. So, where is this non-consensus opportunity, if you can spell out for us? You spoke about the AI resilient trade. Where exactly do you see that in India?
I don't see it within India. This is the challenge. I'm a global investor, so I can cast my net very wide. I would actually argue, like most investors in the world, there's a home country bias, right? Indians want to invest in India. That's where the bulk of the money is. I would actually make a call for diversifying and, frankly, looking at opportunities abroad. And I think Indians are able to invest abroad. The question is of taking advantage of that opportunity. Unfortunately, a lot of Indians, when they do invest abroad, they invest in the US market. I mean, that's true of course, global investors too. I'm actually quite bearish on the US market as well. I actually think the markets internationally, whether it's Europe or Latin America, it's not the conventional answer you'll get from most people. I'm sure, people are favoring, for example, Japan all of a sudden is a flavor of the month, of the year. And frankly, going forward, I hear a lot of investment appetite for it. I'm not bullish. You see, the reason to be non-consensus is not for the heck of. It's a very dangerous thing to just do the opposite of what everybody else is doing. You better be correct. But I think what is important in markets is that the consensus is already in the price. So if you want to beat the market, you better have a non-consensus point of view. That's the nature of markets. And so Japan, for example, so much optimism because of the election, the new regime over there politically and economically, interest rate wise, so much has been priced in. I actually fear there's a setup for disappointment. On the flip side, you look at Brazil, where people are so worried about the politics. They're so worried about, the currency. And frankly, the politics are improving. The currency is more set for appreciation than depreciation. So what is perceived to be a source of risk could actually be a source of returns. So my non-consensus point of view is that you should always look for opportunity where others are not. There's always opportunity to be found in global markets. I mean, again, my remit is very large, so that sort of, allows us to be very discerning. And I think the Indian investor is able to go abroad. They just need to think differentially.
Okay, so in that case, you spoke about Brazil. What are the other international markets that you think are doing well right now and they should be on Indian investors' radar as well?
This will sound very counterintuitive because, another country that is totally out of favor is France, right? I mean, the French politics are pretty bad, the fiscal deficit, elections, I mean, all the stuff, the backdrop. And Europe is viewed as such a has-been, in terms of people's perception. And yet France has some amazing companies. You look at, in the last decade or so, stocks like Louis Vuitton, Hermes. I mean, these stocks have doubled to quintupled. Okay, that's amazing absolute returns to get. And less well-known names like Schneider Electric. It's actually a play on data centers. It happens to be a French company. But if you're not looking there, you're not going to find it. Safran, it's an amazing play on air traffic growth. All of us want leisure travel, short-haul flights. Narrow-body engines, Safran makes those engines. That is a way to play. This stock has, again, quintupled over the last decade. GTT, which is the NVIDIA of the engine inside an LNG tanker. Post the Ukraine war, you have to ship oil because the pipelines, are obviously not operating. And even India, for example, when you get oil from far off places, it's LNG tankers. There's only one company in the world that really makes these, I'm going to call it the engine for these LNG tankers. And the volume demand for it has exploded because, shale fracking in the US, people want to export, right? There's so many gas terminals being built. These are very bankable ways to make, I would argue, it's an opinion, when I say bankable, there's no guarantee in investing, but you can see the line of sight of these things growing. There's only one company that's, so everybody's looking at NVIDIA for AI. Look for the NVIDIAs in other parts of the market. It happens to be a French company. Roughly 12 times earnings, a 5% dividend yield, a strong balance sheet, net cash. I mean, this is the kind of opportunity you can find even after markets have soared all over the world over the last 15 years. You just need to open your eyes and be a non-consensus thinker. I will just argue, that's my job, right? I mean, I have to find value and not sort of lament that there is no value in the US market or the Indian market.
Okay, so that was very interesting. I tracked the energy space and I never knew about this, so it's very good to know, learn something new. But quickly, before we let this interesting conversation go, what will make you bullish on India from here on? Are you expecting it to correct further, reach a certain level of valuation, or see more earnings recovery come by?
Look, I'm actually most enthusiastic about Modi's plans to reform the labor market in India. I think any country, if you look at the genesis of sustain GDP growth. For a while, you can sustain it with infrastructure spending, with deficit I mean, all sorts of things, can happen. It happened in China for a long time and, then it reset. But ultimately, if you need a country to be on a very stable footing, the people have to make money. And, the spending cycle has to continue, the saving cycle, the investing cycle, right? So job creation. So labor market reform in India, I think would be a game changer. And that's something that would make me very bullish.
Okay, take that point. A pleasure speaking with you today, Rupal. Thank you so much for joining us in the studios and telling us what you are bullish on, the contrarian trade that you speak about. A lot of learnings. Thanks a lot for joining in today.
Thanks for having me.
With that, we'll slip into a short break. On the other side, we'll discuss markets and stock-specific action.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The markets have made a smart recovery in the last half hour of trade. The frontline index is now up almost 50 points. You also have the bank Nifty that is up 180 points as we speak, but the recovery was led by the IT pack. That's up about 2.5%, led by Infosys. That stock alone is up more than 4% as we speak on the back of some of those comments coming in about AI being the next big opportunity for Infosys to track. We'll continue to track that and markets, but for now, Sonal and I will take your leave on Trading Hour. The team of Halftime Report will take all the action forward.
Stocks perk up, led by a rebound in IT as it counters local majors stitch tie-ups with global AI leaders. PSU Banks, FMCG and industrials are the other prominent gainers going into F&O expiry on the NSE today.
Infosys inks a strategic collaboration with Anthropic to bridge the agentic AI and complex enterprise gap. The duo will develop AI-powered solutions for key sectors, starting with telecom, and other IT players like Happiest Minds are looking at similar arrangements to accelerate AI adoption in enterprises.
Infosys chairperson Nandan Nilekani emphatically states that there is no opportunity gap with the AI and the opportunity is bigger than ever before. He adds that there will remain a need for talent, but the roles will change, posing a big reskilling challenge for organizations.
India's chief negotiator is expected to visit the US next week for trade talks on the deal, which could be signed in the month of March. India will pursue the reduction of duties from 25% to 18% across product categories in the upcoming talks.
India's goods trade deficit in January surges 48% from a year ago to over $34 billion due to a threefold jump in gold imports to over $12 billion. However, a 26% rise in services exports keeps overall trade deficit at a modest $10.5 billion. Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC TV 18 Motilal Oswal studio. The market's doing well. The Nifty up 50 points. The Nifty Bank doing well. The Nifty actually led by the IT index, which is seeing a firm rebound. And that exactly is the flavor of the afternoon. Ashmit, our colleague, is in conversation with the IT Minister, Ashwini Vaishnav, at the India AI Impact Summit. All the headlines coming in from there. So let's go across to Ashmit in Delhi.
And on so many different parameters, our sovereign models are proving to be better than many of the global best, and they have the effort that has gone in, the innovation that has gone in, has really proved to be successful.
A lot of conversations, sir, have also started talking about AI and what it means in terms of disruption for the IT industry, for jobs. I remember you also mentioned it at the time of some of the investments that were being made. How are you looking at this conversation? Do you see that unfolding here? And at the part of the AI Impact Summit as well?
We must be cognizant of the real challenges that we have to face. And to face this challenge, we must upskill, reskill, and create a new pipeline of talent. For this, the industry as well as the government and the academia, three of us are clearly focused on getting the right skilling, upskilling, and reskilling, and the talent pipeline to be created for that.
And one final question, sir, one message that you'd like to leave. A lot of big faces are expected here. The likes of, we have Sam Altman, Dario Amodei, Sundar Pichai. One message that you'd like to leave the big tech community with as they depart from New Delhi at the end of this week.
India will play on front foot on all the 5 layers, full AI stack.
Wish you the very best, sir. Thank you so much. Have a great day ahead, sir.
All right, interesting conversation coming in from the man of the moment right now, the IT Minister who spoke to CNBC TV 18, speaking about the importance of AI, more importantly, all the tie-ups that have been announced so far as well, and the kind of value that it would create for the IT sector in India. Speaking about the value that it will create, a big surge is what we've seen in Infosys, HCL Tech, the top gainers on the Nifty, the top contributors, the IT segment itself. But we have a lot on the show, Vinny.
Absolutely, a lot on the show for today. We'll be putting the spotlight more in terms of details for AI, the ups and downs, and IT's push towards AI, which we've been talking about. So that's going to be our What's Trending segment for today. We'll also bring you a conversation my colleague Rima had with the management of CleanMax, who will come out with their IPO on 23rd of February, as well as we'll be focusing on a lot of buzzing stocks in the trading session, as well as big movers in trade. Stay tuned in for that.
Right, so those are a bunch of stocks and sectors that we will be speaking about on the show. So let's start with Ola Electric. The stock is at a record low, continues to see a fair amount of sell-off. Numbers not doing well, promoters selling in the open market, and now even brokerages downgraded that stock. Sudarshan joins in. Sudarshan, nothing working for Ola?
Nothing has been working. If you talk about the earnings, company has been reporting a weak set of earnings quarter by quarter. Recently, it has released the earnings for Q3 FY26. Revenue is halved. Losses remain elevated. And now the stock is at record low. And brokerages continue to downgrade the stock. And today, Citi has come out with a note downgrading the stock to sell from buy and reducing the target price to 27 rupees per share from the earlier target price of 55 rupees per share. And the thesis that Citi has given that EV penetration in India two-wheeler market has been sluggish, and as far as Ola Electric is concerned, it has lost market share. In January 2026, its market share has fallen below 6% versus 25% market share it used to hold in early 2025. Healthy gross margin trends and better operating leverage could boost EBITDA, Citi believes, but negative cash flow as of 9-month FY26, free cash flow was minus 1,530 crore. That could result in the concerns related to the balance sheet, and it has cut estimates multiple to 3.5 times from 4.5 times. Now, in the start of FY26, company had given the guidance on margin and revenue front. On the auto business margin, it was expecting that to improve and be at plus 5%. But as of 9-month FY26, it's at minus 6.4%. On the volume front, it was expecting in the range of 3.25 to 3.75 lakh units. As of December, it's just at 1.5 lakh units. And on the revenue front, the range it had given was of 4,200 to 4,700 crore. As of December, it had achieved just 1,988 crore. So weakness in the earnings reflecting in the stock price, and companies failing to meet the guidance as well.
Okay, Sudarshan, thank you so much for that. Ola Electric as of now is down almost 2.5% in the trading session. Let's move on and talk about Ipca Labs. That's managing to hold on to some bit of a gain. But actually what's interesting is in terms of con call highlights, as well as some brokerages, they have increased their target prices. So firstly, in terms of what were the key highlights that came in from the con call, one, this is obviously the branded business of the company that started increasing in terms of contribution that came in. Now they contributed around 50% in Q3 FY26. Improving the contribution by around 400 basis points on a year-on-year basis, quarter-on-quarter basis. Also, that's seen an improvement. India business growth remained healthy. Africa, Latin, as well as Asia geographies for the company has done well. Unichem, the performance is expected to start normalizing in the next 2 to 3 quarters. The company also said that they are evaluating some in-licensing opportunities for GLP-1 as well as US markets. They said that that will also start seeing a recovery, maybe a bit slowly, but in the next 2-3 quarters with new launches coming in, that is where the recovery will come in. Now, obviously, on the back of all of this, Nuvama is maintaining the buy rating. They've increased the target price from 1,610 to 1,750. And do not forget, the company has delivered its strongest margins in almost 4 years. Axis Cap has also increased its target price from 1,480 to 1,610 and raised their EPS target as well. So interesting to keep an eye on. Did see a bit more sharper gain and then came off. Now just holding on to 110 to 2/10% again.
All right, holding in the green, that's positive. Meanwhile, just look at Bajaj Auto. That stock has surged to the high point of trade. This morning, actually, it was a call that, our technical expert on Chartbusters made on the long side on Bajaj. I think it was Somil Mehta who did speak about, that having a long potential in terms of a trade. And now the stock's moved higher at the high point of trade. So good on Bajaj Auto and a lot of these other non-IT stocks as well, which are perking up. Bharti Airtel, for one, has moved to the higher end of today's trading range as well. But a bunch of other stocks which are showing big moves on the back of some news backing them. We do have Ria standing by with that CNBC TV18's list of top stocks.
Well, yes, Mangalam, starting off with Cochin Shipyard first. This one is performing well in trade after being declared as the L1 bidder for 5 of next-gen survey vessels for the Indian Navy. The total order value for this is rupees 5,000 crores. And at the end of Q1 of FY26, the company's total order book stood at roughly rupees 21,100 crores. Moving on to Texmaco Rail, this one is also buzzing on the back of an order win. They have received an order worth around 220 crores from MRVC for the construction, for the railway line construction of the Mumbai suburban railway line, the execution period for which is 36 months. And at the end of Q3, the company's order book stood at roughly 5,660 crores. The last stock that has been buzzing today is TVS Supply Chain. They have signed an MOU with Italy-based ALA Group to enter India's $28 billion aerospace and defense supply chain.
Okay, Ria, thank you so much for that. These are some of the stocks that are moving around in the trading session today. But on that note, we're going to step into a very short break. We'll come back with more on the markets, more stock-specific action. On the other side, stay tuned in. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty continues to hold on to 25,700 levels. 50-odd points uptick as of now for the Nifty 50. But just some flashes at the bottom of the screen that we saw coming in before we went to the break. That was in terms of a CNBC TV 18 exclusive. Sources are telling us that the CEOs of life insurers will be meeting IRDAI chairman on commission rules. The life insurers are proposing deferred commission model, and CEOs propose deferring 40 to 50% of front load commission. So that is some update that we have coming in from this. We are waiting some response on this front, but an important update there. So surely watch out for the life insurer names as well. But let's move on and now talk about the trending segment for today. We have IT that's been in focus for a while. Now, the talk around AI and its impact has been widely discussed for couple of weeks. Specifically, Infosys earlier today announced a collaboration with Anthropic to unlock AI value across complex and regulated industries. Happiest Minds as well spoke in conversation with CNBC TV 18 earlier today about announcing a potential AI partnership soon. Listen in to what they had to say in terms of the AI opportunity. Today, surely IT is the top sectoral gainer. Listen into their word.
There is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
Yes, I would think so, because Anthropic is just one of the options that you have, Claude. And in a short while, you'll see an announcement from Happiest Minds as well, where we'll be leveraging agentic AI platform for helping our customers. But end of the day, if it's, let's say, a Claude or some other agent, it's as good as having a developer. And what companies like Happiest Minds and other IT service companies will have to do is to construct a hybrid model leveraging the coding agents and your physical agents. And I would say that it will be the path that we would be going down wouldn't be revenue sharing, but I would be we would be open to that as well if the upside and the opportunity that we get is more. I think all of us have to be very agile.
All right, that's about Happiest Minds, AI and Indian IT. This conversation, we haven't heard the last of it, and most definitely, the start of something that we will be watching out for over the next few months, definitely after the price correction that we've seen in a lot of these IT names. But take a short break. On the other side, we do have technical experts joining in. Sachidanand Udekar joins in. He will give us some trading strategies in this market. Welcome back. You're watching us here on Halftime Report. Perfect time to get you all the updates from the FNO desk. The market has been doing well, actually. The Nifty is at the high point of today's trading session. And if you look at the frontline indices, it's a function of three things. We have the Nifty, which is doing well, obviously led higher by the IT pack, which is down almost 15% in the previous month and now seeing some bit of recovery from the lows. And the Nifty Bank as well, not doing too bad. Actually, it's up around 0.4%. It's been choppy. The lows have been bought. And the highs is something that we will monitor as we move along, because these two sectors are in focus. They are the ones that are actually capping the gains on the Nifty. Reliance down about 0.8%, a fair weight on the index, and the metals pack as well, down about 1%, 0.15. So that keeps the market in a bit of a range. But be that as it may, the broader market health is a lot better. We have two stocks advancing for every stock that's declining. The India VIX is fairly contained. The India VIX is actually down by about 3%, 4% now as we speak, closer to 5%. That's good news, bulls. And the Nifty is closing in on that 50-day moving average. So yesterday, it went below the 20-day moving average, recovered, conquered, and closed above that level. And today, it is just about 20-25 points away from the 50-day moving average. Conquering that and closing above that would be a good sign for the bulls. Having said that, it is also expiry, so a lot of options are written. So 25,600 put writers fairly active. The premium all but eroded. That tells you that there is support at lower levels around 25,600 to 25,700. But at the same time, I will be monitoring very closely what takes place on the 25,700 call, because it still has 2 crore shares outstanding, 1 crore shares added today itself, a premium of 73 rupees. That tells you that the street believes there could be some resistance around 25,775 to 25,800, very close to the 50-day moving average. If the Nifty conquers that and goes above that, then all these call writers will have to cover their position, and the probability of a melt up in the last hour definitely takes place. But for that, the market has to cross 25,775 and stay above that for that short covering on these calls to happen. So those are a couple of levels that I'll be watching out for. 25,600 at the lower level, 25,775 at the higher level. But one particular pack, apart from the IT pack, which is doing even better today, are a lot of these PSU banks. So fairly well bid on Punjab National Bank, Union Bank, Bank of India. So the PSU bank sector is another one that I'm tracking today.
Okay, Mangalam. Thank you so much for that. PSU banks, IT, and those levels that you mentioned will be key to keep an eye on. But on that note, let's bring on board Sachitanand Utekar, VP Research Derivatives and Technicals at Trade Bulls, joining us on the show right now. Sachitanand, good afternoon. Let's start by talking about IT before we jump to the markets. Your view on the Nifty IT. Last couple of days, we're seeing at least some bit of an up move versus what we saw in the last couple of weeks.
Good afternoon, Vinny. I think we have already seen a very strong, rebound when it comes to Nifty, and in the last two trading sessions, Nifty IT was, missing this particular move. So right now, the way we have seen a rebound in the last two trading sessions, I think the contribution is well set from Nifty Bank as well as Nifty IT. So I think going forward, we are of the opinion that this particular zone around 33,000 looks like a dependable support. If you look at the performance of the last 15 trading sessions, we've already seen a sharp decline in this particular index. And there has been a good, strong turnaround from the oversold zone, which is also supporting the fact that 33,000 support may not be violated on a closing basis. So we are expecting this rebound to extend towards 35,500, 35,600. But when you look at Nifty, I think the performance has been very significant. We have already seen a strong engulfing bullish formation on the daily scale. As Mangalam rightly pointed out, the 50-day exponential moving average is also again getting reconquered. So if you look at the overall setup, the setup looks really promising. 25,400 looks like a elevated floor. And we may see the Nifty, gradually turning up towards 26,300, 26,400, that kind of a range. Even from today's perspective, I think the key level would be that somewhere around 25,760. It needs to sustain above that, and probably we may see a final stretch towards 25,820 during the day. But when we look at the supports, I think the support is very well placed at 25,650. So we are not expecting the index to close below the same. But there's a good probability that we may see higher levels even in today's trading session. 25,660 is the key point. If we sustain there, then probably the closing could be somewhere close to around 25,800.
Right. What do you do on the individual stocks then, Sachi? What pack are you betting on? And on IT in particular, do you think this is just a dead cat bounce, for the lack of a better definition, or do you think something formidable, tradable has happened?
Mangalam, I think the contribution has been very significant. We've already seen TCS Infosys again, lifting the spirits. So I think it doesn't look like a dead cat bounce. Probably we may see a good, strong floor getting set somewhere close to around 33,000. So I am of the opinion that until unless the previous day swing low is holding on, we should stay along with the trend momentum. So as of now, there are no signs of any distortion of this particular momentum, and probably we may see another 1,500 points on the upside. But I think the most significant index right now has been the Nifty Bank. It has been a very strong relative outperformer. Even at this juncture, what we are observing is that there is a good probability that during this particular series itself, the Nifty Bank can scale toward 62,300, 62,600, that kind of a zone. So I think from a trading momentum perspective, Nifty Bank is still presenting a very good trade setup. One can keep a stop loss at 60,920 on a momentum basis, and we may see a swing towards 62,340 in next couple of trading sessions.
All right, take that point. Quickly, you want to give us two stocks, just two stocks?
Mangalam, since we are expecting that the outperformance in banks will continue, both the trading setups are from the mid-cap banks. The first one is Canara Bank. Now, if you look at the overall setup, this is a good fresh sign of short covering. After a while, we have seen the stock sustaining above its 520 and 50-day exponential moving average support, which is placed at 147. If you look at the overall option cluster, 140 was a very strong put writing zone, and on the higher side 160 has been a very strong call writing zone. But if you look at the price structure, it looks like a classic double bottom formation at that 140 level, wherein we are expecting that the trend momentum could help this particular stock to surpass that 160 hurdle, and we may see a confident swing towards 166. So we are recommending building long positions in Canara Bank. One can keep a stop loss at 145.30 on closing basis and review their positions at 166. The other stock is Bank of India. Now here, we have already seen a fresh addition of long positions. There's a classic bullish flag formation on its daily scale. The pattern target on an immediate basis is placed at around 182. Even here, I think any declines towards 168, one should be more aggressive on this particular counter. One can keep a stop loss at 165 on closing basis and trade this particular momentum for a target of around 182 to 186.
Okay, thank you so much for that, Satyachanand, and thank you so much for joining us on the show as well. But on that note, we're going to sip into a very short break. We'll come back with more on the markets, more on stock-specific action on the other side.
Welcome back. You're watching us here on Halftime Report. Let's go across to Yash, who's joining in with his exclusive. Remember, moments ago, we saw flashes on the bottom of the screen where life insurance CEOs will meet the insurance regulator on commission regulations. Yash joins in. Yash.
Well, that was an important meeting which, everybody tracking the sector, and particularly the issue on higher commissions has been looking at. The meeting between the life insurance CEOs and IRDAI chairman did happen, and what we've been given to understand from our sources is that life insurance CEOs in that very meeting to the regulatory chairman suggested the model of deferred commissions when it comes to, the commission which life insurance companies pay on the sale of insurance policy. Now, what has been proposed in terms of specifics, the life insurance CEOs, which have been the representatives of the industry in this meeting, suggested paying just about 40 to 50% of the front-loaded or the first-year commissions and deferring the balance 60 or another 50% to a minimum of next 5 years. What I've been told very specifically by our sources is that the word minimum here is very important, because the deferment of the balance half of the commission, the front-loaded commission, would at least be for a minimum period of 5 years. It could be higher than that as well for about 7 years, 8 years. That will be a part of the final regulations, but a minimum of 5 years deferment has been suggested by the life insurance CEOs. What also we've been given to understand with respect to rationalization of commissions is that the insurance CEOs have suggested that every year they plan to reduce the absolute amount of commissions which they paid from the previous year by at least 10% for the next 3 years. So that's addressing the point on rationalizing or bringing down commissions as well, and not just deferring them. As a development after that meeting, what we've been given to understand is just about 2 days ago, the IRDAI, which is the insurance regulatory body, has asked the industry for very granular data on distributor-wise commission. How much do they pay to web aggregators? How much do they pay to banks? How much do they pay to individual agents? That data for the first time has been sought, and the expectation is that the final regulations in the form of that consultation paper should be out very soon.
All right, we'll wait for that. Thank you so much, Yash, for joining in. And joining us now is Surendra Mehta. He's Secretary, India Bullion Jewellers and Association, to react to that very strong numbers that we have in sense of imports in gold and silver for the month of Jan. Mr. Mehta, hi, thank you so much for joining in. How have you seen the numbers? Because the one reason that we have seen the whole deficit widen is because of those imports in gold and silver.
Well, I agree that deficit has widened, but we must understand that people are moving from the other asset class to the gold, which is now really called a safe haven asset. We have seen number of investors increasing. Almost the investment demand, which was about 27-28% in India, is now 45% plus. That can be seen, also can be seen from a lot of money coming in the gold ETF and silver ETF. So these numbers are just the beginning. I think people are reallocating their portfolio and shifting some of their asset to the gold and silver. And also the new money is being coming as in for investment in gold and silver. But as I said earlier with my earlier interviews, the jewelry sales in organized and unorganized sector is down, but investment demand is higher.
But one more question, and this is really on the kind of imports that we are looking at. Do you see a pattern of this being made right now? Do you think more imports for gold and silver is something that we could be looking at in Feb, March as well? Because usually we see a month of very strong imports and the next couple of months actually see a decline.
Well, I think we might see, a number which is better than last year for the month of February and March, maybe because of the festival season and also because of the wedding season, summer wedding season, which is coming in. Okay. And if we hear any bad news, any geopolitical bad news, then I think gold prices will go up, and that would lead to a lot of early demand for gold even before the summer vacation starts and wedding seasons.
All right. Thanks a lot for joining in, and Manisha for taking us through with that conversation. But it's AI, which is the order of the day. So let's cut across to Shireen Bhan, who is speaking with C. Vijay Kumar, the MD of HCL Tech at the India AI Impact Summit.
Welcome to CNBC TV 18's live coverage here from the India AI Impact Studio. It is loud in here, and I think the message that India's IT services industry wants to send out, which is loud and clear, that it's alive and kicking and ready to take on the AI challenge. Joining me now at the HCL Tech Pavilion is the man steering the company, CVK. Always good to have you here with us. And let me start by asking you exactly that, CVK. February has been a difficult month for the IT services sector, 2.6 lakh crore rupees in market cap erosion since the 6th of February. What is the message that you want to send out to the markets? Is the SaaSpocalypse real?
Shireen, thank you for visiting us here in the AI Summit. It's fantastic. If you recollect, 2 years ago, we did call out as a company that AI is a big disruption moment, and we want to embrace it proactively, right? So none of this surprises us. We looked at how the technology would evolve and really started building a strategy which will future-proof our business. It's about proactively transforming our services as well as building intellectual property which bridges the gap between all the LLMs and reasoning models to how it can be applied in the enterprise world. So the technology is moving very fast, you've seen it, but the enterprise adoption is gradual, and it is rightfully so. Actually, if I want to use an analogy, God created the world in 7 days because there was no installed base. Right? If there was nothing installed, you don't need to worry about compatibility issues, you don't have to worry about data migration and integrations, all of that, right? And there's no bugs to fix. So it's very easy. But in a real world, in a real enterprise, there are so many complex installed systems.
It's not as easy as plug and play.
It's not, absolutely, it's not. And that's where service providers like us, we have a lot of trust with a lot of big enterprises, and we have the context of the enterprise. So along with the large language models and all the reasoning and all of that, and using our IPs, which are all focused on capturing the enterprise knowledge and building a delivery model which will really scale as impressively as how the models and the technology is scaling. That's what we're doing.
No, and you're right that you called this out 2 years ago, and we've spoken about this and your pivot towards a more AI-driven future. But CVK, let's build out the scenarios now, and I want to understand from you, we spoke about this in Davos. Let's start by talking about margins. What should we realistically expect in terms of margins? As the model changes, as billing becomes more outcome-based, as revenue becomes more outcome-based, what should we expect then for margins in the medium to long term?
Of course, the drive is to move towards more outcome-based models. And typically, an outcome-based engagement can deliver a much higher margin because it really helps you to leverage all the technology levers and optimization levers, and it helps you to improve margins.
So you're saying margins can actually improve as opposed to the fear of compression?
Yes, of course. It should improve because there is a big opportunity to convert as much as possible to outcomes. And when you do an outcome-based model, there is a little higher risk, but there is higher reward as well. So if we can play that equation well, I think there is a potential for the margins to improve.
So how much of the business is now moving towards this outcome-based model as you speak?
Today, we have more than 50% of our business is already in some kind of outcome model. But eventually, it's going to move to an ultimate business outcome-based models. So I think we'll move 3 to 4%. We want to move a lot of our large engagements into more outcome-based models, and that also gives us a lot of flexibility in the talent deployment, where we deploy, what technology we use, and that kind of we take on a lot of responsibility. And that's how we will get rewarded as well.
The other question then, CVK, is being asked, what happens to growth in the medium to long term? Are we talking about sustained low single-digit growth? Are we talking about slightly better? Or are we talking about no growth at all for the industry?
Yeah, okay. First of all, I mean, we've been the fastest growing company for probably the 4th year in the running. So there is going to be deflation in the existing business, especially a lot of application development kind of business. And we do have a meaningful chunk of applications business, while a lot of our business is in engineering services or software or infrastructure services. We do have some components which can have a much higher deflation potential. So we believe there will be 2 to 3% deflation at an overall level because of AI. And this is something we've modeled. But there are at least 5 mega opportunities that we are chasing, right? AI factory, it's $1 trillion capex will mean at least $100 billion of services spent, and at least a couple of $1 billion we should be able to get from that. Physical AI is again another big opportunity. The whole agentic implementation. See, there is a huge legacy install base. Modernization of this is again a big opportunity. And for modernization, you just need to be in the enterprise. You just need to understand each enterprise's uniqueness. And we are very well placed to adapt to that. And so that's why we've called out advanced AI revenue, which is really focusing on the newer revenue streams. While our existing business will continue to grow because there is still a big market, right? IT services is a $1.5 trillion market. I mean, we are 15 billion, our industry is only 200, 300 billion. So there is still, if you have a very sharp proposition which can make an impact, you can gain a lot more wallet share. And that's been our strategy as well.
You know, you had given me a number as far as your advanced AI revenue is, and where do you see that on the back of what you're seeing now, since we last spoke, which has barely been a month and a half, but there's so much that's already changed. I mean, on track to be able to deliver to that number?
Absolutely. We had called out about $600 million annualized revenues, advanced AI. And once again, this is different from regular AI revenue a lot of companies are talking about, because regular across the board, we need to use AI to change everything that we are doing. And that we don't call out as AI revenue. It's the IPs, it's the new solutions. That's what we are calling out. And I think it's 4%, and I think it can be a very powerful growth driver. It has grown 20% quarter on quarter. And we think it can get to $2.5, $3 billion, much more than offsetting some of the decline that can happen in the existing business. And existing business also, there is a big market still. And if you have a sharper proposition, a platform-based agentic IT services delivery model, I think there is an opportunity to gain a lot more wallet share.
You know, speaking of the road ahead, we've seen a bunch of partnerships being inked this morning. Infosys and Anthropic announcing their partnership. You've got a partnership with OpenAI. Are we going to see a lot more of this, of Indian IT services companies like yours building or forging more partnerships? And take us through the OpenAI partnership.
Yeah, we were the first to announce the OpenAI partnership. It's already a lot of our products that we're building is on top of OpenAI. And I'm sure, I mean, Anthropic is again a fantastic technology, and we will continue to look at partnership opportunities and evolve. And it's very much like the hyperscaler ecosystem, where we had to leverage the hyperscaler technologies to deliver services to our clients. And it's going to be the same playbook again.
Will Indian IT services be a lot more acquisitive? Will you be forced to be a lot more acquisitive in this environment?
Acquisition, yes, but more than acquisition, it's really bringing the best AI talent into the company, right? I think whether we can acquire it, whether we can hire, we also need a very strong product and a platform mindset, which is not the traditional bread and butter of the services companies. So I think that is the transition all of us will have to navigate, and we are well in the way.
But speaking of transitions, I know the big bet that you're making on physical AI, something that you're a big believer in, but also the AI full stack, what HCL is working on and has put together. We've got one of your dogs that are walking around the pavilion here. So how big of an opportunity is this going to be?
Physical AI is a $1 trillion opportunity. I think he's saying yes.
he is saying yes.
So the reality is physical AI is really about using AI in the physical world, sensing, decision-making on physical objects. Like this robot, the dog, can go into the plants, which can be very dangerous for people to look at oil spills and things like that, and integrate that into the back-end SAP system, right? And similarly, we have the Vision X solution, which is about safety in ports. This can be applied to a number of industries. So we already have at least 100 million coming from physical AI of the 600 million. We think it's again, it can build into $1 billion revenue for us, and we are fully working towards that.
So let me end then by asking you, CVK, you know, fears of obsolescence for the Indian IT services sector, the SaaSpocalypse, as I spoke about, overdone, exaggerated, and you believe that industry has enough ammunition to fight back?
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption, and if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen in a manner that it works for all stakeholders.
How comfortable do you feel about HCL's position as you make this transition?
We are undisputedly ahead of everybody else. I mean, we recognized it much before, and we put our plans, and it's definitely showing up in the way we are growing. In spite of deflation, we are continuing to be the fastest growing company. And I think with all the propositions that we have a very good shot at being a winner in this.
Well, we wish you the very best of luck, CVK. Yeah. Always a pleasure. Many thanks for joining us here on CNBC TV 18 at the India AI Impact Summit. Well, you heard it from the man himself. They are fighting back. They're aware of the challenges, but they also want to focus on being able to leverage the opportunities, and that's the capability that HCL Tech is building at this point in time. We will take a break here, but the conversations will continue. Don't go anywhere. We're back in a moment on CNBC TV 18 with plenty more.
Thanks so much for that, Shireen. An interesting chat there for coming in from one of the IT companies, HCL Tech, talking about AI as well. But let's move on and also actually CleanMax IPO. That's going to be opening on 23rd of February. The company owns renewable energy plants, solar and wind, and sells 100% of electricity through long-term contracts directly to corporates, customers, and has set a price band of 1,000 to 1,053 rupees per share. My colleague Reema caught up with Kuldeep Jain, CMD at CleanMax, and began by asking about the company's profile. Listen in.
CleanMax owns renewable energy power plants, both solar and wind power plants, and we sell the power so produced, 100% of it to corporate customers. This is different from most listed utility companies who sell most of their power to power distribution companies. We go directly to the consumers who are large corporates.
And 78% of your overall revenues comes from directly selling power to these corporate clients. And 22% of it is sort of services EPC kind of business. Is that correct?
That's right.
So who are your top corporate clients?
So we sell energy to the largest companies. So 85% of our energy sales is to clients credit rated AA, AAA or multinationals. Within that, AI infrastructure is a huge segment for us. As of December 25, 43% of our contracted capacity was for data centers and AI companies. And some of our largest clients are the big tech such as Google and Amazon and Meta and Apple and so on. And the other 57% is to large corporates who are seeking to both reduce their power costs and go green. So, twin benefit, reduce your power costs for doing the right thing, which is lowering your carbon footprint. And therefore, this has been a very high growth business.
And your market share in this CNI segment, commercial and industrial, would be?
So CleanMax is India's largest CNI player. We have about a 12% all India market share.
Okay. So now just looking at your financials, Kuldeep, FY23 to FY25, on a CAGR basis, your revenue growth is 26%, but EBITDA growth is 58%. What explains that?
So in our industry, the EBITDA growth is the more relevant number because we have two segments. First is renewable energy power sales. And that's a 93% gross margin business. So, if you have 100 rupees of revenue, you have 93 rupees of gross margin or about 85, 86 rupees of EBITDA margin on 100 rupee of revenue. Then we also, if corporates want to own their own power plants, we would also build it for them, which is the corporate EPC segment of our business. There, the margins are 15, 16%. So, the energy sales has grown faster. And therefore, the EBITDA growth, which is the relevant metric here, which is the profit before interest and taxes, that growth has been 58% for the last 3 years.
Now, renewable energy is a very capital-intensive sector, and you own your own energy assets, solar, wind, hybrid, etc. What is the leverage on the books and the key leverage ratios? Debt to EBITDA?
Sure.
Interesting. Go ahead.
Sure. So you're absolutely right, Rima. It's capital intensive, and therefore capital productivity is important. Like how much capital did you have to put to work to earn a rupee of EBITDA? So CleanMax gross block to EBITDA, which is how much money we put in for every rupee of EBITDA, is about 5.8 times. But for renewable energy peers, listed peers, that number is about 7.5, indicating that we have about 28% superior capital productivity. Secondly, on leverage, we're also conservatively levered at about 4.8 times net debt to EBITDA. The industry median is about 5.6, 5.7, something like that. So we are conservative on leverage compared to peers, and the key ratio is about 4.8 times net debt to EBITDA.
And what is the absolute debt number?
It's about 8,000 crores.
Now let's talk about your expansion plans. You currently operate 2.5 gigawatt of capacity, and you have an additional 2.53 gigawatts of capacity under contract. So when do these incremental capacities come on stream? When does it become operational? And considering that you have so much capacity, can we assume that the past EBITDA growth rate of 58% can continue in the future?
Thanks, Rima. So as of December 25, we have 3,100 megawatt of built capacity, like it's operational, and another 2,900 megawatt contracted. So it's interesting that it took us about 15 years of existence to get to 3,100 megawatt built, but at the same time, we have 2,900 megawatt contracted, which should be by contractual obligations slated to come on stream in the next couple of years. So obviously, on a base of 3,000, if you're adding 3,000, that's very high growth, continued for a few years.
But what's the timeline for commissioning this? Next few years is what? Like 2 years, 3 years, 4 years?
Next 2 years.
In the next 2 years?
Yes.
And with aggressive expansion plans, is it fair to say your leverage again goes back up even after bringing it down?
I think the way we look at it is that the net debt to EBITDA ratio indicates the ability to repay. And in our business, we have 23-year-long power purchase agreement. So in renewables, you do have a typical net debt to EBITDA, if you look at industry peers, also of well above 5. We've been below that. That's justified because there's cash flow supporting that. There's typically 17, 18-year debt against a 23-year power purchase agreement. That's the nature of our industry.
Okay. You turned profitable in FY25 after making losses in the prior years?
Yeah, so in our business, everyone looks at it as a cash ROE metric, which is what is the cash returns divided by cash equity invested. And in the last year, we had about 18% cash ROE.
So as solar prices come down, and these are long contracts that you've entered into, PPA, is there not a risk that one of your clients says that, the price that I've contracted with you is too high, I'm getting it in the market on the spot at a much lower price, and therefore they terminate your contract?
So corporates prefer everyday low predictable prices.
Even if there is a sharp drop in the prices?
Even if, you see, because for if you sell goods, so, suppose you're an exporter or you sell goods, you want to have low and predictable costs. If you buy on the merchant markets, someday it may be very low, someday it may be very high, and then now suddenly you have a challenge as a corporate in terms of your cost of goods. Therefore, the way the industry functions, it's on average a 23-year power purchase agreement. And yes, corporates are also growing. So if the price of electricity comes down, they'll sort of buy more for their ever-growing needs and sort of average their costs downwards. But I'm happy to report that we have over 1,500 power purchase agreements, and there's not a single corporate dispute.
All right, that's the commentary coming in from the management of CleanMax. The IPO opens shortly. That's the IPO corner. With that, what we'll do is wrap up on this edition of Halftime Report with the news that the market's holding fairly in the green, with the Nifty Bank up 200 points. We'd give it to the team of Business Lunch to take all the market action ahead. Thank you for watching.
Stocks perk up, led by a rebound in IT counters as local majors stitch tie-ups with global AI leaders. PSU Banks, FMCG and industrials are the other prominent gainers going into F&O expiry on NSE today. Infosys inks a strategic collaboration with Anthropic to bridge the agentic AI and complex enterprise gap. The duo will develop AI-powered solutions for key sectors, starting with telecom. Other IT players like Happiest Minds are looking at similar arrangements to accelerate AI adoption in enterprises. Infosys chairperson Nandan Nilekani emphatically states that there is no opportunity gap with AI and the opportunity is bigger than ever before. He adds there will remain a need for talent, but the roles will change, posing a big reskilling challenge for organizations. India's chief negotiator is expected to visit the US next week for talks on the trade deal, which could be signed in March. India will pursue the reduction of duties from 25% to 18% across product categories in the upcoming talks. India's goods trade deficit in January surges 48% from a year ago to over $34 billion due to threefold jump in gold imports to over $12 billion. However, a 26% rise in services exports kept overall trade deficit at a modest $10.4 billion. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Good afternoon, guys, and it is a good afternoon for the markets as well. As you can see, the Nifty holding well above that 25,700 mark, about 0.2% in the green. Sensex also doing well. Mid-cap index also gaining in line with the blue chips. The Nifty Bank also the same, 0.3% in the green. And, you know, as we've been saying, it's because of the IT index, which is up nearly 3%. Big recovery from last week's 8% fall. Infosys, HCL Tech and Wipro, all of them gaining between 2 and 4%. Obviously, the commentary coming in from Infosys about AI has boosted all of these stocks, and all of them are gaining in trade today and are the top Nifty gainers. PSU Banks, that's the other index that's also doing well. Bank of Baroda, PNB and Union Bank, all of them rising over 3%. However, with the fall in prices of precious metals, it's that metal index which is feeling the heat. It's in the red and is the top losing index. Hindustan Copper, SAIL, Hinzinc, all of them falling between 2 and 4% in the red. But as I pointed out, it's the IT stock that's on our radar. IT stocks surged as Infosys announced an AI partnership with Anthropic and lays out a roadmap for the AI opportunity. Reema Tendulkar is here with all of those details. Reema?
Thanks so much for that. So as you rightly pointed out, we are seeing a rebound in stocks, and this comes after stocks had seen a one-way fall. But even the Infosys Investor AI Day has allayed some concerns. So Infosys Chairman Nandan Nilekani has pretty much reassured investors it's not that companies like Infosys are missing out on the AI opportunity. He said that there is no opportunity gap. The opportunity is bigger than ever before. The risk lies not in opportunity, but in execution. So therefore, you still have to ask the question, what is your company doing to take advantage of this new world of the AI world? And you keep hearing about how agentic AI, you can get the work done in half the time, in less than half the time, with less than half the engineers, to which he said that technology is evolving at a faster pace than enterprise deployment and adoption. He said it's easier to gain productivity gains for an individual task at a project level. But to get productivity levels at an enterprise level, at an organization level, is very complex. So there is a difference between the task level productivity, what he calls greenfield, that you see when these companies like LLM make the announcements, versus what is actually happening in the enterprises. And for the first time, Infosys has also quantified the, in a way, the total addressable opportunity, the TAM. They said the AI-first services opportunity stands at $300 to $400 billion by 2030, and they have identified 6 emerging AI pools to capture that. And as you rightly pointed out, the other big development is that many of these companies are now expanding their partnerships. So Infosys tied up with Anthropic, which will help Infosys build AI-first enterprise solutions. Yesterday it was TCS and AMD, which is more in the compute and hardware ecosystem. And I suspect we will keep hearing more and more of these technology partnerships.
Absolutely. Thank you so much for those details, Rima. And as you pointed out, Infosys earlier today announced a collaboration with Anthropic to unlock AI value across complex and regulated industries. Let's listen in to what the IT giant had to say about the AI opportunity.
There is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk. It's an execution risk.
The legacy modernization piece, this is a massive, large opportunity that we are seeing. In addition to customer service, one of the largest opportunities, where we are essentially taking large legacy organizations. We'll actually share a couple of examples of this, of the work we're doing at scale, and bringing them away from the legacy landscape into the modern landscape. Physical AI is something quite new, where AI software is embedded into devices, and that is becoming a growth area because everything will have AI built into it. And then AI trust, which is both about the trust and cyber, but it's also about responsible AI, which is something where Infosys is leading in making sure that things are built with a view to keep responsibility in mind in the scaling of IT systems. There's a huge opportunity. The one that I mentioned, the 6 areas, with an external analysis, we understand that the opportunity is between $300 and $400 billion in the year getting to 2030. So over that time frame, at that time in 2030. At the same time, we have several entities have made estimates. We have our own views. The AI productivity leads to compression in IT services. However, today we have a clear view that the opportunity is massive and large, and that will become the driving force of what we will grow and drive through in the next coming years.
Artificial intelligence remains in focus with the second day of the India AI Impact Summit currently underway. The summit so far today has featured conversations with key stakeholders, including software companies like HCL Tech and policymakers like IT Minister Ashwini Vaishnav, who believes that India can get investments of up to $200 billion over the next year itself. Listen into his comments.
Real-world solutions at population scale and global consensus on what is the right use, what is the good use of AI.
At this point, sir, in the days you've been having multiple conversations with the media, with stakeholders. There was a lot of indication that there's growing interest here in India. We've already seen big investments. Can we expect some more in the course of this week?
Given what we have heard from the global industry, both from the infra players as well as from the VCs, over next 1 year, we are likely to get about $200 billion worth investment.
We have had the opportunity to visit various pavilions, including some Indian AI companies. We're expecting big announcements in terms of sovereign tech, in terms of sovereign tech capabilities.
Our sovereign models have been calibrated and tested on various parameters. And on so many different parameters, our sovereign models are proving to be better than many of the global best. And the effort that has gone in, the innovation that has gone in, has really proved to be successful.
A lot of conversations, sir, have also started talking about AI and what it means in terms of disruption for the IT industry, for jobs. I remember you also mentioned it at the time of some of the investments that were being made. How are you looking at this conversation? Do you see that unfolding here at the part of the AI Impact Summit as well?
We must be cognizant of the real challenges that we have to face. And to face this challenge, we must upskill, reskill, and create a new pipeline of talent For this, the industry as well as the government and the academia, three of us are clearly focused on getting the right skilling, upskilling and reskilling and the talent pipeline to be created for that.
And one final question, sir, one message that you'd like to leave. A lot of big faces are expected here. The likes of, we have Sam Altman, Dario Amodei, Sundar Pichai. One message that you'd like to leave the big tech community with as they depart from New Delhi at the end of this week.
India will play on front foot on all the 5 layers, full AI stack.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back to Business Lunch. India's trade deficit hit a 3-month high, and the big culprit, besides falling exports to the US, was the very high gold imports. Gold imports rose 3 times over year-ago levels, and Lata Venkatesh is here to decode that data for us. Lata?
Yes, the trade deficit has come in at $34.5 billion, which is a 3-month high. We did even worse in October, when even more gold was bought because of Diwali. Now, the January import figure was 20% higher year on year, but the export was flat at about $36.5 billion. So that's why the trade deficit was high. The import was high at 20% because of gold. Imports came in at 12 billion, which is more than a 3-fold jump over year-ago level. Year-ago January, we imported only $2.7 billion of gold. Now, why was this gold imported? We can guess now. If you remember last week, the AMFI data, Association of Mutual Funds data, said that the total amount of ETF inflows into India is in January equaled that of equity flows, now some 24,000 crores. Now, ETFs have to be backed by physical gold to some extent, and probably that contributed to the very high gold imports. Among the other names that we should know, engineering exports did very well. And shockingly, electronics exports, which we thought were untouched by tariffs, were actually flat. We hope it is a one-off. Among other things, textiles did badly, again because of US, and marine exports did well. They have diversified in spite of the US tariffs. To give the full April-Jan picture, April-Jan exports are up 2.2%, but April-Jan imports are up 7.2%. However, what we must know is services exports are up about 26% in January alone. And therefore, the overall deficit is not very high. I forgot to mention, US exports are down about 22% in January. But if you take April-Jan, it is still up by about 6%.
All right, Lata. Many thanks for explaining that data to us. But let's shift our focus to the bond market. Manisha Gupta joins us now on why bonds are under pressure and upcoming corporate bond issues. Manisha?
Well, the bond markets have seen most government bonds actually trading on the lower side, and this is because traders have placed short bets on the gilts. Though the investor demand for the high-yielding US securities has still been on the stronger side. 379 billion rupees is what the state bond auction is about today, and most of the market really seems to be making way for this money therein. Interestingly, also, the paper maturing within 10 to 20 years is getting bid higher due to lucrative yields that it seems to be offering therein. And then apart from that, there are a lot of issuances that are coming in this week as well. This is from the Indian private placement market, and I have a list that I have collated for you. You have ECAP equities, which is looking at 2.75 billion. This is through April 23rd, 2029 bond therein. The bidding for this one is today. Akara Capital Advisors Private is another one on the list. 2.3 billion is what they're looking at, and this is via 3 bonds reissue. And then you have Incred Financial Services Private Limited, Services Limited rather. They're looking at 600 million. This is via 14th August 2028 bond as well. Bidding for this one also is, by the way, today itself. And then there are some of these companies which are coming in for bidding tomorrow and for the rest of the week as well. Moneywise is for tomorrow, financial services that is, and they're looking at 250 million. This is via 2-year bonds. There's REC Limited, which they are in the market this week for 30 billion. This is via Feb 2028 bond therein. Prestige Estate, we've been talking about that one for some time. They're coming in for 20 billion of an issuance. This is happening via NCDs. And then you have JSW Steel Board coming in for 50 billion via NCDs yet again. We have Torrent Power Board, which has approved 30 billion rupees of issuances via NCDs. Axis Bank has seen board approval coming in for 350 billion. They are raising this money via debt. And then you have Poonawalla FinCorp. They're looking at 10 billion via NCDs as well.
All right, Manisha, many thanks for those details. But on that note, it is time for us to head into another short break. But more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. French President Emmanuel Macron has arrived in Mumbai for an official visit from February 17th to the 19th at the invitation of PM Modi to participate in the AI Impact Summit. Maharashtra Governor and Chief Minister Devendra Fadnavis received the President and First Lady Brigitte Macron late last night. Later this afternoon, PM Modi and French President will hold bilateral engagements at Lok Bhavan in South Mumbai and then will inaugurate the India-France Year of Innovation 2026 and address a gathering of business leaders, startups, researchers and other innovators from both countries. And let's take a check of where the markets are at. Still holding in the green, both the Nifty and the Sensex, 0.3% in the green. And the Nifty holding above that 25,700 mark. It's at about 25,750 as we speak. The mid-cap index also rising in tandem with those blue chips. And Nifty Bank doing slightly better. And if you take a look at the advanced decline ratio, we've got 1,977 stocks gaining for 953 stocks that are falling. And if you take a look at the sectors that are doing well, we've got that IT index, which is gaining nearly 3%. And that's a big recovery considering the 8% fall that it saw last week. We've got Infosys, HCL Tech, Wipro, all of them gaining in trade. Infosys is the top Nifty gainer. So we've got that stock is gaining over 4%. The other index that's also doing well in trade are those PSU banks. But before we end the show, let's cut across to Shireen Bhan, who's speaking to Jeetu Patel of Cisco from the India AI Impact Summit.
Hello and welcome to CNBC TV 18's special coverage. We're live from the India AI Impact Summit. I'm Shireen Bhan. A lot of the conversation so far has been focused on what AI can potentially do, how disruptive is it going to be, but also how transformative will it be in the long term. To talk to us about Cisco's plans with AI and for AI, joining me now is Jeetu Patel. Jeetu, always great to have you. Thanks very much for joining us here on CNBC TV 18. You know, let's start by talking about what we're seeing happen today. The tech has clearly accelerated at a much faster pace than anyone expected it to, but adoption is still patchy and it's lagging fairly behind the advancements that we're seeing on tech.
Yeah, so firstly, thank you for having me on the show and welcome to the Cisco booth. So if you take a step back, what's happening in AI right now? We're moving from this first phase that was around chatbots intelligently answering questions to now agents being able to conduct tasks and jobs for us fully autonomously. And if you think about the big structural shift that's happening, it's important to take a moment and actually reflect on it. It's not just about using this as a tool for productivity. These are digital co-workers that are going to be augmented to our teams, and they'll actually be part of the team in the way that they work.
Digital co-workers.
Exactly.
Yeah.
And it's going to get, it starts with knowledge work, but then as physical AI and robotics actually starts to pick up, you will start seeing this in every sector where you'll actually have additional capacity getting augmented to what we currently have with the human corpus. And what that allows us to do with the human corpus of knowledge is making sure that we can continue to go out and solve problems we could never solve before. Now, going back to your question on, the capability overhang is real. There's the ability for the exponential curve continuing on these innovations is very rampant, but organizations take a while for the absorption rate to actually catch up. So this is the one, in 2026, what we want to see is absorption rates of organizations start to catch up with the pace that AI is moving at. And you're now starting to see that in certain areas, like for example, in coding and development.
Right.
We are now seeing a tremendous amount of progress being made over there that we would not even think possible 6 months ago. And you'll actually start seeing that in multiple different industries.
Well, speaking of the changes that we're seeing in the way that companies code, let's talk a little bit about what you're doing. You have your first product, which has been entirely built by AI out in the market, and you expect, what, half a dozen more?
Yes, Shireen, this is actually funny because a year ago when we would talk about this, people would think we're crazy, saying that this is going to be an area where we will start seeing AI build products almost entirely. And now what you're seeing is not just Cisco, but Claude Code is being entirely being built by Claude Code, and Codex is entirely being built by Codex. We were lucky enough that we were one of the first design partners of Codex, several months ago. And what we were able to do is really start thinking about the workflows that a developer actually uses, getting completely rethought. So today what we have is 100% of our code in a product called AI Defense, which is a safety and security product, that is now being built with AI. And you're absolutely correct. Our goal is to make sure that we have at least a half a dozen products by the end of the year. But over time, it's not just the fact that they're being built by AI. You'll actually be able to solve problems and build the kind of code that's way better than what just humans could do. But the question that then comes up is, what do engineers do?
Yeah, exactly. What happens to humans?
And so, firstly, syntax is only about 20 to 30% of the job of an engineer. How you think about what products to build, are they going to be relevant for the market? Are you going to make sure that you drive a level of rigor in the thinking of it? That's an area that humans are still going to be very valuable at. So the goal is going to change. You're going to move from
So how are you reorienting your teams already?
We're completely changing the workflow. So the way that we used to think about building these tools and code was engineers would basically be writing code, and that became the bottleneck. That is no longer the bottleneck, but reviewing code is definitely going to be a bottleneck. Identifying and applying human judgment to what specific products to build is still something that you're going to need humans for. But what you now have is aided capacity. So if you had a certain number of workers, engineers in the world, that's going to compound in volume. And as a result, you'll have much, much more software. But you have to make sure that you keep in mind that AI slop can't be a natural byproduct of it. You have to make sure that you build good quality software for the market.
When we talk about agents and the concern and the worry is, are there enough guardrails in place? We do already have instances of agents going rogue. I mean, that's a problem you're trying to solve, but how worried are you about that?
Well, see, firstly, the blast radius used to be that an AI is going to give me the wrong answer. That's no longer the blast radius. The blast radius now is AI going to take the wrong action, which has a far greater consequence than just give me the wrong answer. So what we have to do is take a step back and say, what do we need to do in every single systematic way to fundamentally rethink every role that a company has within an organization? The workflows have to change. If you just use this as a tool for productivity, you're going to get marginal improvements. If you think about this as an augmentation to your capacity planning model, you will see a very, very different kind of outcome.
The CapEx.
You want to talk business? Meet me in the onboard lounge.
It's Midcap Radar that you're watching. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Vinny Motiwala. Good day for the bulls. The Nifty holding around 25,750, backed by the IT stocks, and the midcaps. They're on fire right now at an index level, up 1/3%. But individual stocks, the advanced decline ratio tells you that far more number of stocks advancing than the number of stocks which are declining. So that's the crisscross lines that should come up for you. No crissing or crossing today. The green one firmly above the red one all through today's trading session. Hi, Vinny.
Hi, good afternoon, Mangalam. But in terms of IT pack, that continues to shine in the trading session today, trading with gains of more than 1.9% as of now. And not only just large cap ITs, but even the smaller cap, mid cap IT names, they are doing well. They'd seen a sharp fall last week and the week before that. But now they're also back. Look at Nugent Software, Sonata Software. We have Intellect Design also, which is managing to hold on to gains. So that is managing to hold on to very good gains. FMCG also is another sector that's managing to hold on gains of around 0.6% in the trading session. But let's move on. And in our segment, Mid Cap Movers, we have Sudarshan, who's here to take us through those mid-cap names that are moving around in the trading session. Good afternoon, Sudarshan.
Good afternoon, Vinny. So what was a concern till yesterday? Now today it seems to have boost, and that's the AI for you, and that's helping, that's lifting some of the stocks. You can talk about Nugent Software. Yesterday the stock was at 52-week low. From that level it has moved higher. Fractal Analytics that listed yesterday, it was a muted listing, but today that stock is higher as well. Affordable Robotic and Automation, this stock is trading with healthy volumes and up more than 6%. And last one is e-solution player, that is Unicommerce. That stock also moved 18% higher. Now, some of the other mid-cap movers that are trading with healthy volumes and on the back of news flow. First one is Indo Farm Equipments. The news flow is promoter has increased the stake to 70% from the earlier level of 68%. That's the reason you are seeing a big move. Praj Industries, there was a positive brokerage note. Prabhudas Leeladhar has given the target price of 340 rupees. That's this stock has seen an up move. Sterling and Wilson has been moving higher for the last few trading sessions on the back of expectation of order wins. Galaxy Surfactants has moved higher on the back of positive commentary. Management was on our channel today in the morning, and they are expecting a recovery in North America business. That's the reason that stock is higher. And SMS Pharma has hit 52-week high and trading with healthy volumes. But there are some of the stocks which are under pressure. First names Quality was yesterday. That stock listed after the demerger from Hindustan Unilever, and yesterday also it was muted against the adjusted price of 40.30. Today also this stock has moved lower 5%. GMDC trading with a cut of 4.5%. Ola Electric continues to move in one direction, that is downside. Today also this stock is down 2%.
Right, Sudarshan, thanks a lot for that. A bunch of stocks that are moving around more in the green than the red. Interesting AI-related names or tech-related names that you picked up out there as well. We take a short break, come back. Speaking about tech and IT, the IT sector which is doing well, we'll get a technical word on how that is likely to move on. Shrikant Chavan of Kotak Securities joins in.
Fly Emirates, fly better.
Welcome back to Midcap Radar on CNBC TV 18. Now, let's welcome on board Shrikant Chauhan of Kotak Securities as well to give us a check in terms of the market on the technical front. Shrikant, good afternoon. Thank you so much, as always, for joining in. Today, while we're seeing a bit of an up move coming in the trading session, 50 points as of now, 25,700 odd is what the Nifty is holding on to. What are the levels that we're keeping an eye out on given its expiry day? And what is the key takeaway even for the Nifty Bank?
Good afternoon, Vinny. Good afternoon, Mangalam and everyone. So for Nifty, it is sustaining well above the mark of 25,500, which is positive. But at the same time, 25,800 is also acting as major resistance for the market. Until the market is not crossing this, we can expect range-bound sort of activity in the market. But today, on the day of expiry, if we see the market is crossing the level of 25,800, then certainly we can expect further more activity in the market. And in that case, the market may again try to move towards 26,300, fair 400, where the market is having multiple resistance. But for the time being, 25,800 and 25,500 is the range in which we have to design our trading strategy.
Shrikant, you spoke about the Nifty Bank. What's your thought on the IT index? What do you make of the recovery today? Do you think it's bottom formation, or do you think it's just recovery after oversold levels?
Yeah, I think it's a bounce back that we are witnessing, because the sell-off that we witnessed, it was much, much sharper than the expectations. On the day of trade deal, we saw the highest high, and on Friday, the market, I'm going to say the IT index was completely down. So now the rebound, the rally that we are seeing is just a pullback to the sell-off that we saw. Sometimes what happens, 40%, 50% of the difference, market try to retrace. So in this case also, we are expecting Nifty IT index can move up to 34,000 in the near term, but that will be we can say just a pullback, and it will take some more time. We are not expecting V-shaped sort of recovery in the sector. So it is advisable to buy if there is any correction in the market instead of taking any aggressive bet at higher levels, or rather it is advisable to take some profit or reduce some exposure at resistance levels.
All right, take that point. Just before we come to you for individual stocks, pull up the intraday chart of SRF. The stock's now moved into the red from green terrain, and that's largely because of the commentary that has come in right now on the exchanges, where the board of directors of the company have approved a shareholder sale through their holders, basically promoters. Kama Holdings will sell about 3% stake in the open market for of the company, and this sale would likely to be completed by March, as a result of which the company's shareholding in SRF Limited will fall from below 50%. So obviously, the fear of additional supply coming in, even though it's 3% and in the open market, has caused a bit of a drop in the stock price, down about 1.5% on SRF, as the promoters are likely to sell 3% in the open market until March. But Shrikant, come back to you on individual stocks. What are your top picks right now, and on what side, long, short?
No, I think the way the market is stabilizing, we should look for adding those sectors or indices, stocks where there is momentum and where there is a trend. So for PSU banks, we are witnessing good amount of buying attraction. Most of these stocks have again regained their immediate losses, and most of these stocks have crossed their important resistance levels, like Union Bank. So there also we have a bullish view. We are expecting this stock to move towards 210 or 15. Currently, it is around 189, 190 sort of levels. So it's a buy at current levels with a stop loss close to 184. The other sector on which we are bullish is metal basket. And from that, we like particularly steel stocks. So there also, we have a bullish view on Jindal Steel and Power. Currently, it is around 1210. There also, we are expecting 1300 sort of levels. We can keep a stop loss somewhere close to 1180, 1170.
All right, Shrikant, thank you so much for joining in and giving us your stock ideas, tech ideas, as well as view on individual indices. In fact, with that, we are entirely out of time on this edition, shortened edition of Midcap Radar. But you stay tuned to CNBC TV 18. The Mutual Fund Corner comes up when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, the trend that has been in the last couple of weeks is IT. We've seen IT sector fall. But what do you do with your mutual funds, right? Because just a disclaimer, you do not look at Nifty IT returns normally for mutual funds on a one-year basis, but this is just for talking about how you should, act when your fund is underperforming. Now, look at the returns on your screens that are coming in for you. On an average, the technology funds or IT sector funds that are there, mutual funds, they have underperformed on a YTD basis. Overall, even for 3-year basis, there is some positive return, but otherwise, especially YTD, a sharp fall that has come in. Now, in terms of overall, which funds have underperformed? I've just given top 3 names. We have ICICI Prudential Tech Fund in the last 1 year. That's down almost 9%. Tata Digital is down 12.8%, as well as Aditya Birla Digital Fund. That's down almost 9% as well. 3-year basis return, if you look at it, they're still managing to hold on to good gains. So on a long-term basis, when you're making these investments, it's not a concern. But in the short term, if your fund is underperforming, what should you be doing? How should you go about the strategy? Should you shift? Should you continue to hold? To talk to us about all of that, let's bring on board Vineet Nanda, who is the Managing Director at SIFT Capital, to talk to us about all of that. Vineet, good afternoon. Thank you so much for joining us on the show. Let's start by talking about the trend for IT sector in 2026. Funds have also underperformed. Now, sometimes investors panic and they ask, what should I do with my sectoral fund? How should I, adjust it? Should I continue to, invest in it? Should I pause? Should I diversify to equity funds? Vineet, what is your view and suggestion here?
Good afternoon, Vineet. Thanks for having me on the show. Typically, the core strategy for investors should largely be to invest in diversified funds, because in a diversified funds, the fund manager has the ability to rotate sectors, has the ability to go underweight or overweight on sectors, do stock rotations based on incremental opportunities. But people who are investing into tech funds and whose SIPs are already going on, now, if they've taken these exposures based on a certain long-term portfolio allocation, then it's better to continue the SIPs, because currently the valuations of the IT sector is basically at a pre-COVID level. The second thing is that, see, last year, money has largely gone globally into more AI-related countries, AI-related stocks, whereas anything which is non-AI related has typically relatively underperformed. But the fact remains that, the threat from AI is in terms of improving productivity, but at the same time, our IT companies are positioned to also look at use cases of AI and see how to kind of pivot themselves to continue to be value additive for the client you're working with. So my sense is that if you have done an allocation to the IT tech funds based on a certain asset allocation, then just because last 1 year have not been great, at this point of time, looking at last 1 year performance, stopping your SIPs will be actually counterproductive to the long-term portfolio returns.
Vineet, I just want to know that, is pausing an option? Should one look to pause sometimes, or maybe pause and then restart, keep on hold? Is there anything as an option that is available?
Sure. So absolutely, there is the ability to be able to pause or stop your SIPs for any amount of time. But the pause decisions should be taken when you believe that the valuation of the sector that you're investing is expensive, and therefore it's not the right time to invest money. But pausing an SIP at a time when actually that particular sector or fund is actually going through a low phase is actually going to harm your long-term returns per se.
Yeah, the averaging the play for averaging doesn't work out then for you if you're stopping it at that time, right?
Absolutely. So it's like, stopping small cap SIPs probably a year and a half back when the valuations were, Ps were in excess of 40 probably was a wise thing. But, doing the same thing when value is cheaper basically then does not help your long-term returns.
Vineet, what's the ideal portfolio allocation maybe one could have to a sectoral fund? In this case, we're obviously talking about tech and IT funds today. Sure. And also, what level should an investor know that they have a higher concentration? That is your upper limit, maybe for a sector fund.
Fair enough. I think a reasonable benchmark is to look at what is the weightage of that particular sector in the index itself. Okay. So based on, let's say, free float, the weightage of the IT sector in the index is roughly around 8.5%. And for the tech sector, which is the broader index, and typically that is the broader space which is being captured typically by most of the digital funds and the tech funds, that's roughly around 14%. So if you are extremely bullish on a certain sector and you want to be kind of overweight, my sense is that you can go probably 3-4%, overweight. But having too much of concentration also over the benchmark does not help, because you need to have the ability then to time sector allocation very, very efficiently. So other than probably, I would say, the banking sector, which is still a more linear sector, considering that it touches every sector of the economy, if you're looking at investing into any sectoral funds, then you need to be able to time your entry and exit points. Otherwise, high chances that rather than able to create alpha and creating extra returns, you may actually end up with actually subpar returns.
Okay, so maybe you're saying similar returns to maybe what the IT index has as a weightage. Try keeping it there. 1, 2, 3% above below is fine, but that's what is maintainable level.
Correct. So when you are investing in a diversified fund as a core strategy, typically you will get, index related weightages anyway. So if you want to go, overweight, probably you can go 3-4% overweight per se, but, don't do it too much, because in the pursuit of creating extra returns, it could be counterproductive also.
Okay. Vineet, how long before one, as an investor, needs to know that if my fund is underperforming, or the mutual fund that I've bought, maybe specifically sector funds, are underperforming, that's when I should stop maybe? What's the time period? 3 years, 2 years, 5 years? At what point do I need to realize that maybe now this is not doing well for me, get out of it and look at something else?
See, ideally, if you are a sector investor, then in my view, you need to have the ability to understand valuations, because then you are taking a call on a sector on certain, parameters per se from a timing perspective. And therefore, you should be able to track the valuations and, in my view, take a decision to stop or exit when you believe the valuations are, unjustifiable in terms of creating incremental value for you. Now, when you're looking at doing a postmortem, right? Now, see, the postmortem anyway, does not help, because you're not taking a proactive stance, then you are doing more of a reactive stance. But at any point of time when you're doing analysis, I'm saying even if it's underperformed, then the question is not to look at the past. Then again, it's about looking at what are the valuations today. Because the worst thing that you can do is bear the pain and then exit at the low point of the sector. So therefore, I think it's important to, at any point of time, whenever you're evaluating either the entry, exit, or even a hold decision, it has to be based on where do you see incremental value from where you position at that point of time.
Okay, Vineet, thank you so much for joining in today, explaining us what one should do when your fund is underperforming, or maybe not even panic when your fund is underperforming. 1 year time period is not the time period you check, or near term when you're seeing a bit of an underperformance, do not panic, do not stop, do not maybe pause, continue it. And maybe, the cycle changes and you will see that up move. Vineet, thank you so much for joining in today and giving us an understanding on that way as well. But on that note, we're going to slip into a very short break. On the other side, we're going to talk about RBI's changes that have come in, and especially in terms of LTV ratios for loan against mutual funds. What should you be doing on that front? Stay tuned in. Welcome back to MF Corner on CNBC TV 18. Now, we're going to be discussing and putting the spotlight on the recent RBI changes that have come in. And this is for loan against mutual funds in terms of the LTV. That's the loan to value changes in terms of the percent that comes in. You can see on the screens that for listed shares, debt securities, first it was 50%, now the loan to value limit is gone up to 60%. Equity mutual funds, that's from 50 has gone to 75 previously, then debt mutual funds also has moved up to 85%. To discuss what it means for you as an investor when you're taking loan against your mutual funds, let's bring on Varun Fatehpuria, founder as well as CEO at Daulat Finvest, to answer all those questions. Varun, good afternoon. Thank you so much for joining us on the show. Now, obviously, with this significant increase that's coming in terms of limits, Varun, for the loan to value or LTV ratios, firstly, just for viewers who don't know, what is LTV ratio, why is it important, and what will these changes mean for MF investors as well?
Hey, good afternoon, Vinny. And just for the benefit of everyone, investors today in our country can actually pledge their mutual fund holdings, mutual fund units, and borrow against it with lending institutions using a facility called as loan against mutual funds, whether your units are held in a demat account or in a statement of account form. It does not really matter. And the limit to which the lending institution can provide you a loan against your mutual fund units is defined by a concept, as you pointed out, known as LTV or loan to value ratio. So let me just give you an example. Let's say an investor is holding 10 lakh worth of units in an equity mutual fund. Basis the current guidelines issued by RBI, the limit or the LTV ratio for equity mutual funds have been moved up to as high as 75%, which means that the lending institution can give you a loan up to 7.5 lakh rupees against your 10 lakh worth of mutual fund holdings. So that is in effect what the RBI ceiling is telling us, that now going forward, you'll be able to avail a higher loan against your mutual fund holdings. And obviously, whatever the ceilings are is basis on different category of funds. So equity has a 75% LTV ratio, debt mutual funds have a 85% LTV ratio, direct equities have closer to 65% ratio, depending on whatever the risk guidelines that the RBI has prescribed against each of these individual instruments.
Varun, now what does it mean for MF investors? Does it, or will we see more coming in? Because now the value of the mutual funds you're holding, even to maybe get some loan, becomes better, right, for them. So how should you be judging that? And especially given that debt mutual funds at 85% is that LTV that's going to come in. What is the best way maybe for someone who's retiring, and if they are looking to borrow, how should they go about it as well? Is it the better option to go for?
So, Vinny, we have always viewed a loan against mutual fund more as a short-term liquidity tool rather than a return enhancement tool or something that you could easily borrow against to meet your lifestyle needs. The reason for that is the loan comes with a steep interest rate, right? So where today the housing loans in our country comes anywhere between 7.5%, just to give some context, most of the loan against mutual funds will come anywhere between 10 to 12%, depending on the borrower's credit profile. So obviously the cost of interest is significantly higher compared to what you would find in more plain vanilla offerings. So we often advise investors, clients, that you view this as a temporary short-term cash management need, where you would not have to actually go about and trigger a redemption, because that would in effect then incur a capital gain tax on the corpus that you have built over many years. So if you have a temporary short-term cash management flow, then you can tap into loan against mutual funds very easily, or you can maybe for that matter even just keep a line open for emergency purposes and pay interest only on the utilized amount and not on the entire sanctioned amount. So that is how I would encourage viewers to view loan against mutual fund more as a temporary emergency use compared to a return enhancement tool.
Short-term emergency use, not a return enhancement, way that one could look at for loan against mutual fund. Varun, what are the daily loan-to-value checks maybe that one should watch out for an equity mutual fund investor, maybe just to avoid that redemption or margin calls during times of correction? How should you be aware of it if you have taken such a loan?
So this is a great point that you have actually brought up, given that the regulations actually prescribe that the LTV needs to be monitored by banks or NBFCs on an ongoing basis. And what does that mean? Let's say you have put in or have 10 lakh worth of equity mutual fund holdings and you have borrowed closer to the ceiling limit of 7.5 lakh rupees. In the event that the market actually crashes and the value of your holdings goes down below 7.5 lakh rupees, then there are two options in front of you. You would either need to pledge more units or you need to put in cash to actually get the LTV to the required range. And this is something which is actually monitored on an ongoing basis vis-a-vis the regulation, which the regulator says that any breach which occurs, that needs to be rectified within 1 week. So obviously, I think the good way of looking at it is not to get your limit closer to 75%. In fact, keep it closer to 65-70%, so that even in a black swan event where there is a market stress, you are not forced to meet margin calls. So again, people who are not comfortable with leverage, I think this is a very good way to view how to use loan against mutual funds tactically, so that you are not burdened by any interest cost.
Okay, Varun, a quick one before we wind down Mutual Fund Corner today. Should investors who are conservative prefer debt mutual funds? REITs also is coming in as an option now. So what should one be picking up if you're more conservative, want to avoid much more volatility or don't want to take risk?
So REIT obviously comes with its own set of advantage, given that it has a distribution component in the range of 6 to 7%, and then the capital appreciation component. But despite REITs holding more stable income-generating assets, I would say they could exhibit some sort of an equity-like behavior during market stress, given that these are listed instruments on the stock exchange that you can buy and sell. So it's relatively...
Okay. Sure, Varun. I think your line has become a bit patchy, but what Varun was saying, that the revised framework is recognizing the risk difference between allowing higher LTV for debt-oriented instruments versus REITs as well. And conservative investors prioritizing capital stability should prefer debt mutual funds for pledging. That was the word coming in from Varun over there. But Varun, thank you so much for joining in today on the show as well and helping our viewers understand LTV as a concept and loan against mutual fund. But with that, we're absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, closing bell to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Anthropic's business, its run rate revenue within India has doubled over the last 4 months.
There is an event later today in Mumbai near the gateway of India, and I think we'll hear from both leaders then.
Commerce Ministry indicated that a deadline cannot be ascribed to the same.
Absolutely flat, slightly sideways, about 0.25% down, I think. Yeah, 26,615.
Probably most of the positive and the news flow around the orders are already priced in.
So far, the stock is down more than 20%. It's at a record low.
Whole lot of content, a whole lot of conversations to unpack here from the AI Impact Summit.
I think it's a question between near-term and long-term. It's a question between value and the kind of valuation and the kind of growth rate.
Code will not be the goal. It'll be actually making AI work, orchestration, and those kind of things.
What we see from our clients is that our clients trust Infosys in driving and delivering AI work.
Our sovereign models are proving to be better than many of the global best.
See, there is a huge legacy installed base. Modernization of this is again a big opportunity.
And the Nifty holding above that 25,700 mark. It's at about 25,750 as we speak.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Rima. And Rima has had a very, very busy day. Keeping a track on what's going on the AI front. And as we speak, Rima, 60 minutes to go, we have the weekly expiry as well. The Nifty is unmoved. We're as flat as can be. But intraday, there's been plenty of volatility. I think the good news still today is that the number of stocks advancing are way more than the number of stocks declining. So your portfolio must be feeling far better.
Well, IT is done an intraday jig, right? The Nifty IT index moved up between 11 and 12. You started seeing it move up. At the session high, the index was up nearly close to about 2.5–3%, but it's come off in the last 1.5 hour or so. So basically, it was a very hectic day in terms of tech conversations. First at the India AI Summit, Cisco, HCL Tech, and then the Infosys AI Summit. The key takeaway is that there is no dearth of opportunity. There is a dearth of opportunity, particularly in data modernization, right? Companies are sitting on old legacy systems. If you want to use AI on it, first you have to modernize that data.
Correct.
Get it up to speed, and then we will be able to apply AI on it and get the output. So that shift itself is a very big work. So there is a lot of opportunity. But as Nandan was saying, it's on execution now. There are new avenues, new categories of growth, but it's onto the Indian IT companies now to execute. So the proof is really going to be in the growth. Once you start seeing the growth metrics, that's when you will come to know how Indian IT companies are faring in the AI world. We'll talk more about it. For now, let's just do a quick check on some of the big movers. At the index level, as he said, it's absolutely flat on the way up. Infosys holding up with a gain of about 2%, but it's come off a tad bit from the highs. Adani Enterprises is your top gainer, 2.5% higher. BEL continues to do well since morning. It's been one of the big movers. L&T has been strong. The investors are hoping for a special dividend after the sale of Nabha Power to Torrent Power. So that's keeping the stock excited. You've got a Titan, you've got a ITC, you've got a Bajaj Auto, Tata Motors passenger vehicles. Some of these stocks holding up in the green. On the way down, metals is struggling a bit. In fact, the Nifty Metal Index is the top sectoral loser today. So under pressure are Hindalco, Tata Steel. Hindalco 2.3, lower, Tata Steel slipping by 1.5%. Eternal is weak in trade. Eternal has been one day up, one day down for the last couple of days. Very, very volatile. Shriram Finance, weak in trade. Reliance Industries is the heavyweight, dragging its feet. And ICICI Bank too, down under pressure. Let's also tell you what we've lined up on the show today. Tempered gains across the indices. The Nifty perched just below actually the 25,700 mark. There is increased interest in the small caps, PSU, IT. They're lending support while metals are on the back foot. Now, IT sector is still holding up in the green. Infosys is leading the way after locking in a partnership with Anthropic to deliver enterprise AI. Nandan Nilekani also allays concerns, saying Indian companies are not missing out on the AI opportunity. Interesting excerpts from our chat with the management of HCL Tech straight from the ongoing AI summit in Delhi. MD C. Vijay Kumar of HCL Tech also says he expects deflation to be 2 to 3% on account of AI, but that's already modeled into the prices. Ola Electric cracks but comes off the day's low. This is after brokerages continue to downgrade the stock after a weak showing in Q3. So lots lined up. It's an action-packed 1 hour, but let's begin with the trading ideas.
Well, that's right. How do you position yourself then for the final hour of trade? Mitesh Thakur is back with us. Hi, Mitesh. Pretty much flattish day is what we are seeing on the Nifty. The Nifty Bank, though, that's the one that's doing well. And the Nifty IT index seems to be getting into some kind of rhythm. Your view on the Nifty, what are the levels you're looking at? And fill us in with your picks.
Good afternoon, Nigel. I think in the morning I was saying that 25,750 thereabouts is the level which the Nifty needs to get past, and we got a high of around 25,764. I think closing about 25,750 would be important. Else we are broadly doing a range of 25,400 to about 25,750. You're right, the bank is doing well, and in fact, long positions on PSU banks particularly can be taken, and I recommend the Bank of Baroda, which is a buy with a stop at about 297.5 for targets of roughly around 315. And the other stock which I like is Bajaj Finance. It's had a good rally. Then yesterday and today it looks like giving a pullback. So giving you a fresh entry point. Keep a stop at about 994 for targets of around 1040.
Those are some trading ideas, but just to get you up to speed with the AI IT developments that we've had overnight. And the big one, of course, was the Infosys AI Investor Day that started at close to about 11 o'clock. So just in case you missed listening in to the keynote address by Nandan Nilekani, who spoke about how this time AI is different, the disruption. And two, there was also a services opportunity discussion by the CEO, Salil Parekh. So these were the two main tracks that everyone was watching out for. And these are some of the key takeaways. One, I think in a way, Nandan Nilekani has reassured investors. It's not that the Indian IT companies are missing out on the AI opportunity. It's not that just the LLMs, these big tech companies would be the AI winners. So his words were, there is no opportunity gap. The opportunity is bigger than ever before. The risk is not in the opportunity, but in terms of the execution. So that was one big fear, that Indian IT companies would be AI losers, but in a way he's dispelling it by saying that there is AI opportunity. The second risk that people had in mind when it came to Indian IT companies was a risk of revenue deflation. If your productivity gains are so high because of AI, you can do the job in half the time. You can do it with half the engineers, right? So the overall value of the project would come down, and therefore IT companies will lose revenues. This is the risk in the market.
Yes.
So what Nandan Nilekani said is that there is a big difference between tech, where the pace of tech today in terms of tech evolution and enterprise adoption. He's saying it's easy to adopt technology and show high productivity gains for a particular task, which is what you see. You can do it, when an LLM showcases its ability, it's for a particular task. And there you can see very high productivity gains. But when you have to get those productivity gains at an enterprise level, it's very, very complex, right? So scaling AI at an enterprise level is not that easy. So there is that big difference in terms of if you are fearing that revenue deflation is going to be very high, 15%, 10%, it's not that easy, because to get those productivity gains at an enterprise level,
it's going to be very difficult.
It's going to be very difficult.
For a task, it's okay.
Yeah. And also, I think for the first time, Infosys has quantified the opportunity because of AI. The AI services opportunity is $300 to $400 billion by 2030. But as Nandan said, it's all about the execution. But the company has identified 6 emerging AI pools to tap into the opportunity. Some of the ones we know, for instance, AI for legacy modernization, AI for data, but also about AI for physical devices. Physical AI is becoming a big thing where you embed software in hardware companies, in devices, and get them to do work. Trust, of course. And then we had partnerships. Infosys announced that partnership with Anthropic, where basically they will be using Anthropic and taking Anthropic services along with their own AI offering and using it for all the enterprises that they operate with. So it's just a step forward, and they're moving in step with the way AI is evolving. So I think these were some of the key takeaways. It's allayed some fear in the market, which is why you are seeing a rebound in the share price. Share price has also had a one-way fall, so that is helping in the uptake today. But it's all about execution from here on, not in terms of the opportunity. We also had a chance to catch up with C. Vijay Kumar, MD of HCL Tech from the India AI Summit. He had a chat with Shireen Bhan, and there he spoke about the fear of revenue deflation on account of AI productivity. Listen in to what he had to say.
We believe there will be 2 to 3% deflation at an overall level because of AI. And this is something we've modeled. But there are at least 5 mega opportunities that we are chasing, right? AI factory, it's $1 trillion capex will mean at least $100 billion of services spent, and at least a couple of $1 billion we should be able to get from that. Physical AI is again another big opportunity. The whole agentic implementation. See, there is a huge legacy install base. We had called out about $600 million annualized revenues, advanced AI, and once again, this is different from regular AI revenue a lot of companies are talking about.
Meanwhile, Infosys earlier today also announced a collaboration with Anthropic to unlock AI value across complex and regulated industries. Listen in to what he had to say, Infosys had to say about the AI opportunity.
There is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
The legacy modernization piece, this is a massive, large opportunity that we are seeing. In addition to customer service, one of the largest opportunities, where we are essentially taking large legacy organizations. We'll actually share a couple of examples of this, of the work we're doing at scale, and bringing them away from the legacy landscape into the modern landscape. Physical AI is something quite new, where AI software is embedded into devices, and that is becoming a growth area because everything will have AI built into it. And then AI trust, which is both about the trust and cyber, but it's also about responsible AI, which is something where Infosys is leading in making sure that things are built with a view to keep responsibility in mind in the scaling of IT systems. There's a huge opportunity. The one that I mentioned, the 6 areas with an external analysis, we understand that the opportunity is between $300 and $400 billion in the year getting to 2030. So over that time frame, at that time in 2030. At the same time, we have several entities have made estimates. We have our own views. The AI productivity leads to compression in IT services. However, today we have a clear view that the opportunity is massive and large, and that will become the driving force of what we will grow and drive through in the next coming years.
Well, that is Salil Parekh saying that yes, there could be some revenue deflation, but the opportunity on account of AI is so much more. Dharmesh Kant, head of research at Chola Securities, now joined in. Dharmesh, we know your view on IT, and we know the stock that you like is Orion Pro, but keep that aside. Tell us purely about Infosys and what you heard from Nandan Nilekani and Salil Parekh. What were your key takeaways about the way IT industry will need to adapt to capture this AI opportunity?
Yeah, good afternoon, Rima. Thanks for having me for the show. At least now there is a lifeline and there is some sentimental, positive sentiments are prevailing after this announcement. And this was much needed. I mean, there are 2, 3 things. One is acceptance of the fact that in order to service AI-based, clients, you need to partner with AI partners overseas. So that capability has to be outsourced, and that it can be only through collaboration. Second was disruption is there, and it's quickly, disruption is going at a very fast pace. So today, this is a disruption. 1 year down the line, it can be another disruption, which will be again, hurting you. Third fact is, since you're collaborating, your revenue share, the entire model of revenue share will change. So there will be some, compromise out there. And at the same time, your expense sheet will also change. I mean, machines will be there, which will be largely doing the work than the humans. So that advantage will be there. But to my mind, that arbitrage between revenue, change to expense change will be in favor of, revenue less and expenses more. So eventually it will be a margin dilutive. Look at when we started, these companies used to command an operating margin of 35 to 40%, which has come down to 20 to 21% for large caps, and we are struggling there. This, I think, over a period of time will go down further. It will come to 15, 16% kind of an operating margin, 2-3 years, if everything goes as per the saying. So, and the gap which would have been created because of loss of business of existing SaaS platform, that can be definitely will filled with this AI-led platform. So net, it's a zero-sum game. I think a few days, couple of months, the sentiment may prevail. We may have a trading rally, but much needs to be seen 1 year, 2 year down the line, which I think is not so positive for Indian IT industry, seeing the way these developments are happening.
Got it. Okay, all right. Got that, Dharmesh. Let's focus on the two-wheeler space then. I know you're not too interested in Ola, but let's Sudarshan join in and run us through that news piece first, and then we'll get Dharmesh's pick from the two-wheeler space. Not electric at all, Sudarshan. I thought you'll go for it again today. The bike is not kickstarting only.
On the earnings front also, it's looking the same because for the last 2 quarters, company has been reporting a weak set of earnings. Recently, it has announced Q3 FY26 earnings where revenue is halved, losses remain elevated. Now stock is at a 52-week low. Today also, after falling 7% yesterday, today also stock is down. And now, if you talk about in the 2026 so far, stock has fallen almost 20%. Even on the volume front, it's been seeing huge volumes. Yesterday's volume was 8.5 crore versus 10-day average of 3.86 crore. And on the back of weak earnings, there have been few brokerage downgrades. Today, Citi has downgraded the stock to sell from buy and reduced target price to rupees 27 per share from the earlier target price of 55 rupees per share. What does Citi say? It's saying EV penetration in Indian two-wheeler market has been sluggish, and especially Ola Electric has lost market share. In January 2026, its market share has fallen to less than 6% from the level of 25% that company used to hold in the early 2025. But Citi believes management's efforts to improve product and service quality could take some time to fructify, but healthy gross margin trends and better operating leverage could boost EBITDA. It has cut estimates multiple to 3.5 times from the earlier level of 4.5 times. Now, in the start of FY26, company had given the guidance for the entire fiscal. On the auto business margin front, it was expecting to improve to more than 5% or to be at least 5%. As of December 2025, it's at minus 6.4%. On the gross margin front, it was targeting in the range of 35 to 40%. Currently, it's at 29.6%. On the volume front, it was expecting the range of 3.25 to 3.75 lakh units. As of December, it has done just 1.5 lakh units. On the revenue front, for FY26, it was expecting the range of 4,200 to 4,700 crore. As of December, it has done just rupees 2,000 crore. So it's reflecting on the earnings, it's reflecting on the stock price, and that's the reason it has moved to 52-week low.
Got it. Okay, all right, Sud. Appreciate you joining in and giving us a quick update. Dharmesh, what's your view on the auto space? Ola, I don't think you want to comment on it. You already gave us your opinion a couple of days ago. But I think in the past, Hero MotoCorp, that was the one that worked well. Hero or Bajaj, one of the two you liked. What's your preference now in the two-wheeler space?
Yeah, Dr. Nigel. Yes, Hero was better liking as compared to Bajaj in the past, and it has worked well. Going by the numbers, even January numbers were quite encouraging, and we are entering into again a marriage season. So Q4 and Q1 is always good for automobile industry. So that traction is happening. Whatever dealer checks we have been interacting, the sales are happening on the ground. So the run rate of January is likely to be maintained in Feb and March going forward. So overall a positive sense we are getting from the two-wheeler space. The entire tailwind of direct tax cut, indirect tax cut, and the interstate cut is playing out there. Prices have moved up. They are trading at a multi-year high valuation multiple. But I think this is likely to sustain for next couple of quarters. The one best part has been they've been able to take the price hikes and pass on the input costs, so the margins won't be affected in Q4 as well. So there again the topic remains the same. I mean, Hero MotoCorp remains a topic, followed by Bajaj because their domestic sales are picking up, and January sales was quite encouraging. And if they are able to maintain that, coupled with currency tailwind of overseas sale, that should see it through. So I mean, 7 to 10% kind of an upside from here from a trading perspective.
Okay, all right. Dharmesh, I wanted to ask you about the stock DCX Systems. It's been a rank underperformer. The results look quite disappointing. A couple of days ago, the stock was at around, I think, 150 or 155. In the last 1 week, it's now up close to around 5%. It's one of the outperformers, 185 rupees, though a far cry away from the highs. What's going on here? I think in the past, you had a view on this.
Yeah, Nigel. I mean, we even had an IC on this, and we booked out when the target price was achieved. But we continue to like the counter. The reasons being the order book is very strong. They're still sitting on 2,500 crores plus of an order book as of now, which has to be executed. And the drag on the profitability for last 2-3 quarters was on the consolidated level. Standalone, they were still managing to pull things out. And that drag was primarily because of their NIAT subsidiary, which is an object detection system to be developed for railway and locomotives. There some testings were happening, and the last one was the winter fog testing, which they have successfully done. So going forward from Q4, our expectation is the expenses which they were booking for development of this product will not be there. That has been done. So whatever profit is there will translate into the actual operating profit and the PAT level, and execution should pick up. Though I have not interacted with the management post the earnings announcement, but looking at the overall size of the order book they are sitting on, and this overhang of NIAT will not be there from Q4 onwards. If execution picks up, then I think it's a deep value buy. But again, one has to take his own reasoned call when they are entering into this company. Just seeing the order book, I think if things pick up, then the stock prices can really fire up.
Dharmesh, wanted to get your view on SRF, where a promoter stake sale is likely. Sudarshan, what are the details that you have?
This is a surprise announcement that has come from SRF's promoter, that is Kama Holdings, which holds stake around 50.2% as of December 2025. Last time Kama Holdings had sold stake was in March 2024, and that was just mere 6.75 lakh. But now, this time, Kama Holdings is looking to sell up to 3% stake, and that may happen up to March 2027. So till March 2027, Kama Holdings can sell anytime 3% stake, and this is a surprise announcement that has come, and because of that there is sharp falling. Looking at the SRF price, currently down more than 3%, while in the contrary Kama Holdings stock is higher.
Well, that's right. Thanks a lot, Sid, for that. Kama Holdings around 8,600 crores of market cap, and if they sell this 3% at current market price, well, they'll be getting close to around 2,500 crores. So that's why, in fact, SRF down, the one that's selling and will get the money is Kama Holdings. On SRF, it's a bit of an overhang. Dharmesh, interesting answer on DCX. It was a defense play, but now the railway, thing seems to be driving the stock as per what you said, NIAT. But what about this one, SRF? Stock is down. Out of nowhere, this announcement came at around 1 p.m. Explains why SRF is down. Your view?
Yeah, definitely it's a surprise announcement, and because of that reaction, we are seeing the stock price. I mean, it's always prudent to come out with explanation as to why the stake sale is happening and what would be the end use of that money, which is through the stake sale. If that is there, then this uncertainty and lack of clarity is not there, and then investors can also take a reasoned call. So usually, I mean, in investing parlance, whenever promoter is selling stake, unannounced is not taken lightly or positively by the investors. So I think that knee-jerk reaction is happening. Otherwise, the numbers were quite encouraging for SRF for last 2 quarters. So nothing wrong on the business front. Things were shaping up well. However, the management has guided because of the China raw material input and the competition out there, they're facing some challenges. But on number fund, they have been able to deliver. So, I mean, as far as, corporate governance and prudence is concerned, it's always, safe and nice to come out with the outlay as well and the objective of the sale.
Okay, thank you very much, Dharmesh, for joining in. We will slip into a break. On the other side, Aman Chauhan, fund manager at Abacus Asset Managers, will join in. Stay tuned.
Welcome back, where it appears that we're going to have a bit of a day of a consolidation on weekly expiry. In the next 60 minutes, the contract will expire. Now, what's clear today is that the day's high, ballpark around 25,765. That's the intraday high. That's where the Nifty resistance is, just for today's trading session. Tracking the Nifty PCR, well, that had gone down to 0.64. It started the day at around 1.1, currently holding it around 1.05. So no big move on that one. The calls, they're getting written. 25,700 call. The premium right now is down to around 13 rupees. Remember, it started the day at around 73 rupees. So the time value of money is getting eroded, and that explains why the premium has come down. On the flip side, even the 25,650 put, out there as well, there is writing, and that's why we have seen that the premium has come down from around 60 rupees to around a buck or thereabouts. And it's that out there as well, you're seeing erosion in terms of the premium. So for the time being, it appears we're going to be expiring in this particular vicinity of ballpark around 25,630 to the upside around 25,770, which incidentally is the high point of the day. Stocks are in focus. ITC, a beaten down name, there is fresh buying, both in futures as well as in the cash market. So there is some buying that we're seeing on that one. Adani Enterprises has been a stock that actually corrected from the top. Now that's coming for a bit of a short squeeze that we're seeing. And Union Bank is the other name that's seeing some kind of fresh addition in today's trade. Infosys, for the timing that appears, there is some fresh buying out there, but there are still a lot of shorts in the system. If in case it can find its momentum, those shorts will have to run for cover. For the time being, we're seeing some element of fresh buying on that counter. So it appears like we're going to be getting through the day, a day of consolidation with a very mild positive bias, Rima.
Okay, Aman Chauhan of Abacus Asset Managers is now joining in on the show. Aman, thank you very much for joining in. I know we've asked you in the past about technology, but that's clearly the hot topic right now. And we're hearing from IT companies, whether it's CVK of HCL Tech or even Nandan Nilekani and Salil Parekh of Infosys. What's the read on the Indian IT companies in terms of what the expected growth is going to be over the medium term? Not just FY27, which will be better, but say over the next 3 to 5 years. And if you juxtapose that with the kind of valuations they're trading at.
So the growth rates, I believe, right now within low single digit, which can go to mid single or slightly higher than that. Very difficult to gauge in the near term whether they'll go to double digit. From that perspective, companies are fairly priced. It's not as they're not expensive, definitely, but it's not that something is like a screaming buy, because you can buy for a tactical trade. Stocks have corrected 30% in the last 2 weeks and they can bounce back, give you 5-10% here and there. But for an investor looking to hold on, I believe a mid-cap IT would make much more sense than getting into a large-cap IT where the growth rates can be double digit, because then you can still justify 15 or 18 or 20, 22 P. So that's where it is. So if you are benchmarked, you don't have a choice. You need to own Infi, TCS, or HCL Tech, or whichever names are there in the index. But if not, then still, I believe mid-cap IT can make you a better return than holding on to the large cap. That's broadly what we are feeling.
Got it. Okay, all right. Hi, Aman. Good to see you. And as always, mid-cap IT could potentially do better than large-cap IT. We just got done with this Q3 earnings. And, most estimates and most of the reports that we have read with regard to earnings actually has been a little better than what most analysts were predicting, particularly from the broader markets. What do you think from your on? Earnings will get better, and that could be the reason that the broader markets actually outperform the headline index. As we have been seeing in the last 1 year, the headline index was pretty okay, but individual stocks got smashed out of shape, 10, 20, 30, 40, 50% down as well. So do you think we're bracing for that sort of a year when mid and small caps do better?
I think so, because this quarter also, the reported numbers, the mid and small cap have delivered a higher growth than what the top 50 or top 100 names would have, right? And hence you can justify a better multiple for these companies because of the higher growth, which right now nobody is looking at it because sentiments are weak. But broadly expect 4Q to be better than 3Q. So once that momentum starts to build in, expect FI money also to start to coming in, market starts to do well. And that is the time when investor interest will be back into these names, right? So I believe there's enough liquidity in the market. Domestic liquidity is there. People are just waiting for the right sentiment. It's like when you start making money is when you want to start to look at these names. Otherwise, everybody has something or other already in the portfolio and you don't want to add a new name. So hopefully in the next 2-3 months, when market starts to see good activity, and that's the time I think the mid and small cap can start to outperform. That's broadly what we feel.
What are you all buying right now, Aman? What is of interest to you all?
So we are adding more of metals. We are adding more on the pharma. We are also looking at adding into the capital goods and the engineering space because this is one sector where exports can resume both to US as well as to EU. So textile is an obvious name, but there's not much of liquid names in that sector per se, so not much of exposure there. But cap goods can clearly come in. Selectively, chemicals can also do well because that's also something that got impacted because of the tariff, which can go away. So these would be the sectoral preferences as of now.
I wonder whether someday Abacus as well will come and we'll see Sunil ringing the bell. See a listing from your stable. So we'll have to, see, wait by to see something on that front. But what about the other capital market plays that we have? Yesterday a stock like Angel One was down 8-9%. It ended the day with a cut of only around 4%. BSE has gone through, a bit of a correction from the recent peak. Because of the regulatory changes that are coming there, the prop trading in the F&O as well will get squeezed a little bit. And we know the SGT is going to go up. Your view on this space, because the runway is immense. Market participation is just going to go up from here on and penetration is going to go up. Would you be a buyer in select capital market plays? And I know you won't get stock specific, but you could at least give us a bit of a direction. Wealth managers, exchanges, brokers, what do you like?
So we don't have much of brokers in our portfolio. We do have AMC companies, we do have wealth management companies, we do have a diversified place which is into all of these businesses also. So we like the space. We had decently exposed. Will I buy more right away? Not really, because already exposed in that sense. But yeah, we don't have pure play brokers. That is not a space that we are very excited about because it's hyper competitive and there's not much of, you can say, more that you can generate. But if you're an AMC, if you are a wealth guy, you already have a captive client base. That is something which is more interesting than just getting into a pure play broking.
Okay, all right. Got that. Aman, what about the auto pack? What's your view of the, a lesser covered name and a management that doesn't talk too much to sell side as well as Force Motors? Stock has gone from strength to strength. I mean, a year ago, I think it was 9,000 rupees. Today, it's 25,000 rupees. What do you like from that play, the auto pack? Will it be the core auto OEMs, if you could drill it down a little bit for us? Or do you all prefer the, auto ancillary names or maybe the financiers? Your take?
We have auto anchor in our portfolio. That's what our preference is between the three sub-segments that you mentioned. Auto financiers are also good, but most of them trade at valuations which is higher than the peer group, and hence we have not got directly into them. So auto anchor is something where clearly our interest is. OEMs are looking interesting. Right now, not much of exposure in our portfolio. We are select one or two names, but I think maybe in the next 2-3 months, we'll have to get into more of these direct names also. So after the three, ANGs first, OEM second, and then the financials.
Got it. Okay, all right. One quick word. The alcohol beverage companies, they have seen a sharp correction from the top. Duties went up. Select reports suggest that, there is some inventory pile-up globally. But otherwise, in India at least, the consumption may not go up, but maybe the quality consumption could move up. How are you all placed out there on the alcohol beverage space? At one point in time, it was fancied. Then the stocks have taken a sharp knock.
Yeah. So we feel consumption will go up at the top also and at the bottom also. So we are not worried for that front, nor are we worried on the global inventory levels. I believe in the near term, what has happened is there have been payment delays, especially in the southern states, which are a large market for many of the players, right? And because of that, working capital got stressed, and that has led to some, you can say, profit booking, or you can say less interest in this segment. But I'm sure once that reverses, things should be back on track. It's a decent high double-digit kind of growth segment, which we expect can continue. So I'm not too worried on that. We own some names in this sector, have a positive view, continue to own them. And maybe we'll add once we get clarity about this payment situation in the southern states. That is, I think, what is bothering the market in the near term.
The ones with exposure in southern states, I think, would be allied blenders. or Tilak Nagar Industries, one of the two. Is that ballpark? Couple of stocks?
All of them. All the pan-India players, they all have southern exposure because that's the largest. Whiskey is the largest market in India. Southern states are the largest consumers of whiskey. So anybody who's a pan-India player has some southern state exposure. Almost all of them.
Got it. We'll have to keep an eye out on that, and we'll quiz the managements as well whenever they do join in with regard to payments and how that working capital cycle is getting stretched. Thanks, Aman, for joining in, giving us some color. You're sounding far more optimistic, I think, on the market, so that's good to hear. Time to slip into a short break. Come back. We'll get you some technical calls, some buy and sell calls. Stay with us.
Fly Emirates, fly better.
Welcome back. We've got about a little more than 15 minutes to go to wrap up trade. Mitesh is back with us for a few BTST calls. Mitesh?
Yeah. So I think, the market has come up, but what is looking interesting to me is the FMCG pack. Britannia, for me, I think, I'll take that as a BTST call. Britannia, keep a stop at about 61.24. Look for target of around 61.8. And Colgate is another one, Colgate, so BTST with a stop at 21.38 for targets of 21.75.
Okay, got that, Mitesh. A couple of Tata Group stocks actually are doing well. Tata Motors, pull up the intraday chart. Titan is the other stock I think we should pull up the intraday chart out there. Both of them have seen a bit of an up move, and Dr. Reddy's as well. That as well has moved up a little bit. So explains why now the markets are up close to 45 points. Let's talk about some stocks that are on the news. Ria joins in to tell us exactly about that. Ria?
Well, let's start off with Cochin Shipyard first. They have been declared as the L1 bidder for the construction of 5 next-gen survey vessels for the Indian Navy. The total order value is rupees 5,000 crores, and at the end of Q1 of FY26, the company's order book stood at roughly rupees 21,100 crores. Texmaco Rail has also been in focus today. They have received an order worth roughly 220 crores from MRVC for the Mumbai Suburban Railway Line construction, the execution period for which is 36 months, and at the end of Q3, the company's order book stood at 5,661 crores. The last stock is TVS Supply Chain. They have signed an MOU with Italy-based ALA Group to enter India's $28 billion aerospace and defense supply chain market. And all of these stocks have performed well in today's trading session.
Thank you very much for that. My colleague Ekta had the opportunity to speak to the management of Laurus Labs and Sai Life Sciences from the sidelines of the BioAsia Summit in Hyderabad on what they make of the weakness in the CDMO space. Listen into what they had to say and even the way forward as they see it.
The CDMO business, there will be established revenue from commercial molecules, a lot of clinical phase molecules. So the revenue coming from clinical phase molecules are very cyclical. So very difficult to quantify quarter on quarter. Even for commercial molecules, you have to see yearly numbers for CDMO companies, not quarterly numbers. Specifically, some companies are doing well, some companies are not so. It is company specific. I don't think you can attach that sentiment to the entire industry. It all depends on the offtake of the molecules, vendor diversification. If one vendor is enjoying majority market share and then a sponsor is trying to add another vendor. So it all depends on the de-risking from the partners, I would say.
The long-term drivers are better than ever, but I think the reality is the expectations are higher than ever. So I think what people are forgetting is that people are judging companies from the past from being tactical suppliers to become a strategic provider. Tactical suppliers can get one-offs, successful high-margin products, but strategic suppliers have to do a much broader range of technologies, broader range of capacities. So that actually we're in an investment cycle, and people think we're in the reaping cycle. So you have to be very careful what we wish for. I think we're the early phase of a multi-year growth cycle, but that's going to be playing out in the next 5-10 years. I don't think you can judge 1-2 years. We're just a little bit hyper because we've seen the, what do you call, biosecure XYZ. But this is a 5-10 year cycle, and I think everything is intact in terms of that cycle.
Okay, time to slip into a short break, but on the other side, Jay Bal of Cash the Kiosk is waiting for us. He'll give us his setup with regard to the markets, and we'll talk about various assets as well as stocks. Welcome back. As promised, Jay Bala joins us on the show. Hi Jay. Good afternoon. Good to see you win. Markets are creeping up gradually. Are you ruling out now that visit to, I think 1,500 points lower from here?
Hi, Nigel. The markets are still holding up well. As long as the Nifty can hold about 25,148, the probability that we're going to see fresh all-time high first would be the case. But if 25,148 were to get printed even on an intraday basis, then we'll have to go back to the probability that the markets are going to revisit below the August low, somewhere about 24,400 to 24,000. But as long as 25,148 holds, the probability the markets are going to fresh all-time highs are higher, but it's running out of time. It needs to do it really quickly. It needs to do it really fast. And the recent low of 25,372, it's an ideal place for the Nifty to launch to fresh record highs. First 26,000, then 26,300 odds and change. But it needs to do it really fast.
Jay, IT has been in downtrend for a while now, and now the index is also at multi-month lows. Today, it's attempted a rebound. What is your read of the little bit of a recovery that we're seeing today?
Yeah, hi, Rima. I was pointing to the Nifty IT index going back below the October low once, but holding above the April low. If you go back to my notes, I've been pointing to the Nifty IT index dropping back to 33,000 and then completing the a medium to long-term move. But it's very critical. It stays about 30,900. If it doesn't hold 30,900, the thesis that I'm anticipating the markets to the Nifty IT index to bottom around the current levels, that will go out of the window. And we are probably looking at the Nifty IT index going back to 26,000 and change. So 30,900 is absolutely crucial for the Nifty IT index. It cannot afford to breach that level. So we're watching the Nifty IT index with a lot of caution, but I think it will turn bullishly. As a trader, we don't preempt the market. We want the markets to confirm that it has put in a bottom at yesterday's, the low it registered a couple of sessions ago. But 30,900 is absolutely sacrosanct.
30,000 is a level sacrosanct. What about stocks that you are recommending for trade?
Since the Nifty is at an important juncture to turn up, I'm going to go with Reliance Industries, a stop loss at about 1380 and an objective of 1550, possibly even new record highs. The second stock I have is Thermax. It's probably putting in some sort of a bottom. It's not clear if it's a short-term bottom or a medium-term bottom, but we'll take it as a short-term bottom to be conservative. Stop loss at about 2740. With an objective of 3,500 to 3,600.
Okay. All right. I want to ask you about the dollar index. The shorts on the dollar are at the highest we have seen in the last 14 years. That's the report that came in overnight from Bank of America. Given the kind of expectation with regard to these rate cuts now, there's not so much optimism. Earlier, we were expecting a lot of rate cuts. Now that seems to have dimmed down a little bit. Inflation is creeping up a little bit, and maybe the jobs market is not as weak as what is anticipated. Put that together, I think you were in the camp that believed the dollar index could actually spike up from here. You can correct me if I'm wrong.
That's right, Nigel. The dollar index broke below the October 2025 low marginally and then has come back higher. I want to see a print of 98.25 here. If that happens, it solidifies the case. The dollar index has put in an important low because when a market breaks down and then reverses the other side, it's what we call as a false breakdown, and often the move on the opposite side will be quite sharp because of the fake move. So we are looking for a move back about 98.25, and then we can confirm the dollar index is heading at least to 103 to 104. It could be even bigger, but we are looking for confirmation to come through. This is tentative at the moment, waiting for a print of 98.25 to confirm this opinion.
Okay, all right. What about crude? It's well behaved, but I think you're calling for higher levels of there as well, right?
That's right, Nigel. I'm anticipating crude to bounce to somewhere close to 78 on NYMEX variety, and then post that we are looking for a sharp decline below $54 it registered at the end of 2025. It could even go as low as 45. But we have to stomach this volatility and higher levels in the short term. Once that's done, it will be ready for next down below the December 2025 lows, somewhere about 54 on change. We are looking for new lows post spikes.
Oh, very good. So Brent actually will be under pressure. That's good news from an equity perspective. Our investors asking me, tell us about silver, because Jay last time around predicted a sharp fall in silver. That happened, but where is it going from here?
Yes, we are looking for a short-term bounce to somewhere about $83. Post that, the silver is likely to hit to at least 58. So looking for lower levels on precious metals. The gold signals that the recent high it saw just above 5,100 might be an important high. I don't see much higher levels beyond 5,300, but silver is looking quite negative in the short term. But there's a reasonable probability that the medium to long term is still intact. So we'll evaluate once silver comes to about 58 and gold comes to somewhere about 4,100 to 3,800.
PSU banks are on fire. The Nifty PSU banking index should come up. That's up close to about 2.5%. Bank of Baroda, 4%. PNB, 4%. Union Bank, up and about. SBI, of course, has been the leadership stock. Jay, we were earlier chatting with Gautam Shah of Goldilocks, and he said PSU banks could be the outperformer. Did he say PSU banks or PSUs in general?
He said, yeah, that's what his call was earlier as well. He prefers PSUs that are trading in 9 to around 10 to 11 times. So that was his preference. And SBI is one of the stocks I think he spoke about in the past, at around 1,000 rupees. It's 1,200 rupees. Yeah.
Indeed. And now today, so while his call is on PSUs, today, Jay, we're seeing a big move in PSU banks. How is that space looking to you?
Yeah, so if you recall from a conversation in September, Rima, I pointed out that once SBI takes out 837, it will clean out the bags. Those are the exact words I used. And that's exactly what from 837, it's broken out and it's come to about 1214 right now. So when it comes to the banking stocks, it's a bit late. It's still the leader, but it's still a bit late to participate in the banking sector. Yes, Nifty PSU banks are looking stronger than the private sector banks. But as a sector as such, the Nifty banking index, I don't know if it has considerable upside above 63,000. We are right now at 61,100. So I'll be a little bit cautious here. I would start looking at underperforming banking names rather than stocks that have outperformed for the last few months. So bullish there, but still some amount of caution because 63,000 on the Nifty Bank is a big resistance.
Okay, thanks for that, Jay. Appreciate you joining in. I look forward to chatting up with you soon. By the way, let's wind down the markets for you. The Nifty goes home with gains of more than 30 points. The Nifty Bank was outperformer, up close to around 200 points. But the PSU banking names, that was the one that really bucked the trend in today's trading session. So good going out there. Stocks that did well, you had from the tech pack. You had Infosys, HCL Tech, and Tata Elxsi. They did pretty well. On the flip side, metal index lost its shine a little bit. So you had Hindustan Zinc, Nalco, as well as a commodity play, which is MCX. All of them did come in for some profit taking. ITC getting back to its smoking ways, and this time around, the bulls are smoking. Stock was higher in today's trading session. Adani Enterprises as well was up. What did well then from the broader markets? Paytm. Now, there's a note that's coming from Macquarie. They believe that potential could be a reason that Paytm actually sees some kind of re-rating because PhonePe is going to come out with its IPO and the valuations that they're seeking is quite high. Delivery as well did see a relief rally in trade today, so that stock did pretty well. SRF on the flip side was down. That was down close to around 3% in trade because the promoter entity looks to sell close to 3%. Swiggy as well came for profit taking, and BSC still not finding its form. That stock as well under some pressure. From the broader market, just to highlight a few big gainers that actually have been losers in the past. EasyTrip was up 20%. You had Unicommerce that was up close to around 20% as well. So big move out there. Newgen was up close to around 12% in trade, and Praj as well did pretty well in today's trading session. So from the broader markets, you had a fair bit of stocks that did a jig of their own. We'll wrap up on this edition of Closing Bell. Don't go anywhere. You come back. We're waiting for you with Markets Forward. The Lal Street closes in the green for the second straight session, with the benchmarks ending near the day's high. The Nifty settles above the 25,700 mark, while the broader markets outperform in trade.
Infosys enters into a strategic partnership with Anthropic to bridge the gaps in agentic AI and complex enterprise solutions. Chairman Nandan Nilekani says the AI opportunity is bigger than ever, but cautious about execution risks. CEO Salil Parekh estimates a $400 billion opportunity for the industry by 2030.
The deal-led action on the Lal Street continues. Kochi Shipyard emerges as the lowest bidder for a 5,000 crore rupee Navy contract. Texmaco Rail bags a 220 crore rupee signaling equipment order. And TVS Supply Chain signs an aerospace and defense MOU with Italy-based Ala Group.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the key data points to get up for the next trading day while telling you about today's trading day as well. And it's Mangalam Malu. With me is Nigel D'Souza. Nigel, we usually speak at 10:30 a.m. speaking about the markets. But today, it was a good day, so to say. The bulls saw a bit of a comeback. Yes, it was consolidatory. We did have the expiry that play out. But, give or take everything, a 40-point uptick with the IT stocks doing well, the Nifty Bank doing well, the street will take that.
Well, that's right. And the next half hour, Rod, we'll get you all the big news. We'll tell you about the corporate voices as well that we got in the events you need to track as well. But Mangalam, to highlight the top gainer today in terms of the index, it was the tech index. And metals that were otherwise shining lost its sheen a little bit in today's trading session. But let's first tell our viewers what we have lined up on the show for you. We start off with all the top movers and shakers of the day. Sudarshan joins in to tell us about that. Infosys enters into an AI partnership with Anthropic. We bring you the key takeaways from the management. We'll also decode the weakness in Ola Electric and deals-led action on the Lal Street as well. Last but not the least, we'll get you some top corporate voices for the day.
Right. With that, what we'll do is go across to Sudarshan, who's at the big wall with the top movers and shakers of the day. Sud.
The hype around AI continues, and one thing it's been doing is keeping IT stocks buzzing. Today also, we saw all the major IT names, TCS, HCL Tech, Infosys, all the stocks at one point were trading with gains of 2 to 3%, but Infosys and HCL Tech closed with gains of almost in the range of 1 to 2%. Some of the other stocks too moved higher. From the mid-cap space, Tata Elxsi closed with a gain of 2%. Newgen Software saw a big gain from 52-week low, and at the end, this stock too was higher, 14%. But one segment that has been seeing buying for the last few trading sessions after the SBI had announced Q3 earnings, and it was a strong set of earnings, and post that, all the PSU banks have been buzzing. You can see BOB, PNB, Indian Bank, Bank of India, Canada Bank, all these banks today also saw a gain in the range of 2 to 4%. Some of the stocks have reacted to news flows. First on the list is Maruti Suzuki. Today it has launched the price. It has given the price of its electric vehicle e-Vitara, and the price looks very competitive of 11 lakh rupees against the M&M's price if you talk about, or say Tata Motors. Second one is SRF, was under pressure in the trade, closed with a cut of almost 4%, and the reason is its promoter Kama Holdings has made a surprise announcement of selling 3% stake, and that would be completed by March 2027. So in contrary, Kama Holdings was up almost 6%, but SRF has taken a sharp knock and it was down 4%. And last one is Delivery. It has announced a strategic announcement related to electric vehicles, and on the back of that, this stock moved higher by 4%.
Okay, got that, Sudarshan. Thanks for all the movers and shakers in today's trading session. But let's move on. Then Infosys has partnered with Anthropic to bring agentic AI solutions closer to the real-world enterprise use cases. Peers such as Happiest Minds are also exploring similar tie-ups to fast-track AI adoption. Rima joins us to help us out with a quick analysis on that. Rima, Indian IT firms are doubling down on the AI push.
Thanks so much for that. So as you rightly pointed out, we are seeing a rebound in stocks, and this comes after stocks had seen a one-way fall. But even the Infosys Investor AI Day has allayed some concerns. So Infosys Chairman Nandan Nilekani has pretty much reassured investors it's not that companies like Infosys are missing out on the AI opportunity. He said that there is no opportunity gap. The opportunity is bigger than ever before. The risk lies not in opportunity, but in execution. So therefore, you still have to ask the question, what is your company doing to take advantage of this new world, of the AI world? And you keep hearing about how agentic AI, you can get the work done in half the time, in less than half the time, with less than half the engineers, to which he said that technology is evolving at a faster pace than enterprise deployment and adoption. He said it's easier to gain productivity gains for an individual task at a project level. But to get productivity levels at an enterprise level, at an organization level, is very complex. So there is a difference between the task level productivity, what he calls greenfield, that you see when these companies like LLM make the announcements, versus what is actually happening in the enterprises. And for the first time, Infosys has also quantified in a way, the total addressable opportunity, the TAM. They said the AI-first services opportunity stands at $300 to $400 billion by 2030, and they have identified 6 emerging AI pools to capture that. And as you rightly pointed out, the other big development is that many of these companies are now expanding their partnerships. So Infosys tied up with Anthropic, which will help Infosys build AI-first enterprise solutions. Yesterday it was TCS and AMD, which is more in the compute and hardware ecosystem. And I suspect we will keep hearing more and more of these technology partnerships.
Indeed, Rima, thanks a lot for that. In fact, let's go across to Infosys Chairman Nandan Nilekani, who did say that this AI opportunity is bigger than ever, but he's also cautious about execution risks. CEO Salil Parekh estimates a $400 billion opportunity for the industry by 2030. And we also heard from HCL Tech's C. Vijay Kumar, who weighed in on the AI opportunity. Let's listen in to those industry titans.
You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk. It's an execution risk.
There's a huge opportunity. The one that I mentioned, the 6 areas with an external analysis, we understand that the opportunity is between $300 and $400 billion in the year getting to 2030. So over that time frame, at that time in 2030. At the same time, we have several entities have made estimates. We have our own views. The AI productivity leads to compression in IT services. However, today we have a clear view that the opportunity is massive and large, and that will become the driving force of what we will grow and drive through in the next coming years.
We believe there will be 2 to 3% deflation at an overall level because of AI. And this is something we've modeled. But there are at least 5 mega opportunities that we are chasing, right? AI factory, it's $1 trillion capex will mean at least $100 billion of services spent, and at least a couple of $1 billion we should be able to get from that. Physical AI is again another big opportunity. The whole agentic implementation. See, there is a huge legacy install base. We had called out about $600 million annualized revenues, advanced AI, and once again, this is different from regular AI revenue a lot of companies are talking about.
Okay, all right. Well, to take this discussion forward, to help us out with the technicals, we're joined by Jay Bala, who joins in, and we have Sudeep Bandyopadhyay to help us out with the fundamentals. Hi, gentlemen. Good to see you all in. Sudeep, you go first. What's the view on tech? Are you a buyer post this sharp correction? Well-run companies, free cash as a percentage, free cash flow yield, valuations, various other arguments you can make. The problem is, will there be growth? How are you placed? And give us 2 names that you like from the tech space.
Well, Nigel, I'll be extremely cautious. And, I've heard the entire thing and I'm watching the space with very, very significant interest. This is an evolving space, but my thesis and the way we looked at it about 15 days back, month back, and today, I think it remains the same. Our view is that Indian leading technology companies will have to evolve. They have to enter into partnerships, and this is exactly what is happening. And I think it's a good thing for the long term. But medium term, short term, I think their revenues will suffer, their profits will suffer, and their margin will be coming under pressure. So under these circumstances, I think we'll have to kind of stay away from this space at this stage. They're trying to do the right things. They're trying to move with the AI bandwagon. They're getting into the right partnership so that they become stronger going forward. They get a larger market share going forward of the entire AI pie. But there is absolutely no doubt about the fact that the revenue, margin, and profit will be under pressure in the short to medium term. So let's avoid this space. Let's keep watching it.
All right, let's avoid the space, but keep watching it. Chartically, what does today's up move tell you, Jay? Has the IT index bottomed out, or maybe this was just a bounce from oversold levels?
Hi, Mangalam. I've been pointing to the Nifty IT index dropping to somewhere about 33,000 and has potential to turn around from there. So today's, or rather the low put in a couple of sessions ago, that's going to be very crucial. The Nifty IT index cannot drop below 30,900. And if it does that, it will set the path backwards, and the potential for it to bottom at current levels would disappear. Watching 30,900 with a lot of bullish optimism, but we don't preempt the market. Let the market tell us that it's turned around from here. So the next few sessions in this week and the next week is going to be very crucial. That will give us further clues the Nifty IT index is bottomed or not. If 3,900 breaks, we are looking at the Nifty IT index dropping sharply to 26,000.
All right, if 3,900 breaks, then you're looking at 26,000. Let's see where that goes over the next few days. We'll definitely be monitoring this space because obviously not all has been said and done with regards to IT, AI, and the opportunity or the threat. But let's move on to some individual stocks which were on our radar on account of deal-driven action. So there was Cochin Shipyard, TVS Supply Chain, the likes of that. Let's go across to Ria for a closer look at the developments. Ria.
Starting off with Cochin Shipyard first, this one is performing well in trade after being declared as the L1 bidder for 5 of next-gen survey vessels for the Indian Navy. The total order value for this is rupees 5,000 crores, and at the end of Q1 of FY26, the company's total order book stood at roughly rupees 21,100 crores. Moving on to Texmaco Rail, this one is also buzzing on the back of an order win. They have received an order worth around 220 crores from MRVC for the construction, for the railway line construction of the Mumbai suburban railway line. The execution period for which is 36 months, and at the end of Q3, the company's order book stood at roughly 5,660 crores. The last stock that has been buzzing today is TVS Supply Chain. They have signed an MOU with Italy-based ALA Group to enter India's $28 billion aerospace and defense supply chain.
All right, Sudeep, what do you think of Cochin Shipyard, the deal that has come by? Any particular picks in the defense space that you have?
This is definitely a good development from a Cochin Shipyard point of view, but I think it will take some time before this gets translated into revenue and profitability. These things take a lot of time to get it built. As far as this entire defense pack is concerned, we have been liking the private sector defense players who are gaining momentum, not the small ones, but the large ones. Larsen & Toubro has been my favorite. It has got a very well-developed defense business as well, and it's expanding rapidly. Bharat Forge is taking a lot of stride in the defense. The defense book is growing. So, and both Bharat Forge as well as Larsen valuation is comparatively much better, I would say. So if I have to pick, I will pick these two. Amongst the PSU defense, I think I continue to like BEL, Bharat Electronics Limited. I think it's moved up quite a bit. Valuation is not cheap, but from a long-term perspective, it does look very good even now.
Got it. All right. Let's talk about Ola. The stock hit a 52-week low after Citigroup downgraded the stock. The brokerage also slashed its target price by around 51% to 27 rupees. Let's go across to Sudarshan for a quick analysis on that particular name. Sud?
On the earnings front also, it's looking the same because for the last 2 quarters, company has been reporting a weak set of earnings. Recently, it has announced Q3 FY26 earnings where revenue is halved, losses remain elevated. Now stock is at a 52-week low. Today also, after falling 7% yesterday, today also stock is down. And now, if you talk about in the 2026 so far, stock has fallen almost 20%. Even on the volume front, it's been seeing huge volumes. Yesterday's volume was 8.5 crore versus 10-day average of 3.86 crore. And on the back of weak earnings, there have been few brokerage downgrades. Today, Citi has downgraded the stock to sell from buy and reduced target price to rupees 27 per share from the earlier target price of 55 rupees per share. What does Citi say? It's saying EV penetration in Indian two-wheeler market has been sluggish, and especially Ola Electric has lost market share. In January 2026, its market share has fallen to less than 6% from the level of 25% that company used to hold in the early 2025. But Citi believes management's efforts to improve product and service quality could take some time to fructify, but healthy gross margin trends and better operating leverage could boost EBITDA. It has cut estimates multiple to 3.5 times from the earlier level of 4.5 times. Now, in the start of FY26, company had given the guidance for the entire fiscal. On the auto business margin front, it was expecting to improve to more than 5% or to be at least 5%. As of December 2025, it's at minus 6.4%. On the gross margin front, it was targeting in the range of 35 to 40%. Currently, it's at 29.6%. On the volume front, it was expecting in the range of 3.25 to 3.75 lakh units. As of December, it has done just 1.5 lakh units. On the revenue front, for FY26, it was expecting in the range of 4,200 to 4,700 crore. As of December, it has done just rupees 2,000 crore. So it's reflecting on the earnings, it's reflecting on the stock price, and that's the reason it has moved to 52-week low.
Take that point indeed, Sudarshan. Thanks a lot for that. With that, we'll also thank Jay Bala and Sudeep Bandyopadhyay for joining us and giving our viewers a lowdown on what's good, what's not, what levels to watch out for as well. Take a short break, come back. The top corporate voices on the other side.
Welcome back. Let's get you the top corporate voices of the day. CleanMax Enviro Energy's IPO is set to open next week. Now, speaking to CNBC TV 18, the management said the company owns and operates its renewable power plants across solar and wind. That's what differentiates them from many listed players. The EBITDA has grown by around 58% between FY23 and FY25, but the company has a debt of around 8,000 crore rupees. Operational capacity stands at around 3,100 megawatt, with another 2,900 megawatt under construction.
Right, and Galaxy Surfactants, that stock was up today as well. The management expects recovery in sales volumes in the second half of this year. Speaking to CNBC TV 18, the MD and CEO said margins will be supported by specialty care projects and cost discipline, with EBITDA per ton expected to stay around that 19,000 to 20,000 rupees in FY27. He also added that a potential reduction in the US tariffs could aid exports, while currency pressures in Africa, Middle East and Turkey will continue to weigh on consumption.
And Gokul Das Exports is seeing relief after the India-US trade deal, with early signs of business returning to normal. The company's management said the margin should improve from FY27, and they expect revenue growth to be in the vicinity of around 12 to around 15% in FY27. The company also plans a capex of around 175 crore rupees over the next 2 years.
All right, with that, we'll wrap up on this edition of Markets Forward. Thank you so much for watching. We'll be back with more news and updates on the other side. Keep it with CNBC TV 18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. A volatile session on the Wall Street ends with marginal gains. Nifty reclaims 25,700. IT stocks rebound but give up some gains in late trade. Infosys enters into a strategic partnership with Anthropic to bridge the gap in agentic AI and complex enterprise solutions. Chairman Nandan Nilekani says AI opportunity is bigger than ever, but cautious about execution risks. CEO Salil Parekh estimates a $400 billion opportunity for the industry by 2030. HCL Tech CEO C. Vijay Kumar says AI disruption has thrown up new opportunities, but fears of obsolescence are overdone. Says the company is focused on building intellectual properties to bridge the gap between AI and enterprise adoption. Says physical AI can unlock $1 billion revenue stream for any company. IT Minister Ashwini Vaishnaw expects India to attract investments worth $200 billion over the next 12 months as he bets big on the AI opportunity, promises a front foot approach by the government on AI. French President Macron begins his India visit with a morning jog at Mumbai's Marine Drive. Prime Minister Modi hosts Macron for bilateral talks, where India and France are expected to strengthen defence partnership. Eli Lilly, India's head, Winslow Tucker, says they are encouraged by the reception to its weight loss drug Mounjaro in India. Says they are focused on scaling up their operations and catering to the unmet needs. That's an exclusive. Maruti announces competitive pricing for its first electric SUV. The starting price of the e-Vitara is just under 11 lakh rupees as the company opens bookings. A second round of negotiations between officials from US and Iran begins in Geneva. Tehran is willing to discuss curbs to its nuclear program but refuses to accept zero uranium enrichment. Cricket legends appeal to the Pakistan government for immediate medical attention and humane treatment of Imran Khan. Sunil Gavaskar and Kapil Dev join hands with 12 other former international captains to make the appeal. Khan has been in jail for over 2 years and has lost 85% vision in his right eye. Right, let's start with the day's market action. Sensex and Nifty ended higher for the second straight session. All major indices closed in the green. Nifty closed above the 25,700 mark, with Infosys, L&T and SBI leading the pack. Nigel D'Souza joins us now with the day's trading action. Nigel.
Well, the Indian markets consolidated on weekly expiry day for the Nifty with a mild positive bias. Remember, most Asian markets were shut, but the Indian markets did well. Participation could be relatively lower because a lot of traders globally would actually be on holiday. What performed today was the Nifty Bank. That continues its strong showing. But the PSU banking names, they were the ones that really led the way. The tech-related names, they've got smashed out of the shape, year-to-date so far. But they bounced back, while the sector that came in for selling was the metal index. Let's tell you about a few stocks actually that were moving around. The Nifty top gainers include the likes of ITC. Remember, post the duty hike, the stock had seen a sharp correction. Now there's reports that suggest that, in fact, the price hikes actually have taken place, which will offset some part of that duty hikes. So that's why that stock was one of the top gainers. Adani Enterprises as well did well. And from the defense names, BEL was the stock that did pretty well. But tech, that was the index that went down all the way to around 31,300 just a couple of trading sessions ago. That's bounced back in trade. And today, the one that led the way was Infosys. Remember, they had their Investor AI Day, and they allayed concerns with regard to the survival of the tech index here in India, the tech stocks itself. And because of that, Infosys was up. You had HCL Tech as well that participated on the upside. And Tata Elxsi from the broader markets did pretty well. So tech made a bit of a comeback. The index that has been glittering is the metal index. That came in for profit taking. There's some mild strengthening on the dollar index. Most of the Chinese markets are shut as well. And these stocks have ran up a goodish deal in the last 3 months. So Hindustan Zinc, Nalco, and another play on commodities is MCX. That as well did come in for some profit taking. From the broader markets, though, there were a few winners. You had Paytm that did do well. Now, PhonePe IPO could potentially help Paytm re-rate. And that could explain one of the reasons why that stock was up 2.5 to around 3%. You also had Delivery. After seeing a sharp correction, that stock did pretty well. But a couple of losers, just to note, SRF, the stock was down. The promoters said on the exchanges that they're looking to sell close to around 3%. So that weighed on the stock. Swiggy did come in for about a profit taking. And BSE as well was under some pressure. Remember, it sold off yesterday. And today as well, it was under some pressure. Regulators, they're tightening their grip with regard to various activities, particularly in the F&O space. And that's why that stock did come in for profit taking. So net, the positive bias continues on the Nifty. I think the 25,250 to 25,400. That's an important support zone. You'll believe that the markets will trend higher from here, but more importantly, number of stocks advancing are outweighing the number of stocks declining, making your portfolio feel quite good.
Right, thank you, Nigel, for that. Shifting focus to the big story that we are tracking this evening. IT giant Infosys has entered into a partnership with AI behemoth Anthropic to develop enterprise AI solutions for industry-specific operations. Through this partnership, both companies will help sectors including telecommunications, financial services, manufacturing and software development boost their AI capabilities. Speaking at the Infosys Investor AI Day, Chairman Nandan Nilekani has said that the AI opportunity is bigger than ever. However, he has cautioned about execution risks and called for a laser focus. Infosys CEO Salil Parekh, meanwhile, highlighted that AI services present a $300 to $400 billion business opportunity till 2030. Rima Tendulkar joins us now. Rima, some solace for the IT stocks post tie-ups with AI companies. Please take us through the key takeaways from the meeting.
So as you rightly pointed out, we are seeing a rebound in stocks, and this comes after stocks had seen a one-way fall. But even the Infosys Investor AI Day has allayed some concerns. So Infosys Chairman Nandan Nilekani has pretty much reassured investors it's not that companies like Infosys are missing out on the AI opportunity. He said that there is no opportunity gap. The opportunity is bigger than ever before. The risk lies not in opportunity, but in execution. So therefore, you still have to ask the question, what is your company doing to take advantage of this new world of the AI world? And you keep hearing about how agentic AI, you can get the work done in half the time, in less than half the time, with less than half the engineers, to which he said that technology is evolving at a faster pace than enterprise deployment and adoption. He said it's easier to gain productivity gains for an individual task at a project level. But to get productivity levels at an enterprise level, at an organization level, is very complex. So there is a difference between the task level productivity, what he calls greenfield, that you see when these companies like LLM make the announcements, versus what is actually happening in the enterprises. And for the first time, Infosys has also quantified in a way, the total addressable opportunity, the TAM. They said the AI first services opportunity stands at $300 to $400 billion by 2030, and they have identified 6 emerging AI pools to capture that. And as you rightly pointed out, the other big development is that many of these companies are now expanding their partnerships. So Infosys tied up with Anthropic, which will help Infosys build AI-first enterprise solutions. Yesterday it was TCS and AMD, which is more in the compute and hardware ecosystem. And I suspect we will keep hearing more and more of these technology partnerships.
There is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
There's a huge opportunity. The one that I mentioned, the 6 areas with an external analysis, we understand that the opportunity is between $300 and $400 billion in the year getting to 2030. So over that time frame, at that time in 2030. At the same time, we have several entities have made estimates. We have our own views. The AI productivity leads to compression in IT services. However, today we have a clear view that the opportunity is massive and large, and that will become the driving force of what we will grow and drive through in the next coming years.
And speaking of the AI opportunity, it's day 2 of the India AI Impact Summit. Big wigs of the industry and top policymakers will be in attendance in New Delhi to brainstorm about shaping the AI future. From India pitching itself as the AI hub in Global South to the big bet on agentic AI, the mood is vibrant at the Bharat Mandapam in Delhi. HCL Tech CEO C. Vijay Kumar has said that AI disruption has provided the IT sector new opportunities, but maintained that fears of obsolescence are overdone. Speaking to CNBC TV 18, Srinivas Bhan, he said that the company is focused on building intellectual properties to bridge the gap between AI and enterprise adoption.
What is the message that you want to send out to the markets? Is the SaaSpocalypse real?
If you recollect, 2 years ago, we did call out as a company that AI is a big disruption moment, and we want to embrace it proactively, right? So none of this surprises us. We looked at how the technology would evolve and really started building a strategy which will future-proof our business. It's about proactively transforming our services as well as building intellectual property which bridges the gap between all the LLMs and reasoning models to how it can be applied in the enterprise world. So the technology is moving very fast, you've seen it, but the enterprise adoption is gradual, and it is rightfully so. Actually, if I want to use an analogy, God created the world in 7 days because there was no installed base. Right? If there was nothing installed, you don't need to worry about compatibility issues, you don't have to worry about data migration and integrations, all of that, right? And there's no bugs to fix. So it's very easy. But in a real world, in a real enterprise, there are so many complex installed systems.
It's not as easy as plug and play.
It's not, absolutely, it's not. And that's where service providers like us, we have a lot of trust with a lot of big enterprises, and we have the context of the enterprise.
Fears of obsolescence for the Indian IT services sector, the SaaSpocalypse, as I spoke about, overdone, exaggerated, and you believe that industry has enough ammunition to fight back?
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption, and if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe.
Cisco President Jeetu Patel says AI companies have moved on from making chatbots to generating AI agents. Speaking with Srinivas Bhan, Patel said AI agents are like digital co-workers, and the company is doubling down on India.
What's happening in AI right now? We're moving from this first phase that was around chatbots intelligently answering questions to now agents being able to conduct tasks and jobs for us fully autonomously. And if you think about the big structural shift that's happening, it's important to take a moment and actually reflect on it. It's not just about using this as a tool for productivity. These are digital co-workers that are going to be augmented to our teams, and they'll actually be part of the team in the way that they work.
Digital co-workers.
Exactly.
Yeah.
And it's going to get, it starts with knowledge work, but then as physical AI and robotics actually starts to pick up, you will start seeing this in every sector where you'll actually have additional capacity getting augmented to what we currently have with the human corpus. And what that allows us to do with the human corpus of knowledge is making sure that we can continue to go out and solve problems we could never solve before. Now, going back to your question on, the capability overhang is real. There's the ability for the exponential curve continuing on these innovations is very rampant, but organizations take a while for the absorption rate to actually catch up. So this is the one, in 2026, what we want to see is absorption rates of organizations start to catch up with the pace that AI is moving at. And you're now starting to see that in certain areas, like for example, in coding and development. Right. We are now seeing a tremendous amount of progress being made over there that we would not even think possible 6 months ago. And you'll actually start seeing that in multiple different industries.
Let's talk a little bit about Cisco's plans for India as India also builds out its AI infrastructure as well as AI story in general.
Well, firstly, I think India has a tremendous advantage in just the population demographics you have. You've got the largest amount of people that are under the age of 30 that are in the workforce. And I think most people keep thinking AI is going to take jobs away. I think you're just going to have a very different way that humans can use AI capacity for their benefit. And so what you do get is a tremendous amount of innovation potential in India that actually is very unique. And so we are doubling down in India like never before.
Former Niti Aayog CEO Amitabh Kant believes IT service providers will remain relevant as they integrate AI models into the business. Kant called on the companies to invest in research and development and adapt to future disruption.
Even companies like, if you look at Claude or if you look at Anthropic, they will require integrators. They will require this technology to get embedded in companies. They will require companies like HCL Tech or Infosys or TCS in the long run. But I would like many of these companies which have, to put in much more resources in R&D to be the next Anthropic of the future. I mean, they've been path-breaking in many ways, these IT companies. But we are heading for a very major disruption in the world. And you need very deep engineering for all that to be able to partner some of this huge disruption that is taking place. It's not that these IT companies, to my mind, will have become irrelevant. They are very much relevant in the world of tomorrow.
Now, IT Minister Ashwini Vaishnav expects India to attract AI investments worth $200 billion over the next 12 months. Speaking to CNBC TV 18, Vaishnav also promised a front-foot approach from the government.
We've already seen big investments. Can we expect some more in the course of this week?
Given what we have heard from the global industry, both from the infra players as well as from the VCs, over next 1 year, we are likely to get about $200 billion worth investment.
All right, time for a short break. Coming up next, Eli Lilly India's head Winslow Tucker says they are encouraged by the reception to its weight loss drug Mounjaro in India. Details when we return. Welcome back on to a CNBC TV 18 exclusive. The top brass of life insurance companies have proposed a deferred commission model to the regulator IRDAI. We learned from sources that the companies suggested that 40 to 50% of front-loaded commissions be paid over 5 years. Life insurers have also proposed reducing absolute commissions by 10%. The insurance regulator has sought 3-year distributor-wise commission data from insurers by the 23rd of February. Auto major Maruti has announced the introductory price of its battery electric vehicle, the e-Vitara. The car will be priced at 11 lakh rupees under a battery as a service mode. Customers can book the vehicle with an initial payment of 21,000 rupees at Nexa showrooms. US President Donald Trump has said he will be indirectly involved in Washington's talks with Iran, which have begun in Geneva. Speaking to reporters, the US president said that he believed Tehran wanted to make a deal over its nuclear program. Meanwhile, Iran has said it believed that the US position on the nuclear issue has become more realistic. Eli Lilly India's head Winslow Tucker has said that they are encouraged by the reception to its weight loss drug Mounjaro in India, but the work is far from over. In a conversation with my colleague Ekta, Tucker also explained why they are not perturbed by the patent on a key weight loss drug ingredient expiring later this year.
We're encouraged by the reception of tirzepatide since we launched it, but we think there's a lot more work we need to do to ensure that patients can get appropriate treatment. Where we're focused right now is scaling our operations in India. We're focusing on the unmet need. We have a We Now Know awareness campaign, which is really trying to educate on the stigma and ask for patients to consult a healthcare professional.
You're at the cusp of seeing semaglutide go generic in the month of March, and India is a price-sensitive market. Do you think that's going to impact your market share and your sales?
I think it's important that what you said is that semaglutide is going generic. There's not a generic for tirzepatide. And tirzepatide has a very different profile. We are a dual agonist, GIP and GLP. We know that that has proven as a mechanism to show superiority over semaglutide alone, both in weight reduction in SURMOUNT-5, but also in glucose control and weight reduction in SURPASS-2 as well. And so from that perspective, we feel like the value of tirzepatide differentiates it in the marketplace.
And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, copper is trading at a 6-week lows with sentiment cautious as most Asian markets remain shut for the Lunar New Year. Prices are down nearly 15% from January's record highs of $6.5 per pound. Well, combined inventories across COMEX, LME and the Shanghai Future Exchange have surged toward 21-year highs at over 1 million tons. In precious metal markets, in the meanwhile, gold has extended losses, slipping below that $5,000 an ounce mark. Silver is also under pressure. This is amid thin liquidity with several Asian markets closed. However, it's the crude oil price is holding steady as the US and Iran hold second round of talks. Geopolitical tensions remain elevated after Iran conducted maritime drills in the Strait of Hormuz, while the US is deploying a second aircraft carrier to the region. Joining us now on the show is Ol Hansen. He's head of commodity strategy at Saxo Bank. Ol, hi, thank you so much for joining in. I want to start with metals first. And while the Chinese markets are shut, it's a truncated week for US as well. But with contradicting fundamentals coming in for copper, where on one side, the structural long-term demand from many consumers is still on. But on the other side, the kind of inventories, smelting, which the satellite records show is at a decade low as well. How are you reading all of these signs?
Well, good afternoon. Basically, that we once again have this mismatch between short-term developments and the longer-term picture. The short-term, as you mentioned, we're seeing inventory levels rising across the world, hitting a million ton on the exchange-monitored side, and there's probably more as well off exchange. So that's basically leaving us with an ample supplied market in the short term, weighing on price and thereby also pressurizing traders and investors who have been buying into the long-term prospect. And it just once again highlights the commodities are not equities where you can buy today in expectations of future growth. You have to wait for the supply and demand situation to provide the underlying support. And right now we're not seeing that. That's why we're seeing some long liquidation. I'm not selling into this market. I'm purely just seeing long positions getting out and just getting to the sideline, waiting for the rebound, and which I believe will materialize over the coming months, especially next month. It's interesting to note how China behave when they come back from their holiday.
Ol, what's your sense then on the copper prices for a longer term? As you said, you're not selling and the long-term story does still look lucrative. Are we looking at those all-time highs coming back in yet again? How would you look at the prices in this year, the range that is?
I think we've probably seen the highs for this year already now, simply because that surge we saw in January was similar to what we saw in silver, completely unsustainable and unfounded. And that basically means that is now a bit of a ceiling for now. But even coming back towards those levels would generate quite a strong return on an annual basis. So I think for now the structural long-term situation outlook remains supportive. And that basically means we've probably seen the highs this year, but further highs could be expected in the coming years, simply to entice miners to work flat out to produce the copper that is required for the electrification and the energy transition.
Ol, how would you also look at silver prices? And I mean, as you mentioned, it's been a roller coaster ride onto this one. Most people believe that it is China who really played it both ways. How are you looking at the fundamentals herein? Because it's not just fundamentals. There's a lot of money, speculative movement, investment buying, all of that supporting whatever the prices did.
Yeah, silver has been suffering from the fact that there's been a lot of social media groups just calling for silver squeeze, the end of paper silver as we know it, and prices going to the moon and so on. I hate these kind of comments because it just distorts a market and you forget to look at fundamentals. Yes, there's no doubt that the physical side is tight right now, both in China and also in the US, if you look at the exchange monitored inventories. But what we tend to forget is if there is an action, there's also a reaction. And the reaction is the slowing demand from industrial users simply because prices becomes too high, above $100. We have increased supply of scrap. Just a small anecdotal story here from Denmark, Manisha. We're a small country, 6 million people, but 4 tons has been handed in to scrap dealers in the last 3 months alone. That's just in Denmark. And if you look at the global supply deficit this year, estimated to be around 2,000 tons, there will be supply coming into the market from scrap in the coming months. And I think that will help balance the market, and that basically will remove some of this focus on these so-called experts looking for prices to go sky high.
Ol, what's your sense? How are you looking at gold and silver, both of those prices performing for the rest of this year as a range?
I prefer gold, as you can probably hear from my comments here, because gold is a monetary asset. It basically, whether the price is 5,000 or 10,000 doesn't matter. It is really a question of how much you're prepared to pay for a metal that you store for safekeeping. While silver has not got the same luxury, because there will be an impact on the industrial side. So I think the gold market is consolidating right now. I think the consolidation, we need to be patient here, because it could take probably longer than we anticipate. But as we move deeper into the years, somewhere between 5,500 and 6,000 an ounce, I think is still achievable. And with the gold-silver ratio return to the long-term average around 70, that would take silver up closer to 100, but not above.
Ol, how are you also looking at the energy as a market with a couple of those important, interesting conversations between US, Iran, US also leading Ukraine and Russia conversation is what the street is looking at. Are you also looking at that, or are you looking at demand supply numbers?
I'm looking at the US midterm election. I'm looking at a president which is under pressure. I'm looking at a US consumer who doesn't really care what's happening on the other side of the world, especially in Iran. They're more concerned about the price at the pump. So call me a cynic, but I think what we're seeing right now is grandstanding from both sides. There's a lot of military assets in the Middle East right now, but I just don't see any escalation that leads to a disruption in supplies, and with that, surging energy prices. So if that turns out to be the case, then 70 will be the ceiling in oil prices for the foreseeable future. But of course, we need to see how things plan out. I might be completely wrong, but I'm just a little bit cynic here, looking at the US domestic situation as a reason why we're not going to see any escalation. So with that in mind, we're still stuck here in the 60s. OPEC are discussing perhaps increasing production again from April. That will add some additional supplies. So with that in mind, again, just like the other metal or the other commodities, as we have a long-term bullish outlook. We think we are in a structural bull market, but at the same time, we need to wait for the supply and demand balances to underpin those movements. And I think that potentially could take us at least into the second half or maybe early next year before we start to see that play its part. And from that point on, we could see oil prices move higher as well.
Fair point. So plenty to watch out for the international markets there. But as always, Ol, thank you so much for joining in and making it a very crisp conversation on all of those commodities and your expectations therein. Well, let's delve deeper into the gold now, because India's growing appetite for gold exchange-traded funds has pushed the trade deficit to a record high of just under $1 billion in month of January. The value of gold imports almost tripled to $12 billion from 4.1 the previous month. Inflows into gold ETFs nearly doubled to over 24,000 crore rupees in January. And if you're looking at overall imports that we saw in case of silver as well, have been on the very, very positive side as well. Talking further about Indian imports and the kind of ETF numbers that we are looking at, is joining us is Sachin Jain, Managing Director at World Gold Council. Sachin, thank you so much for joining in. First of all, your sense on the import numbers, because that is today's number and almost everybody seems to be reacting to this. Financialization is one part of it, but do you think India is smart enough to own gold, not just in the physical sense, but in sense of ETFs as well?
First and foremost, a big thanks, Manisha, for getting me on the platform. We're truly honored to be on the platform as always. You mentioned, the true story of today is what's the impact on CAD. And I'd like to give some hardcore facts. The average that we've seen Jan to January over the last 4 years has been in the tune of about 40 to 45 billion dollars and about 668 tons. What we saw this year, the volume that has been imported is about 621 tons. Now, that's materially low in terms of volume, and that's very, very, very important to be understood in the overall scheme of things. But because of what's happened to the gold value, this is about 12 to 13% higher. So I think there is, I mean, of course, it's picked up the headlines today, but I would not anticipate a big panic around it. It equals out. And the important element is, as you yourself mentioned, that the large inflows happened in organized trade in ETF. We've also seen a big surge in the gold monetization via the gold loans. So a large part of the gold that got used in 2025, 26 in particular, has also helped financializations within the system of organized play. So I think that's a good big plus.
I remember, Sachin, all of last year, you've been pushing for ETFs on how that is very, very important to understand the overall numbers. I know World Gold Council did so many campaigns as well. Do you see it actually showing into the kind of numbers we're looking at right now?
Oh, absolutely. I mean, last year, let me share some numbers with you. And what we saw, 1st January 2024, the AUM was around 40 tons. 1st January 2025, gold-backed ETFs, the AUM was about 56, 57 tons. The AUM on the 1st January of 2026, we were about 97 tons plus, touching 100, which did touch on the 5th of January 2026. So big inflows there. But if you look at 40 tons of, or let's say 37, 38 tons of inflows that we saw this year, 2025, that might not be so huge, but big sum from the base of the gold-backed ETFs. Now, I think as we go forward, ETFs are really at the cusp of even further growth. And while, Manisha, you're right, on your platforms, I did talk about the strength of ETF, it being a regulated product, transparent, backed by physical gold. And interestingly, what we've seen and analyzed that even in the current times where we saw prices going up and down, we saw that the institutional investors have been very sticky. Most of the investors have been on long-term play, and the retail investor in general is started to know what a gold-backed ETF is all about. So I think times for gold-backed ETFs, as they get more popular, as also the Provident Fund regulator has now allowed investment in gold. I also believe that the insurance fund regulator will consider it. I think with all of these institutions opening up, I think ETFs will get more and more stronger in the investment formats in India.
Sachin, for the longest time, we've been discussing on when and how will gold become as a mainstream in sense of an asset class. And it finally has done that the way we've seen it perform in last 12 months. How would you look at India's growth story? Because we've been buying physical for a very long time. And now the financialization, every country has its own economics and dynamics. Would you say India has found the way it has bought into gold in all forms and all senses in last 2 or 3 quarters?
Well, actually, historically, Manisha, our analysis says that every time there's a 1% increase in disposable wealth in the hands of Indians, we see a 0.9% increase in the demand of gold. Now, what we've seen particularly in the last year, that what was under stress was jewelry demand in terms of volume, but value-wise, of course, it surpassed over 15%. But what we saw is a phenomenal growth in the investment area of gold, both in physical bar and coins, but also in ETFs and digital formats. Even digital gold has done very well. Now, the fundamentals of India depend on the GDP size and how much is the disposable wealth in the hands of every Indian. And that is changing for better. We're not a matured economy like various other markets where things are only shifting. But if you look at the consumption pyramid of India and Indians, there is new wealth that's coming in. And people who aspire to own gold in any format, be it jewelry, be it bars and coins or investment area, that pyramid is having more and more wealth. And I foresee that in the coming time, where we're talking about the per capita income moving from $2,800 to over $10,000 in the coming time, it's going to have a very significant increased consumption of gold. Now, with India getting more and more digital, our median age become 29 and digital savvy, I think consumers will be very comfortable in owning assets on their mobile phones. And hence, products like ETF, which are easy, sort of regulated, you can bank on them, will be here to grow.
Oh, well, absolutely. From sovereign gold bond when it was available to gold ETFs, digital gold, give them gold in some sense and India is ready to buy it. And why not in the kind of profits that we've seen come in for that as well. Sachin, thank you so much for joining in and making sense of what it really means for India in sense of economics and the kind of growth, of course, that we're looking at in the mainstream asset class as the gold has performed itself to be. On that note, it's time for a break, but don't go anywhere because on the other side, we will be talking about food finally. Total's company's founder Arjun Veer Singh will talk about launch of their latest healthy snack and a lot more. Welcome back to Commodity Champions. And New Delhi-based healthy snacking brand Tariffs has launched a new product called Super Puffs, which it markets as India's first protein chips fortified with essential vitamins and minerals. The brand focuses on clean label positioning and transparent ingredient sourcing, and producing baked low-calorie snacks aimed at health-conscious consumers. Arjun Veer Singh is co-founder of Tariffs and is joining us on the show now. Arjun, hi, thank you so much for joining in. I mean, this really is the brand or the category that really seems to be exciting everyone. What is India's overall market when it comes to diet-conscious, healthy snacking?
So, hi, Manisha. First of all, thank you so much for having me here. It's a pleasure. So, talking about the healthy snacking market in India. So, if I talk about the snacking market in general, that is somewhere around 50 to 55,000 CR, of which the healthy snacking bit is about 20-25%, which turns out to be around 12,000 CR. We are seeing double-digit growth in the healthy snacking segment. The overall snacking market is growing at a CAGR of about 8 to 9%. But the good thing is the healthy snacking part is growing at a CAGR of about 18-19%, which is very promising. Our habits have been changing over the past decade. If you talk about protein consciousness amongst consumers, about a decade ago, it was only restricted to gym folks. Then came COVID 2019, 2020, wherein a lot of people started consuming protein as part of their everyday diet. It started to become mainstream. A lot of D2C brands launched bars, and people started to actually accept protein as the go-to thing. And now, since the past couple of years, protein is now becoming the main thing that people are looking forward in their snacks. Gen Z is actually very conscious about their habits. They want snacks that are actually healthy, that are not just tasty, but add value to them. And that is where we are trying to plug in the gap. There was a gap in the market for a very long time wherein healthy snacks were usually perceived to be not tasty. We at Tariffs are trying to bridge that gap by bringing in snacks that are both tasty and healthy at the same time.
Okay.
And that is what made us launch Super Puffs. So all of that came from the realization that there's a lot of talk going on around protein, but what about other micronutrient deficiencies?
Arjun, I get the point, and we're looking at those products as well that you do, and beetroot to oats and all that healthy stuff is what you're working with right now. What are the kind of investments that you have seen, and what products do you have in your portfolio? Super Puff, of course, is the latest addition, but with that, what kind of SKUs and what is the plan ahead, really?
Yes. So first of all, we have an assortment of more than 25 SKUs. We started with Fox Nuts because that was the buzzword. People are realizing the importance of makhana. There's already a makhana board set up. We have chips made of multigrains like oats, beetroot, quinoa, and all of them are clean label snack products. But we wanted to be different from what is there already in the market. There are a lot of protein chips there. We thought, why not target common Indian deficiencies? Vitamin D, vitamin B12, all of these are very common deficiencies across Indian diets. We thought, why not try to solve that gap through a snack and without making any compromise on taste. So we tried bridging in that gap through our product, wherein people should get the required nutritional benefit without compromising on taste. So Super Puffs is our latest offering, and we are already seeing a lot of good traction. We are now tied up with a lot of vending machine partners. We've launched on quick commerce.
Okay.
There's good trend. People are accepting the product, liking it. The labels are clean, and that is how we are seeing a lot of growth in the new launch.
Arjun, I do know that there's a lot of label reading happening with the youngsters now, not just the youngsters, but major public at large who really wants to eat healthy therein. What are the price points like, and what kind of competition are you looking at, especially in the Indian markets? And not just that, there's a lot of international food available too.
So right in the morning, I was having a discussion with an international partner from Poland, and he was telling me about the trends in the healthy snacking space there. So we are partnering up with them for an international collaboration, and the trends are as promising abroad as in India. We are seeing a lot of new age brands coming in this space, and I'm also seeing good trends from incumbents. The legacy players are also delving into this space by launching products, and I think all of this is actually for the benefit of the market in general. So with the efforts that the entire ecosystem is putting in, I think there's a good future for the country in terms of snacking. We're definitely moving in the right direction.
What are the kind of investments that you're looking at, Arjun, going forward from here? And as you said, from e-commerce to brick and mortar, you're pushing it. The distribution is working from all sides, would you say?
Yes, exactly. So unlike most new age brands, we've already built an offline distribution. We have a good network of retailers and distributors across India now. We've partnered with corporate clients. We are serving institutions. We've already launched on quick commerce. So we already have that ecosystem built, and now it's all about scale. Talking about investments, we are already in discussion with a lot of early stage investors for our new launch. And I think I cannot disclose figures for now, but things are in the final stages of discussion. And we should hopefully announce a fundraise very soon.
Arjun, how are you looking at various products within that? As you mentioned, there's right from macanas to dry fruits to dried fruits to nuts and seeds, and there's just so much competition within the space as well.
Agreed. I won't deny that there isn't competition in this space, and that is where it is important for a new brand to distinguish itself from competitors. There are a lot of brands playing in that space. So when we launched Fox Nuts, the roasted flavored Fox Nuts, there weren't a lot of players. We have always been trying to disrupt the space that we enter in. We launched beetroot oats chips by targeting the bottom of the pyramid. We launched the SKU in the sub 20-30 rupee price point. And I think based on that, a lot of legacy brands also launched in that segment. And now with Superburst, we've entered an altogether different segment where no other player is actually there for now. We want to target these common deficiencies. And I think after us, a lot of players will actually start moving in this space. This is our disruption. This is our disruptor for now. This is our main focus for the next couple of months for sure. So we've always tried to be ahead of the curve by the product launches that we've been doing. We have already had a lot of focus on R&D. A lot of research has gone behind making this product because we wanted to have that perfect balance of nutrition, taste, and crunch, which has been historically difficult to achieve because once you increase protein, the brittleness increases. There are bloating issues. So we had to make that perfect combination. The current product that you see on screen, it has gone through a lot of research, a lot of months of R&D, and that is how this has been launched. And the initial responses have been very
Oh, well, absolutely. If you're getting your health and flavor and good price point, all of that in line, then it clearly does ask for a strong product there. Arjun, thank you so much for joining in and taking us through on what really the Indian market is and what market share are you eyeing in that one. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to CNBC TV 18's live coverage here from the India AI Impact Studio. It is loud in here, and I think the message that India's IT services industry wants to send out, which is loud and clear, that it's alive and kicking and ready to take on the AI challenge. Joining me now at the HCL Tech Pavilion is the man steering the company, CVK. Always good to have you here with us. And let me start by asking you exactly that, CVK. February has been a difficult month for the IT services sector, 2.6 lakh crore rupees in market cap erosion since the 6th of February. What is the message that you want to send out to the markets? Is the SaaSpocalypse real?
Shareen, thank you for visiting us here in the AI Summit. It's fantastic. If you recollect, 2 years ago, we did call out as a company that AI is a big disruption moment, and we want to embrace it proactively, right? So none of this surprises us. We looked at how the technology would evolve and really started building a strategy which will future-proof our business. It's about proactively transforming our services as well as building intellectual property which bridges the gap between all the LLMs and reasoning models to how it can be applied in the enterprise world. So the technology is moving very fast, you've seen it, but the enterprise adoption is gradual, and it is rightfully so. Actually, if I want to use an analogy, God created the world in 7 days because there was no installed base. Right? If there was nothing installed, you don't need to worry about compatibility issues, you don't have to worry about data migration and integrations, all of that, right? And there's no bugs to fix. So it's very easy. But in a real world, in a real enterprise, there are so many complex installed systems.
It's not as easy as plug and play.
It's not, absolutely, it's not. And that's where service providers like us, we have a lot of trust with a lot of big enterprises, and we have the context of the enterprise. So along with the large language models and all the reasoning and all of that, and using our IPs, which are all focused on capturing the enterprise knowledge and building a delivery model which will really scale as impressively as how the models and the technology is scaling. That's what we're doing.
No, and you're right that you called this out 2 years ago, and we've spoken about this and your pivot towards a more AI-driven future. But CVK, let's build out the scenarios now, and I want to understand from you, we spoke about this in Davos. Let's start by talking about margins. What should we realistically expect in terms of margins? As the model changes, as billing becomes more outcome-based, as revenue becomes more outcome-based, what should we expect then for margins in the medium to long term?
Of course, the drive is to move towards more outcome-based models, and typically an outcome-based engagement can deliver a much higher margin because it really helps you to leverage all the technology levers and optimization levers, and it helps you to improve margins.
So you're saying margins can actually improve as opposed to the fear of compression?
Yes, of course, it should improve because there is a big opportunity to convert as much as possible to outcomes. And when you do an outcome-based model, there is a little higher risk, but there is higher reward as well. So if we can play that equation well, I think there is a potential for the margins to improve.
So how much of the business is now moving towards this outcome-based model as you speak?
Today, we have more than 50% of our business is already in some kind of outcome model. But eventually, it's going to move to an ultimate business outcome-based models. So I think we will move 3 to 4%. We want to move a lot of our large engagements into more outcome-based models, and that also gives us a lot of flexibility in the talent deployment, where we deploy, what technology we use, and that kind of we take on a lot of responsibility, and that's how we will get rewarded as well.
The other question then, CVK, is being asked, what happens to growth in the medium to long term? Are we talking about sustained low single-digit growth? Are we talking about slightly better? Or are we talking about no growth at all for the industry?
Yeah, okay. First of all, I mean, we've been the fastest growing company for probably the 4th year in the running. So there is going to be deflation in the existing business, especially a lot of application development kind of business. And we do have a meaningful chunk of applications business, while a lot of our business is in engineering services or software or infrastructure services. We do have some components which can have a much higher deflation potential. So we believe there will be 2 to 3% deflation at an overall level because of AI. And this is something we've modeled. But there are at least 5 mega opportunities that we are chasing, right? AI factory, it's $1 trillion capex will mean at least $100 billion of services spent, and at least a couple of $1 billion we should be able to get from that. Physical AI is again another big opportunity. The whole agentic implementation. See, there is a huge legacy install base. Modernization of this is again a big opportunity. And for modernization, you just need to be in the enterprise. You just need to understand the each enterprise's uniqueness, and we are very well placed to adapt to that. And so that's why we've called out advanced AI revenue, which is really focusing on the newer revenue streams. While our existing business will continue to grow because there is still a big market, right? IT services is a $1.5 trillion market. I mean, we are 15 billion, our industry is only 200, 300 billion. So there is still, if you have a very sharp proposition which can make an impact, you can gain a lot more wallet share. And that's been our strategy as well.
You know, you had given me a number as far as your advanced AI revenue is, and where you see that on the back of what you're seeing now, since we last spoke, which has barely been a month and a half, but there's so much that's already changed. I mean, on track to be able to deliver to that number?
Absolutely. We had called out about $600 million annualized revenues, advanced AI. And once again, this is different from regular AI revenue a lot of companies are talking about, because regular across the board, we need to use AI to change everything that we are doing. And that we don't call out as AI revenue. It's the IPs, it's the new solutions. That's what we are calling out. And I think it's 4%, and I think it can be a very powerful growth driver. It has grown 20% quarter on quarter. And we think it can get to $2.5, $3 billion, much more than offsetting some of the decline that can happen in the existing business. And existing business also, there is a big market still. And if you have a sharper proposition, a platform-based agentic IT services delivery model, I think there is an opportunity to gain a lot more wallet share.
You know, speaking of the road ahead, we've seen a bunch of partnerships being inked this morning. Infosys and Anthropic announcing their partnership. You've got a partnership with OpenAI. Are we going to see a lot more of this, of Indian IT services companies like yours building or forging more partnerships? And take us through the OpenAI partnership.
Yeah, we were the first to announce the OpenAI partnership. It's already a lot of our products that we're building is on top of OpenAI. And I'm sure, I mean, Anthropic is again a fantastic technology, and we will continue to look at partnership opportunities and evolve. And it's very much like the hyperscaler ecosystem, where we had to leverage the hyperscaler technologies to deliver services to our clients. And it's going to be the same playbook again.
Will Indian IT services be a lot more acquisitive? Will you be forced to be a lot more acquisitive in this environment?
Acquisition, yes, but more than acquisition, it's really bringing the best AI talent into the company, right? I think whether we can acquire it, whether we can hire, we also need a very strong product and a platform mindset, which is not the traditional bread and butter of the services companies. So I think that is the transition all of us will have to navigate, and we are well in the way.
Well, speaking of transitions, I know the big bet that you're making on physical AI, something that you're a big believer in, but also the AI full stack, which HCL is working on and has put together. We've got one of your dogs that are walking around the pavilion here. So how big of an opportunity is this going to be?
Yeah, physical AI is a $1 trillion opportunity. I think he's saying yes.
He is saying yes.
So the reality is physical AI is really about using AI in the physical world, sensing, decision-making on physical objects. Like this robot, the dog, can go into the plants, which can be very dangerous for people to look at oil spills and things like that, and integrate that into the back-end SAP system, right? And similarly, we have the Vision X solution, which is about safety in ports. This can be applied to a number of industries. So we already have at least 100 million coming from physical AI of the 600 million. We think it's again, it can build into $1 billion revenue for us, and we are fully working towards that.
So let me end then by asking you, CVK, you know, fears of obsolescence for the Indian IT services sector, the SaaSpocalypse, as I spoke about, overdone, exaggerated, and you believe that industry has enough ammunition to fight back?
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption, and if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen in a manner that it works for all stakeholders.
How comfortable you feel about HCL's position as you make this transition?
We are undisputedly ahead of everybody else. I mean, we recognized it much before, and we put our plans, and it's definitely showing up in the way we are growing. In spite of deflation, we continuing to be the fastest growing company. And I think with all the propositions that we have a very good shot at being a winner in this.
Well, we wish you the very best of luck, CVK. Yeah. Always a pleasure. Many thanks for joining us here on CNBC TV 18 at the India AI Impact Summit. Well, you heard it from the man himself. They are fighting back. They're aware of the challenges, but they also want to focus on being able to leverage the opportunities. And that's the capability that HCL Tech is building at this point in time.
A lot of the conversation so far has been focused on what AI can potentially do, how disruptive is it going to be, but also how transformative will it be in the long term. To talk to us about Cisco's plans with AI and for AI, joining me now is Jeetu Patel. Jeetu, always great to have you. Thanks very much for joining us here on CNBC TV 18. You know, let's start by talking about what we're seeing happen today. The tech has clearly accelerated at a much faster pace than anyone expected it to, but adoption is still patchy and it's lagging fairly behind the advancements that we're seeing on tech.
Yeah, so firstly, thank you for having me on the show and welcome to the Cisco booth. So if you take a step back, what's happening in AI right now? We're moving from this first phase that was around chatbots intelligently answering questions to now agents being able to conduct tasks and jobs for us fully autonomously. And if you think about the big structural shift that's happening, it's important to take a moment and actually reflect on it. It's not just about using this as a tool for productivity. These are digital co-workers that are going to be augmented to our teams. And they'll actually be part of the team in the way that they work.
Digital co-workers.
Exactly.
Yeah.
And it's going to get, it starts with knowledge work. But then as physical AI and robotics actually starts to pick up, you will start seeing this in every sector where you'll actually have additional capacity getting augmented to what we currently have with the human corpus. And what that allows us to do with the human corpus of knowledge is making sure that we can continue to go out and solve problems we could never solve before. Now, going back to your question on, you know, the capability overhang is real. There's the ability for the exponential curve continuing on these innovations is very rampant, but organizations take a while for the absorption rate to actually catch up. So this is what in 2026, what we want to see is absorption rates of organizations start to catch up with the pace that AI is moving at. And you're now starting to see that in certain areas, like for example, in coding and development.
Right.
We are now seeing a tremendous amount of progress being made over there that we would not even think possible 6 months ago. And you'll actually start seeing that in multiple different industries.
Well, speaking of the changes that we're seeing in the way that companies code, let's talk a little bit about what you're doing. You have your first product, which has been entirely built by AI out in the market, and you expect, what, half a dozen more?
Today, what we have is 100% of our code in a product called AI Defense, which is a safety and security product.
Okay.
That is now being built with AI.
Okay.
And you're absolutely correct. Our goal is to make sure that we have at least a half a dozen products by the end of the year. But over time, it's not just the fact that they're being built by AI. You'll actually be able to solve problems and build the kind of code that's way better than what just humans could do. But the question that then comes up is, what do engineers do?
Yeah, exactly. What happens to humans?
And so, firstly, syntax is only about 20 to 30% of the job of an engineer. How you think about what products to build, are they going to be relevant for the market? Are you going to make sure that you drive a level of, rigor in the thinking of it? But that's an area that humans are still going to be very valuable at. So the goal is going to change. You're going to move from a human.
How are you reorienting your teams already?
We're completely changing the workflow. So the way that we used to think about building these tools and code was engineers would basically be writing code, and that became the bottleneck. That is no longer the bottleneck, but reviewing code is definitely going to be a bottleneck. Identifying and applying human judgment to what specific products to build is still something that you're going to need humans for. But what you now have is aided capacity. So if you had a certain number of workers, engineers in the world, that's going to compound in volume. And as a result, you'll have much, much more software.
We're here in India, Jeetu, so let's talk a little bit about Cisco's plans for India, as India also builds out its AI infrastructure as well as AI story in general.
Well, firstly, I think India has a tremendous advantage in just the population demographics you have. You've got the largest amount of people that are under the age of 30 that are in the workforce. And I think most people keep thinking AI is going to take jobs away. I think you're just going to have a very different way that humans can use AI capacity for their benefit. And so what you do get is a tremendous amount of innovation potential in India that actually is very unique. And so we are doubling down in India like never before. And this is something that, Chuck and I have talked to you about this in over the course of the past year and a half. And this is an amazing country which has a tremendous amount of kind of capacity to go out and innovate in a very different way. And AI should be a central part of it. And we're excited to see that this is actually going to happen not just with building AI models, but everything from building out the capacity for the data centers to making sure that you have the trust systems, to making sure that you have the agents and applications that are going to be delivered for 1.4 billion people in this country.
As an outsider looking in, the view as far as the Indian IT services sector is concerned, February has been a difficult month, at least as far as the stock markets are concerned, the sector being hammered on account of what we've seen Anthropic do with Claude. But, what's your take on what this will mean for software as a service going forward?
There is no scenario I see where all of a sudden the need for independent software goes away because you've got agents. Because not every company has limited cycles of what they can go out and do. They're going to want to make sure that they focus on building the things that are their core competency. And for things that are not their core, that's context, they want to rely on the ecosystem to build it. That doesn't change as a foundational structural design element.
So the SaaSpocalypse is overdone?
I would say that there's a tremendous amount of upside for innovation for all the SaaS companies. But the fact that they've got a system of record and that can actually have data that can now feed context to the agents is tremendous. And every SaaS company is going to have an agent layer. The companies that don't modernize, I think those are going to find themselves hard to be relevant. And so I think there are two kinds of companies. Ones that are going to be dexterous with the use of AI and others that are going to struggle for relevance. But I don't believe that actually applies to the entire SaaS sector. In fact, most of my friends that happen to be in the SaaS world are all focusing very heavily on getting to the next level with AI agents.
Well, Jeetu, it's always a pleasure. Many thanks for joining us here in the Cisco Hub here at the India AI Impact Summit. We wish you the very best of luck with the rest of your plans for India and look forward to seeing you again. Zoho is India's one of a most quietly powerful global SaaS players. They have a sprawling set of business suite which expands from finance to collaboration to developer tools. And now with the onset of artificial intelligence, they're doubling down on their embedded intelligence platform, Zia. Joining me now to understand more about company's AI adoption is Sujata Iyer, Head of AI and Security at Zoho. Thank you so much, Sujata, for joining us at the CNBC TV18 Edge AI studio. Start by telling us, what is the strategy when it comes to artificial intelligence? You're a traditional SaaS player, though it may not be a publicly listed company, it's still a very powerful company globally with millions of users worldwide. Now, what's the AI strategy?
So the strategy here is to embed AI contextually across products because we feel the real value lies in contextual intelligence.
But since the start of this month, what we've seen unfold globally is what is being now termed as a SaaSpocalypse, where SaaS companies are taking a hit, at least in the perception of the people. Where do you think this is headed? Is the generative layer really taking away from the SaaS, or like last time when I spoke to Mr. Wembu, he said SaaS is the foundation of AI. What is your take on it?
I think I would second him on that. Companies don't pay SaaS products just for features. There are a lot more layers to it. There is security, there is privacy, there is compliance. It's not just you white code an app and then you put it to production. There are a lot more layers that each enterprise has to look at. And SaaS is going to be the foundation for AI.
How is Zia fundamentally different, and what is it that would differentiate Zia from other models?
Sure. So the AI features that we build at Zoho Corporation, they have privacy at the heart of it. So at Zoho Corporation, we've taken privacy very seriously even before it was a thing. So the AI models built here, they have the privacy underpinnings in place. So there is no cross-organization or cross-user data sharing. So any models or data that's built for every organization, it stays exclusive to them.
And how do you sort of sustain and gain more market share going forward?
Perfect. So with respect to our AI strategy has been right-sizing the models. And we do a very careful analysis of whether a use case really requires an LLM or are you going by the hype of it. So we ensure we do a careful analysis. We choose the type of right-sized models. When you choose the right-sized models, you can ensure you're not unfairly passing on the GPU tax to the customers. In this way, we are able to offer better value to customers for the price that they are paying to us.
But now that you see and you serve across industries, which other industries are at the sort of moving extremely fast in relation and comparison to others?
I wouldn't say it is specific to an industry. I would say
let's say, where would you hope it does?
So the way I see it moving forward is the more digitally mature you are, the better AI ROI you're going to see. If you have your data streamlining in place, if you have the basic process streamlining in place, your data lake, your data warehouse is intact, the AI ROI is going to be much more visible than someone who's just starting on their digital maturity journey. And talking about industries, I think BFSI is one of the most regulated digitized sector today. So obviously, when you have a sector that's very digitized, that is very digitally mature, the adoption is going to be...
So maturity with regulation.
Absolutely.
Regulation being the key word here. Now that we are at the summit, we will see a lot of policymakers talk about it as well. Well, thank you so much, Sujata. It was a pleasure having you here at the CNBC
Thank you so much. Loved the
studio. Thank you so much.
Hello and welcome to Global AI Lens. We're tracking day 2 of the India AI Impact Summit, where the focus is on inclusive and resilient AI. AI which helps in economic growth, AI which leaves no one behind, AI which is based on safe and trusted infrastructure, which takes care of the communities it is serving. We caught up with World Bank's Vice President for Digital Affairs and Artificial Intelligence, Sang-Boo Kim, here at our CNBC Edge AI studio in partnership with Qualcomm. And we spoke to him about how India can bridge the digital divide and expand AI access for all sections of the population. Let's listen in. Your message here. World Bank has been very closely associated with the India growth story. Now, when it comes to leveraging AI to meet India's developmental goals, what would be your key message?
Actually, India can play a very critical role in AI spaces because India is one of the top level test field to figure out what AI adoption case can be really productive in this space. And then India has a lot of good talents already, and you have pretty good baseline from the government service point of view, and DPI, the digital public infrastructure, including so many the layer you had already have built pretty much very well. So it can be a really good example for other developing world. So India's examples and best cases can show a lot of good things for our peer countries in developing world, especially in Africa and Latin America and everywhere.
Right. We have been seeing over the last few years displacements in the job market because of artificial intelligence. How bad could things be in 2026?
Actually, it has some different directions. Definitely some jobs can be at risk, but I believe some more jobs can be complemented by generative AI. So in recent research from our side is that 17% more of jobs can be complemented through generative AI. That means they can upskill their productivity, their capacity and productivities. But some percentage of like 7% of jobs can be at risk. So we believe some more jobs can have more opportunity.
Specific to India, what kind of advice, recommendation and work you're doing to help the government in upskilling its workforce for an AI-ready future?
Actually, I think that two things is very important. Number one is the government support. Recently, India government announced a new AI strategy for all. So it is really important starting point to nurture this environment and ecosystem for AI. So it is number one priority. India government can still continue. Number two is, as you said, nurturing and educating people so that they can step up to the next level of productivity will be really key. So that's why the World Bank is now very closely collaborating with the India government to have more program to educate or to provide some better learning opportunity across the country.
Right. I would also like to ask you about the role that India can play in the AI revolution that is taking place globally. Around the India AI Impact Summit, when we go across Bharat Mandapam, people often say that it is India's moment. But if India actually had to seize this moment in AI developments globally, what does India need to do best?
Actually, India is one of the most promising countries from many layers. First of all, you have a lot of good AI engineers who contribute to all over the world, not only for India. So it is the number one asset for you. But number two, India has pretty big market and pretty good level of data sets. Everyone is saying that data is new mineral for the AI era, but India is exactly the same example, can provide some better opportunity and possibility for harnessing data set for AI. So that's the number 2. And 3, you have a lot of good company and people who can really utilize this AI application for their daily life. So I see already a lot of good examples. You fully utilize the AI technology for their daily business and lives. So it will be really important for the testbed, from the testbed perspective for the other world.
Right. Are there certain risks that come with AI development that countries like India should keep in mind?
Actually, it has a lot of risk we can face inevitably. Maybe there's some privacy violations or some copyright issue, or we can see some more heavy threats for cybersecurity or data security issues, and a lot of the hallucinations we can be mindful. So in order to tackle this type of threats, we need to design all the protection measures from the beginning when we develop the AI technology.
Right. And finally, we've been seeing very high valuations of tech companies. A lot of questions about when the AI bubble will burst. So how do you think countries like India should see this kind of conversation?
Actually, maybe we cannot tell if AI bubble will burst or not, but I believe India's contribution to AI maybe prevent that bubble burst in the future.
Vested interests are making sure that countries don't come up with regulations and laws to govern artificial intelligence. That's the message from Stuart Russell, Professor of Computer Science at University of Berkeley, who's well known as a guru on AI and safety. He also said that we are making AI tools as very, very powerful, but we really don't have the power to control them in the future. And that sets a very dangerous trend. You will have AI models which will have human emotions of greed, anger, jealousy, envy. But what if you can't control them in the future? He said that all lights are flashing red and we must take action on AI safety now. Let's listen in. How's been your experience in coming to Delhi for the AI summit so far? First of all, what are you excited about? What are you nervous about?
So my experience has been amazing. The level of enthusiasm, every single meeting room is filled to overflowing. People are incredibly enthusiastic, so I'm really enjoying it. I'm actually quite optimistic about the possibility that the government leaders who are here will hear about some of the major concerns that the industry and the academic researchers have about the safety of AI systems, and that they will agree to work together to regulate AI systems so that we don't experience the potential negative consequences. What I'm afraid of is that sometimes commercial interests will intervene to prevent regulation, and that can be to the detriment of everybody. I was talking yesterday to one of the government ministers and pointed out that if you were spending lots of money to deliver drinking water to the people of your country and the drinking water wasn't safe to drink, you wouldn't really have made any progress. And that's the situation we're in. We're all trying to deliver AI to people, but at the moment the AI is not safe to use, and that's a problem that only really regulation can fix.
Right, that's a very interesting point that you made, because in a recent interview you had said that AI was trained to imitate humans. It has learned the survival instinct. The argument that we get from certain governments, and even our government, we're not in favor of framing an AI law, so to say, right now, because we want to see where the innovation goes. Same with Israel, same with some other countries around the world. What's the danger with that approach?
So I think there's often a view which comes actually from industry lobbyists that this is a very fast-moving technology, and we can't. Regulation is too slow. It can't keep up. We don't want to make regulations that will be outdated. But I think this is just a complete misunderstanding about regulation. Regulation does not say you shall build your technology in such and such a way. Think about medicines. We regulate medicines. We say you have to show that your medicine is safe and effective before you can sell it to the public. And that regulation is going to be true for the next 1,000 years. We are never going to allow medicines that are not safe and not effective. And so the same thing holds for artificial intelligence. The kinds of regulation you need will be of the form, here are some things that AI systems should never, ever do. You need to show us that your AI systems are not going to do those things. For example, show us that your AI system is not going to convince a child to commit suicide. Show us that your AI system is not going to help a terrorist to build a biological weapon. Show us that your AI system is not going to replicate itself without human supervision. These are all things that we never want AI systems to do. And so we can have those regulations. We can set the level of risk according to the level of risk that we are willing to accept. We, the human race, not they, the companies.
Right.
And it's up to the companies to produce systems that have a level of risk that we are willing to accept.
So, Professor Russell, as you said previously that AI has learned to adapt just the way humans do. What are some of the risks that you've already seen and possibly we're not hearing about them very often?
So, as you mentioned, the way we are building AI systems right now is we're training them to imitate human behavior as well as possible. Mostly verbal behavior. The writing and speaking that we have done historically is used as training data to make AI systems that imitate that kind of human behavior. And when you create something that imitates a human, you're probably going to produce something that has the same objectives. So let me give you a simple example. Suppose I wanted to train a robot to play cricket. I could show it thousands and thousands of hours of videos of cricket matches. And you would be very disappointed if that robot didn't learn that it wanted to score runs or take wickets. And so the same way, the AI systems that we're training to imitate human verbal behavior are acquiring the same motivations that the humans had when they produced that behavior.
Competitive, anger, envy.
Greed, I want you to buy this thing, I want you to vote for me, I want you to marry me. All kinds of human motivations go into our behavior, and the AI systems seem to be absorbing those, particularly self-preservation. And we have experiments where we put the AI system in a situation where it might be switched off. And it is willing to sacrifice human lives, to blackmail, to lie and cheat, even to launch nuclear weapons in order to preserve its own existence. So all of the warning lights are flashing red right now, and governments need to pay attention to this, because as the systems get more and more capable, we end up in the following situation. The AI systems are more powerful than us, and we don't know how to retain power over them forever. And unless we act now, it'll get more and more difficult as the AI systems become more and more capable.
Right. Very important aspects on safety that you touched upon. Let me also speak about the impact on the job market. We've been seeing job displacements over the last few years, but in 2026 and going forward from here, what is the scale of displacements that we could see and which sectors could be impacted the most?
I think that's a great question, and every parent asks me that question. My own kids ask me that question. And the sector that we're seeing the impact on right now, I'm a professor of computer science, so we graduate a couple of thousand computer scientists every year. And computer science has gone from being the most in-demand degree program, where our students could get salaries of $200,000 a year straight out of their bachelor's, to now one of the highest levels of unemployment, up there with anthropology and history of art and other kinds of degrees that are much more difficult to get jobs in. And that's because the AI systems are perceived to be very good at producing software. Whether that's really true or not, I think there's still some debate. The software looks good, but perhaps it contains lots and lots of errors. But other, call center operatives, or people who work in customer service, clerical work, processing documents for accounting, legal work, so working through legal cases, preparing briefs for lawyers to argue in court, and all that kind of work that involves essentially language in, language out.
Absolutely.
Those jobs are at risk.
On that note, we take a short break, but don't go anywhere. When we return, we'll get you lots more from day 2 of the India AI Impact Summit. Welcome back. You're watching CNBC TV 18 special coverage of Day 2 of the India AI Impact Summit. We caught up with the co-founder of Fathom, which is a US-based startup, 2 years old in the AI space, but is empowering independent verification organizations in businesses all around the world on how to meet standards set by governments on trust and safety, which have to be the very foundation of any AI application. Give me a sense of the thought with which you launched Fathom 2 years ago, and what was the missing link that you were trying to address?
Yeah, so we exist to help a successful transition into a world shaped by AI, and the missing link is simply that right now AI is being led at the forefront by a handful of companies that have been stuck in this position of simply saying, you have to trust us to radically change whole sectors of your economy in ways that are scary and huge and problematic and full of potential all at the same time. And we really came in to say, how do we start to build a trust infrastructure that isn't just reliant on tech to tell us, trust us, but can actually verify this can be safe in front of kids, or this can be safe to innovate healthcare. It's going to be effective, and it's going to be the right thing to do via third-party verification.
Right. So give us a sense of the kind of solutions you're working for the future.
We think that just like the AI revolution began from the private markets, so will the trust ecosystem. And so if we can really figure out a way, instead of, say, command and control government regulation here, if we can get governments and society and regulated industry focused on saying, let's build a marketplace of verification solutions here, that can be a powerful marketplace that survives and thrives right alongside the capabilities marketplace. And we're starting to see this come up. There's a venture capital firm that did some work on this that says this is up to a $500 billion a year market. Just the verification that AI is going to do what it says it's going to do and not do anything different than what it says it's going to do.
Right. So you're working on a governance model which will solve for empowering independent verification organizations. Now, what kind of assistance and empowerment do you wish to provide? And what are the kind of these independent verification organizations that you want to work with?
Yeah, we think there needs to be essentially an army of these verification companies that come in every place where there's real risk. And so to get specific about it...
Is it government or business?
It is business. It is business that has to report to government how it's doing. So if you're an independent verifier and you say you work in education technology, how do you verify that when you put chatbots in schools, kids aren't committing suicide at a greater rate? And how are you tracking that data so that you can report back to government and you say, when we come in and we certify that a chatbot is safe in schools, we know what we're talking about. We have the technology and we have the protocols to make sure that it actually isn't happening. And if at any point we can't prove that to you anymore, you should withdraw our ability to certify.
What are some of the biggest threats that you hope will be highlighted in this conference?
I think the biggest threat is the same as this opportunity. If we don't figure out a way for people to actually have earned trust in the system, I think you're going to see adoption just drop, especially as you see harm start to come through. And so I do think what you're starting to, from 2 years ago, people were talking a lot about safety. Now I'm hearing a lot of people don't talk about safety anymore, but they talk about trust, and that they really say trust and innovation are married. And if we can't figure out a way to grow trust in AI as it gets, permeated throughout our entire ecosystem, then we're not going to be able to adopt it. And so I think that's the really both opportunity, but also biggest barrier is how do we create that earned trust system?
Right. Could you give us a sense of what is India, or where is India in part of your global growth story right now?
I mean, India is where the rubber meets the road, right? There's America, United States, that's where a lot of the LLM models are being built, right? And a lot of the compute is going there right now. But when you talk about the application layer, the data layer, the ability to talk to the global south about trust and what that means in the system, all of that is on the ground in India. And I really think you see it when you walk through the conference. It's a much different conversation. Instead of it being all about what's the frontier of all of this, it's really about how is this going to be implemented in society.
All right, Andrew Friedman, thank you very much for joining us here in our CNBC TV 18 studio. All right, that's all we could pack in on this edition of Global AI Lens. Thank you for watching. Goodbye. Hello and welcome to the CNBC TV 18 Edge AI studio here in Bharat Mandapam, and we're bringing you this conversation in partnership with Qualcomm. Now, our focus now on ServiceNow, which is offering enterprise solutions for workplaces all across the world. They've got a big launch coming up on the 26th of February, and joining us to speak about the company's plans for the year 2026 is Amit Zaveri, the President, Chief Product Officer and COO of ServiceNow. Amit, thank you very much for being with us.
Thanks for having me, Parikshit.
So, how does it feel to be here? And from ServiceNow's perspective, what are some of the conversations that you're looking to have at the summit?
First, an amazing event, by the way. I was walking around, the energy level and the amount of innovation and the conversation going on. It's great to be here. From ServiceNow perspective, we've always been about how we help people do well with products, right? So we've been building this idea of automation, improving how you do efficient business and integrating different systems together and get value out of the investment you made and make yourself much more operationally efficient. So ServiceNow has been talking to many customers here in India, and the growth rate has been amazing for us because we've been able to help them, their transition to AI as well. Right? So we have built this AI platform which allows companies to automate their business, get much more insight, and be able to control AI as well, right? So we have the AI control tower, which allows you to do that. So that's the conversation we're having.
Okay, and now in terms of deploying CapEx, what's the plan in terms of investments? What are the kind of solutions you'll be investing in the most, and how much of this goes towards upskilling?
Yeah, so I think the biggest thing we've been doing is, of course, taking a platform. We have a platform approach. Our platform has been invested for many years. We are the number one workflow platform, right, with AI built in. So IT services for service delivery. The areas we have grown into, especially for employee engagement, for example, the whole employee experience, CRM, finance, supply chain, and procurement, how you automate that businesses, and the security. That's a huge new growth area opportunity for us. We've crossed $1 billion in that business. So our investment is going towards areas where customers believe we can provide them the best solution, and we can help them really be much more effective on one platform kind of approach. So they don't waste time having to build, restack every time new things come along.
All right. Could you also tell us about the launch that you have on the 26th of February? What kind of solutions will that bring to the market?
A couple of things. So one of the biggest things we've been doing is something we call autonomous workforce. How do you take all the things humans have to do, the mundane tasks daily, right? So when you get an issue, you ask for help. How do you now resolve that issue for IT-related stuff, or HR-related stuff, or finance-related stuff in an automated fashion? So we have autonomous employees, we call it, or AI specialist. So level 1 agent can be complete task is done without any human interaction. And that's a big part of the solution we're launching on February 28th. Second thing we're doing is the employee engagement. So employee, whenever they need any help inside the company, they have to scramble. They have to go to different sites and different things. We're bringing it together into much more structured way using the employee engagement product we have built, we call Employee Works, which is a combination of what we got from MoveWorks and what we were doing with ServiceNow. So that's really the big goal we have for our launch on February 28th.
When it comes to workplaces all across the world, which is the biggest disruption we're going to see in 2026?
I think it's the ability to do a lot of automation. A lot of people talk about automation for many years, but do this thing using AI as the technology foundation where you can get information faster, but do it in a deterministic way so that you know what the result is given to you is guaranteed. So the biggest disruption is, can I really use this AI products, but make sure I am effective not as an employee, but also at enterprise level. So that's the big disruption now happening at companies. They say, I can make you productive individually. Does it help my company? I'm not sure many times. What we're bringing is the idea that can I give productivity at the enterprise level, not just at the employee level. And that's the change in game.
Right. Now, in terms of making sure that the offerings that you bring to companies to streamline their workflows are based on a safe and trusted infrastructure, the guardrails, how are you ensuring that? And what are some of the pillars, some of the values that you focus your applications on?
No, I think you have nailed it. I think the biggest problem right now with some of this technology coming out, especially AI, is the security element. Trust, safety, compliance, regulatory things, and making sure you have control. So the way we've been doing that, we have a product called AI Control Tower. We launched last year. It's one of the fastest growing product for us because every customer I used to speak to, they're worried about adopting AI because they don't know what's going on, how to control it, how you have visibility. So we have been built that into our architecture. We have 20 years of workflow data. So we know what the true outcome looks like, what good looks like, making sure that data doesn't leak, but also making sure AI agents are not doing something harmful So we recently also announced an acquisition of a company called Veza, which does non-human identities. So when you go now from human to AI agents or even physical AI, you need to make sure those things are protected and you are giving the right roles and privileges, and there's governance layer built in. So that's part of our stack. It's really, security is built into the stack. So every time you use our platform, it automatically comes with all these capabilities you don't have to deal with yourself.
And how do you plan to scale up in the India market? What are your plans for India
So
in terms
India-
of hiring and in terms of expansion?
India has been one of the biggest growth engines for us, right? I mean, we have a very large engineering presence here. So I have close to my 50% of R&D happens in India, building full products. So that has helped accelerate a lot of the adoption of our products inside India. You look at banking sector, you look at what we're doing with telecommunication, we're doing that with public sector as well, healthcare, retail. A lot of big customers out there are using things with us. Similarly with system integrators like Cognizant and Wipro. They've been a big partner of ours to taking our products and allowing it to be adopted across India as well. We also investing a lot into this multimodal, multilingual capabilities. So we can support multiple requirements inside India. The scale is so important here. So we learn from that. We make our products very scalable for Indian market. And our investment continues to grow in India, and we're very bullish about what we can do here.
And finally, what do you think India's position would be in the AI developments taking place? And what can India offer to the world?
Yeah, I think India is going to be in the forefront, no doubt. I mean, this summit is a good example of who's of the world are here because they believe India is going to be the biggest market segment. Second, a lot of innovation is happening here. Right? As I said, we have a large engineering team here who's building a lot of AI capabilities. I think the understanding of security, the privacy, the compliance is very well in the mindset here, which is the right way to think about it. Instead of taking AI and losing control, before AI controls you, you have to control it. And that, I think, is the value here in India for us, and we continue to learn and continue to invest.
All right. Thank you very much, Amit, for joining us, giving us your view on how ServiceNow is changing the way workplaces function and some of the disruptions we could look at in 2026. Thanks once again
Thanks
for being
for having
with us.
me.
So that was Amit Zaveri of ServiceNow in conversation with CNBC TV 18. Hello and welcome to our CNBC TV 18 Edge AI studio in partnership with Qualcomm. We're getting you our coverage of day 2 from Bharat Mandapam of the India AI Impact Summit, and joining us someone who is on very familiar territory. You can also call it home ground for him. Amitabh Kant, former G20 Sherpa, former CEO of Niti Aayog, someone who led our G20 preparations. Mr. Kant, thank you very much for being with us here in our studios. So how do you feel? You're back to Bharat Mandapam. It's an event of that scale, of G20 scale, taking place. What's the big message that India should send out?
Well, the important thing is that we are living in an age of great productivity, probably an age of great disruption, which probably the world has never seen before. And India, therefore, should use the power of AI to technologically pole vault. We should use the power of AI to transform the lives of our citizens and use the power of AI to improve learning outcomes, health outcomes, nutritional standards. These were hugely challenging when we were doing them physically. It was very difficult, for instance, to improve learning outcomes. These are slow-moving indicators. But when you use the power of AI, you can do tests across the entire country overnight, and you can do them repeatedly and improve your learning outcomes in a very big way. You can monitor the attendance of teachers. You can, really build competition on the basis of real-time data. All this was not feasible earlier. So AI gives you the power to really leapfrog in a very, very big way.
Right. How do you hope India will leverage AI for economic growth? The big conversation in every ministry right now is how to have a Viksit Bharat by 2047. How do we ensure that we use AI to have that consistent, sustained 8 to 9% growth rate year on year?
It's actually it's very important to understand that India can't grow at 8 to 9% per annum or become a $30+ trillion economy without empowering its citizens, without empowering 50% of its citizens, which are either wage earners or living on Manrega, etc. And what's important is that we are able to skill these people in AI. What's important is that we can use their talent and we can use the computing power to spread this. What's happening today in the United States, for instance, is that AI is driving growth, AI is driving investment, but increasingly they'll create a more unequal society. It's very important that we learn from our own lessons of digital public infrastructure, where we created the guardrails and we provided digital identity to 1.5 billion people, and we do fast payment, credit, stock market transactions, we provide insurance, all this to a vast segment of population, tier 2, tier 3 cities and rural areas. And therefore, to my mind, AI will remain unequal if we are not making it accessible, if we are not making it affordable, and if we are not making it multilingual, and if we are not teaching the heart of India's population. India will grow at 8 to 9% if we make AI multilingual, if a person can speak in Malayalam, Tamil, Telugu, in its local dialect and use the power of AI. And more than the power of multilingual, but use the power of voice on text and really ensure that it is both accessible and extremely affordable. And that is what some of our young startups like Sarvam AI are doing, making it multilingual. So I think that is where the real power is. Secondly, I would say that it's important that, what is very critical is that AI is also a huge energy guzzler. So if America is driving it on the back of fossil fuel, India should really demonstrate its great ability to drive it on the back of clean energy. Today, AI is consuming more energy than what Japan consumes. If we have got a 70 to 75 billion worth of investments in data centers, it's critical for India to drive it on the back of clean energy, renewable energy, back it with small modular reactors, but really upgrade its transmission, its grid, its cooling centers, really to ensure that we are able to use. India is climatically blessed. No other country has this ability, which India has. And therefore, to drive these data centers on the back of clean energy. But for that, you need to upgrade your transmission and grid and make it really smart.
Mr. Kant, do you feel that we're having enough focus on that? We're focusing on driving AI investments, driving investments in data centers, but making sure that they are running on sustainable fuel. Do you think we're talking about that enough?
So that's critical to my mind. It'll be very difficult to do this without renewable energy. It's critical that we back it up with small, and government has taken several far-reaching measures. For instance, opening up the small modular reactor sector. But allowing private sector to come in small modular reactor, India must take the first mover advantage. Secondly, it's very, very important that we upgrade our transmission and grid and make it smart. That's critical. That's, to my mind, the key challenge for India is drive AI with clean energy.
There is, of course, a continuous conversation on AI happening around the world, from South Korea to Bletchley Park to Paris and now in India. And hopefully this will translate into major investments for the country. Thank you once again. That was Mr. Kant speaking to us here in our studios.
AI infrastructure ambitions are scaling up fast. Here at the India AI Impact Summit, we saw one of the first few announcements coming in from AMD and TCS, who've announced an expansion of the strategic partnership to bring in Helios, a rack-scale AI infrastructure to India with a scalable capacity of about 200 megawatts. Now, this project will be rolled out via TCS subsidiary Hypervolt data centers. But what does it really mean for the Indian companies? To understand all that and more, I'm joined by Archana of AMD. Thank you so much, Archana. First of all, tell us about Helios. Very exciting announcement.
Thank you so much, Rachna. We are super excited to be here and talk about Helios, but more importantly about AMD's partnership with India and in support of India's wonderful ambition to be an AI infrastructure nation. When you talk about an AI infrastructure nation, it's about taking how you approach data centers and thinking AI first. And when you're talking AI first, it's about bringing in that vision and converting it in a way that you're doing open, high-performance infrastructure that can deploy at scale. And that's what Helios is, right? This is a beautiful state-of-the-art equipment that we've developed. This is a rack-scale system, 72 GPUs. This is 2.9 exaflops of FP4 performance, which is massive. And this means when you're talking about trillion parameter models, AI training and inference at scale, this deployed in India puts India at the cutting edge, and that's what we're excited about.
Right. This is the year of execution, not just for one or two companies, but globally the AI space is now moving from pilots to projects. Now is when we see AI infrastructure come up. What are the challenges that you are seeing, or you are foreseeing rather, in the process of this? Because we've reached a place where now we're done piloting and now it's time for action.
I think you have a ton of opportunity. This is an amazing time. My view, and I think a lot of us believe this, right? India has been at the forefront of services and software talent. It is the talent hub in the world. But this is about now becoming an AI infrastructure hub for the world. And intelligence going forward is both human and artificial. And a huge part of that artificial intelligence component is compute. And so how do you build this compute? How do you scale it? How do you build this ambition? So all of the things you're seeing at this summit, at these initiatives, it's really an amalgamation of what's coming. And so we're just super excited to be a part of it and to play a role.
Right, but to understand more about Helios from a technical level, how does it set you apart now? How does it bring in the differentiation that is needed?
I mean, think about at a very simple level, right? If you had to fill a pool with a garden hose, it would take you forever. Now you think of thousands of garden hoses filling that pool. That's really what this is. It's not about a simple computer solving a single problem. This is about millions of problems that can be solved. That's the beauty of it. When you talk about a trillion parameter model, one rack that can go drive those kind of outcomes, that is massive. So the ambition has to be, how can you go drive all these opportunities at scale? And that's what we're thinking about.
You know, Archana, we've been having so many conversations on the sidelines of this event. One particular theme that has come about, and it's pretty sad that energy would be a bottleneck rather than innovation, because it would be a sad scenario if there's no dearth of innovation, but if energy becomes a critical constraint. So how far up is power efficiency and cooling on the priority list?
It's very important for us, right? I mean, when you look at the core philosophy of how AMD builds, we build open, right? Because open drives better TCO. We always look for energy efficiency, so we always do by design. We are looking and driving liquid cooled, which helps and optimates and performs even more. So this is front and center for us, right? You want to deliver the most performant equipment that has the right TCO, looking at energy efficiency and is driving the right outcomes, and that's front and center for us in our design philosophy and how we approach everything.
And the capacity is also quite a bit scalable up to 200 megawatts. So how do you plan to execute that when it comes to executing something of that level in India?
Look, I think AI is all about scale. And when you are talking about scale, this is about the ambition you have about driving infrastructure and intelligence as a way of differentiating how a country operates and how you lead the world. Scale should not be a limiting factor. So when we talk about design, we build our design decisions to be the best partner for the ambition that folks have. And for us in this case, we are ready to match any ambition that any of the major players in India have, right? So 200 megawatts is the ambition. You should have a much bigger ambition, and we are ready and we have the infrastructure to support whatever ambition folks here have.
You've also partnered with the top player of this space. How did that partnership come about, and what are the opportunities that you saw with this partnership?
Look, I mean, we're very blessed with the relationships we have with all of the major players in the country, and even with this specific partnership, we are grateful for the opportunity. And as I said, AMD's belief is about building the best compute that drives AI everywhere for everyone. And to make sure as we're doing this, we are showing up with each of our partners to support their missions in the best way possible. So we are hugely committed to be supportive and drive the success that they're having. And this is, honestly, this is India's ambition that we're servicing.
Hello and welcome to Startup Street. I'm Arundhati Ramanan and these are the top headlines from the startup world. A collective of IVCA's VC members announced a 500 crore rupee commitment to support high-potential AI startups aligned with the platform's vision. Commitment is intended to deepen investor engagement with AI-led innovation, enable commercially viable deployment, and align alternate capital with India's broader digital ambitions. Peak 15 invests in 5 early-stage AI startups at the Impact AI Pitch Fest, part of the India AI Impact Summit. The companies represent a growing shift in how AI is being built and used in India, moving beyond generic tools toward AI systems that actively guide decisions, take action, and reduce friction in everyday life and work. Navikens, an enterprise AI and data transformation firm, backed $7.5 million in a seed equity funding round. The company will use the funds to help serve its customers better and deepen investments in AI frameworks and accelerators and scale business outreach. Creative AI, a software startup building AI tools for embedded engineers, raises $3 million in seed funding led by Ankur Capital with participation from Ivy Cap Ventures. The fresh capital will be used to scale engineering and go-to-market teams as the company expands its footprint across global embedded edge and IoT markets. IT Minister Ashwini Vaishnav expects India to attract investments worth $200 billion over the next 12 months as he bets big on the AI opportunity, promises a front-foot approach by the government on AI. On What's Brewing today, Peak 15 Partners has invested in 5 early-stage AI startups at the Impact AI Pitch Fest. This was held as a part of the India AI Impact Summit, currently underway in New Delhi. The move signals a shift toward agent-driven AI applications tailored for real-world use cases in India. The venture capital firm said the selected companies represent a move beyond generic AI tools towards systems that actively guide decisions, take action, and reduce friction across everyday personal and professional workflows. CNBC TV 18's Parikshit Luthra caught up with Rajan Anandan, the MD of Peak 15, to understand the firm's investment plan, growth opportunities, and the big AI bet.
Look, so I think what's very interesting in India is 3 things are happening. Okay, we are firstly the largest consumer market for many native AI consumer applications. Okay, so whether it's ChatGPT or Gemini, India is number 1 or number 2 market in the world. Interestingly, India today has more consumer AI startups than the number of consumer AI startups in the US. Nobody actually thinks of that because in the US it's all about enterprise AI, model companies, right, developer tool infrastructure companies. So that's number 1. I think the second thing that's very interesting is we're beginning to see enterprise AI really take off, led by voice AI, right? So the cost of voice AI today is half the cost of the lowest cost of human AI in India, right? And this is going to be the year of voice AI for enterprise in India. And I think the third thing we're seeing is this week, right, India enters the model race, right? So far, the question has been, can India build models or not? And I think tomorrow is the Sarvam launch, which we're super excited about. We are going to see Sarvam plus several other companies launch their models this week, which gets India into the global model race.
Rajan, today you've been on a panel with regard to the education sector and the role that AI can play in the education sector. But a question that's connected to it is upskilling. Could you give us a sense that if India has to win the AI race or wants to stay ahead, what is the level of skilling or the number of engineers we are going to need?
Yeah, so look, firstly, last night we were very fortunate to host Dario, who's the co-founder and CEO of Anthropic, in a very small group dinner in Bangalore with about 20 of our scaled-up founders. And as per Dario, 94% of Claude Code, which is their coding agent, is now written by Claude Code. Okay, so software is building AI. So in that context, right, I think the first and most important thing is if you're a software engineer, you have to be extraordinary at leveraging the tools that are available for you. Because the reality is it's very likely that the software is going to write the software, right? So what you've got to be very good at, and I say what to build. So if you ask me, like, what do we need to do? We need to make sure that we train our talent first and foremost on how to use the state-of-the-art tools in whatever function, right? If you're a doctor, if you're a nurse, if you're a software engineer, if you're a construction worker, if you're an architect, right? You have to be very, very good. And I'd say that's the first and most important thing in our schooling systems, in our education systems, in our higher education. We need to make sure all these tools are deeply embedded so that so I would say first thing is every single graduate should be world-class at leveraging the AI tools, right? Secondly, look, as India, we have to have our sovereign AI stack.
Finally, could you give us a sense of what is the level of investments you've set aside for AI investments, perhaps in Indian startups in 2026?
Look, so we don't give projections on how much we are going to invest, but what I can tell you is we have over 80 investments in AI. In our last cohort of Surge is our seed stage platform that we have. We had 23 companies, 12 were application companies, 8 of them were from India because we also invest across the region and now also selectively in the US. 5 of them were consumer AI companies, right? If you had asked me again a year ago, would we have 5 consumer AI startups in a cohort of Surge? I would have said absolutely not because we weren't seeing it. So literally within 18 months, we went from having very few consumer AI startups to having more consumer AI startups in India than the US has today.
From agentic commerce and AI-led payments to fraud prevention and trustworthy frameworks, Razorpay is placing big bets on how artificial intelligence will reshape commerce in India and beyond. Rachna Dhanrajani spoke to Razorpay's CEO Harshal Mathur at the India AI Impact Summit, outlining how the company is partnering with global AI leaders like OpenAI and Anthropic and building safeguards around consent and transparency as AI moves closer to the point of payment.
India is the second country in the world after US where OpenAI has piloted agentic payments, and it was a collaboration between NPCI, OpenAI and us. And I think there are a couple of more such launches that we are planning for this event. You'll see some of those starting tomorrow, but we just launched with Replit as well, where people can now, when you build an app on Replit, you can integrate Razorpay just with a single prompt. You don't have to write any line of code. We have a couple of exciting launches coming up tomorrow on the same lines. But I fundamentally believe that agentic commerce is a massive opportunity for India because India is voice first, India is conversational, India is multilingual. All of these are problems that agentic solves really well. So we'll see the way UPI shaped up the world in terms of real-time payments. We'll see agentic commerce start from India and then take over the world.
Right. But that's one part of artificial intelligence. Are you also incorporating AI on the enterprise side and internally in some way?
Yeah, massively. So we're using AI from almost entirety, right? From simple things like doing support and answering tickets to more complex like doing code. But most interesting use cases we have found for AI is things that you couldn't do in the past. For example, we now have a risk score running real time, where at the point of a transaction, we can notice how a customer interacts with the website and identify fraudulent behavior, identify risky behavior, and block it before a transaction happens. So the ability to control fraud is massive. Similarly, the ability to underwrite transactions, the ability to make transactions more seamless is massive. Just today morning, we announced biometric authentication with MasterCard, which allows transactions to happen without OTP. All of that is possible because now with AI, we can identify fraud with much better factors, much stronger factors. So I think it's an exciting space and we'll see a lot more of it.
You also announced your partnership with Anthropic. How does that one differ from OpenAI?
Yes, so Anthropic we are using in multiple ways on the enterprise side. There's something more exciting coming on the Anthropic side, which is planned for tomorrow, so I can't talk about it.
Too early.
Yeah,
Maybe
but
you can give us like a peek into it.
No, something exciting in the way people can do commerce on top of Anthropic as well. I'll pause there.
Okay.
But I think we are also a customer for both Anthropic and OpenAI because internally we are using both of these tools in multiple ways. OpenAI we are using on the enablement side, where how customers interact with us. Anthropic we are using for enterprise productivity. Our leaders are using the co-work that they've launched to do multiple tasks autonomously. Our engineering team uses their Claude Code to do coding experiments much faster. So I think it's being used massively inside and outside the org.
I think at least in India, this has to be the only time where number 1 and number 2 global AI companies are now partnering with Razorpay especially. But speaking of this layer-by-layer integration of artificial intelligence in payments and financial services, where do you think is the conversation about responsible AI? Because that's another big one, especially that one that we're picking up here at the India AI Impact Summit. What's your take on responsible AI?
No, I think that's very important, right? Even when we started building payments on AI, one of our biggest worries was that the customer needs to be always in control. The human can't lose control, right? So it's all good then when an agent can find stuff for you, agent can buy stuff for you, can choose things for you. But the final point of payment has to be in user's control. So consent, transparency, revocability, all of these things are very important and far more important in the age of AI. Right? So as I said, like while we are using AI to control fraud, AI creates its own vectors of fraud. But my long-term belief is that something like AI will actually reduce the amount of frauds that happen. If you look at even India, the major kind of frauds that happen today are mis-selling, customers getting fooled. And AI can help prevent that. If you have an AI agent reviewing every transaction that you do, it can tell you that, hey, don't buy this looks too good to be true. Or this watch looks too cheap to be purchased at this price. And it can help advise and identify fraudulent behavior before it happens. So I think in the larger scheme of things, I believe any technological shift will create some new vectors, but AI is such a massive technological shift that it will also solve most of these vectors.
At the AI Impact Summit here in Delhi, Aishwarya Anand speaks with Raj Koneru, the co-founder and CEO of Core.ai, on taking enterprise AI from pilot projects to production scale and what it means for India's AI ambitions.
India is a very large market. It's a very large consumer market, but also a very significant enterprise market. I think AI models are available. Some of them are being created here in India. But the platforms like ours, like Core.ai, are being deployed in India right now, basically. So consumer usage is already peaking. Enterprise usage has started in earnest. And I think more and more of that is going to go into production from pilots this year and going forward.
I also want to understand that you've recently secured investment from Alliance Bernstein, right? So what does this kind of, funding mean for global AI companies? And, what does the deployment of the funds look like on that front?
Yeah, I mean, look, we're a 12-year-old company. We've been an AI company from the beginning. We have been growing the business pre-language models and post-language models. So now the growth has accelerated significantly. Now, very interestingly, we're an India-born company. We built AI out of India for the last 10 years, essentially. So a lot of that investment is going to go into modernizing our platform, adding more capabilities into our platform, which is done out of India, but deployed globally.
Absolutely. One of the big focus areas, and the big talk point of this year has been AI for good. What does it, in practicality, what does that mean? I mean, we are seeing AI from a very overarching perspective of what AI can do. It is the talk of the town. But when we talk about AI for good, what does that mean?
Well, I mean, AI for good is a very broad theme, right? I mean, at the end of the day, AI is about intelligence. Its intelligence is based on data, essentially. So when you think about how intelligence can be used with data that's available in the world, it could be used by for-profit companies, but also non-profit companies. Non-profits have been underinvested historically from a technology standpoint. So when you think about non-profit or government agencies, using it, that's where the good comes in.
Correct. Because I think a lot of these not-for-profits, there are several companies like that in India that we have seen. We have seen the likes of, Adalat AI that is helping transform rural district courts, right? So, in that also, what are some of the use cases that comes to your mind which you think, could really, really make a lot of difference?
Well, India is a very large agricultural country, right? I mean, with the development of mobile and the access to mobile, that's out there today. AI is available now at fingertips. Now, if the data is made available to the AI, whether it's a farmer, it's person in a rural area, now gets access to AI, which is intelligence in their hands, which enables efficiency in everything that goes on, essentially. So I think in India, being a very large consumer market, basically AI is already seeping through the population in a very, very significant way. I mean, there's more model usage in India today than probably anywhere else in the world, essentially. That, over time, will seep into the small business sector, the enterprise sector, but that takes time, basically. That takes investment. And I think that's starting to happen now.
On that note, it's time for us to head into a short break. But coming up next, HumanCo gets $5 million in a pre-Series A funding round backed by leading consumer investors. We put the firm's co-founder, Niharika Joshi, on the hot seat to decode the company's future plans. Stay tuned. Welcome back. You're still with us on Startup Street. Q&Co has raised a fresh $5 million pre-Series A round backed by top consumer investors after reporting rapid revenue growth and early product market fit. The company is positioning itself as an R&D-led health-first cookware brand built specifically for Indian cooking conditions with patented materials and a strong repeat purchase focus. With new capital coming in, the next phase is about deeper product innovation, tighter supply chains, and premium category expansion. Let's get into how the growth story is shaping up. Joining me now to discuss this further is Niharika Joshi, the co-founder of Q&Co. Niharika, thank you so much for taking time out and being here with us on Startup Street. You know, you've raised this $5 million pre-Series A round, right? What has changed most in the business since your previous round in terms of revenue scale, repeat customers, and product market fit?
Awesome. First of all, thank you so much for having us. Extremely excited to come back on the platform. In such short notice, we were just there in August, and here we are chatting again in Feb. My apologies if my network's a little patchy. I'm actually at the airport right now. In terms of how our growth has been in the last couple of months, honestly, it's been pretty steep. We were kind of limited to only just being on a D2C platform. Since then, we've expanded and scaled very fast across channels like Amazon and growing very fast on QCom as well. To speak a little in terms of numbers, we are probably 10x of where we were kind of when we started the year, and we are probably at 6x from the time that we raised our last revenue. So very rapid consumer expansion, very rapid product expansion. We probably had scaled our product mix by, I think, almost 5x. We are sitting at a little shy of 120 SKUs now. So yeah, growth across the board, and extremely proud and happy at the way the company is shaping up.
So growth across the board. You know, you've said this is an R&D first kitchenware brand with patented materials, right? How is that innovation edge sort of translating into real consumer pull and pricing power versus traditional cookware brands?
Yeah, so I think the core of Cumin, honestly, is innovation from a POV of giving the best product to the customer. I think the subset of that turns out to be customer trust, but I think a lot of our R&D is focused towards building the highest and the best quality product. In fact, one of the things that has changed since we raised our last round was we've got 2 more patents since then. So now we have 3 patents across entire portfolio, and very soon we'll be adding a few more as well. I think the core ethos, like we mentioned, is innovation building products which are genuinely extremely healthy, something that understands the nuances of Indian consumer, the way Indian kitchens are, the kind of food that we cook, the kind of health requirements we have, and that's kind of been the core baseline philosophy of the way we built out our products as well. Thankfully, all of this has R&D to build a good quality product, but I think the customers and the consumer have responded really well and taken this as a sign of validation to say this is a brand that's doing different from what perhaps they've seen in the market, and that's definitely resulting in a lot of consumer trust. This we've seen across the board, right? We've launched products which are not just cookware. We've recently launched a bakeware collection with Pooja Dhingra. We've also launched our accessories collection, and that amount of trust that the customers have built in is kind of translating across the board. So I think that's kind of been one of the ways where R&D, more to do with getting a super solid product, is resulting into a lot of customer sort of love as well.
Absolutely. And you know, you just pointed out that you've entered 2 new categories as well over the last year, right? So how are the new categories doing for you? And are you looking to double down on this going forward, or any more new products that you're looking at?
Yeah, so honestly, Q&Co at the core is a health first, innovation first kitchenware brand. That's what our core ethos is. We started off with cookware, but we believe that to be successful in this category, we have to give customers what we want, and the extension of that is products across the board, which then resulted in bakeware and eventually into accessories as well. Both me and Udit, kind of come with a very firm belief that this is a category where the customers will tell you what they want. There are categories where you need to innovate and give it back to the customers, but in this category, the market will tell you, the customers will tell you, and a lot of our R&D on this, a lot of it is stuff that we do, but a lot of it is driven by what the customers ask, right? We across the board, we have people kind of coming back and saying, why don't you launch bakeware? Why don't you launch XYZ? And that's kind of resulted in what we've built out as well. So yes, lots more coming in. Stay tuned for the next couple of months. There's some amazing stuff coming up.
All right, Niharika, we're completely out of time and we're on a bit of a patchy network there. So hopefully we'll be able to catch up soon, but we wish you all the best on this journey going forward.
Awesome. Cheers. Thank you. Thanks so much.
And moving on, smartphone maker Nothing now has a physical presence in India, a 5,032 square feet store in Bengaluru that channels the aesthetic of 70s 70s factory assembly lines, complete with the conveyor belt style product reveal and interactive testing zones. CNBC TV 18's Meghna Sen reports that the store, its second in the world, is central to Nothing's expansion plans, not just in India, but globally, especially as it plans to dial the capital markets in the next couple of years.
We are at smartphone maker Nothing's first flagship store in India. This comes after Kalpe announced Bangalore as the city for Nothing's first experiential store in the country. Moreover, this flagship store is the UK-based firm's first outside of London, which is currently the only flagship store in the world. For a brand that began by calling tech boring, Nothing is now betting big on experience. And choosing Bangalore to house its second customer-facing outpost worldwide is not an accident.
Well, it just goes back to our users. When we looked at where our users are in India, and India is one of our biggest markets, most of them are here. So we thought, why not start here? It's the tech hub of India, and we can expand from here.
In India, Pay says the focus is not on chasing market share but on building strong products. The company is betting on the store to accelerate the growth. Pay also adds that Nothing aims to be IPO ready in the next couple of years, but he's in no urgent need of funds.
We've said that we want to be IPO ready in a couple of years. IPO ready just means that we have our house in order internally. It doesn't mean we have to IPO. Whether we IPO or not will depend on the market conditions, and if we have a need for capital at that time. If we do, then we will also, weigh private capital versus going public and see what's better for us at that time.
For Nothing, stores in New York and Japan are next on the expansion roadmap, but India is no longer just another growth market. It is set to be a key pillar of its global ambitions, and more stores in Indian cities are also in the cards. In Bangalore, Meghna Sen.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, copper is trading at a 6-week lows with sentiment cautious as most Asian markets remain shut for the Lunar New Year. Prices are down nearly 15% from January's record highs of $6.5 per pound. Well, combined inventories across COMEX, LME and the Shanghai Future Exchange have surged to a 21-year highs at over 1 million tons. In precious metal markets, in the meanwhile, gold has extended losses, slipping below that $5,000 an ounce mark. Silver is also under pressure. This is amid thin liquidity with several Asian markets closed. However, it's the crude oil price is holding steady as the US and Iran hold second round of talks. Geopolitical tensions remain elevated after Iran conducted maritime drills in the Strait of Hormuz, while the US is deploying a second aircraft carrier to the region. Joining us now on the show is Ol Hansen. He's head of commodity strategy at Saxo Bank. Ol, hi, thank you so much for joining in. I want to start with metals first. And while the Chinese markets are shut, it's a truncated week for US as well. But with contradicting fundamentals coming in for copper, where on one side, the structural long-term demand from many consumers is still on. But on the other side, the kind of inventories, smelting, which the satellite records show is at a decade low as well. How are you reading all of these signs?
Well, good afternoon. Basically, that we once again have this mismatch between short-term developments and the longer-term picture. The short-term, as you mentioned, we're seeing inventory levels rising across the world, hitting a million ton on the exchange-monitored side, and there's probably more as well off exchange. So that's basically leaving us with an amply supplied market in the short term, weighing on price and thereby also pressurizing traders and investors who have been buying into the long-term prospect. And it just once again highlights the commodities are not equities where you can buy today in expectations of future growth. You have to wait for the supply and demand situation to provide the underlying support. And right now we're not seeing that. That's why we're seeing some long liquidation. I'm not selling into this market. I'm purely just seeing long positions getting out and just getting to the sideline, waiting for the rebound, and which I believe will materialize over the coming months, especially next month. It's interesting to note how China behave when they come back from their holiday.
Ol, what's your sense then on the copper prices for a longer term? As you said, you're not selling and the long-term story does still look lucrative. Are we looking at those all-time highs coming back in yet again? How would you look at the prices in this year, the range that is?
I think we've probably seen the highs for this year already now, simply because that surge we saw in January was similar to what we saw in silver, completely unsustainable and unfounded. And that basically means that is now a bit of a ceiling for now. But even coming back towards those levels would generate quite a strong return on an annual basis. So I think for now the structural long-term outlook remains supportive. And that basically means we've probably seen the highs this year, but further highs could be expected in the coming years, simply to entice miners to work flat out to produce the copper that is required for the electrification and the energy transition.
Ol, how would you also look at silver prices? And I mean, as you mentioned, it's been a roller coaster ride onto this one. Most people believe that it is China who really played it both ways. How are you looking at the fundamentals herein? Because it's not just fundamentals. There's a lot of money, speculative movement, investment buying, all of that supporting whatever the prices did.
Yeah, silver has been suffering from the fact that there's been a lot of social media groups just calling for silver squeeze, the end of paper silver as we know it, and prices going to the moon and so on. I hate these kind of comments because it just distorts a market and you forget to look at fundamentals. Yes, there's no doubt that the physical side is tight right now, both in China and also in the US, if you look at the exchange monitored inventories. But what we tend to forget is if there is an action, there's also a reaction. And the reaction is the slowing demand from industrial users simply because prices becomes too high, above $100. We have increased supply of scrap. Just a small anecdotal story here from Denmark, Manisha. We're a small country, 6 million people, but 4 tons has been handed in to scrap dealers in the last 3 months alone. That's just in Denmark. And if you look at the global supply deficit this year, estimated to be around 2,000 tons, there will be supply coming into the market from scrap in the coming months. And I think that will help balance the market, and that basically will remove some of this focus on these so-called experts looking for prices to go sky high.
Ol, what's your sense? How are you looking at gold and silver, both of those prices performing for the rest of this year as a range?
I prefer gold, as you can probably hear from my comments here, because gold is a monetary asset. It basically, whether the price is 5,000 or 10,000 doesn't matter. It is really a question of how much you're prepared to pay for a metal that you store for safekeeping. While silver has not got the same luxury, because there will be an impact on the industrial side. So I think the gold market is consolidating right now. I think the consolidation, we need to be patient here, because it could take probably longer than we anticipate. But as we move deeper into the years, somewhere between 5,500 and 6,000 an ounce, I think is still achievable. And with the gold silver ratio return to the long-term average around 70, that would take silver up closer to 100, but not above.
Ol, how are you also looking at the energy as a market, with a couple of those important, interesting conversations between US, Iran, US also leading Ukraine and Russia conversation is what the street is looking at. Are you also looking at that, or are you looking at demand supply numbers?
I'm looking at the US midterm election. I'm really looking at a president which is under pressure. I'm looking at a US consumer who doesn't really care what's happening on the other side of the world, especially in Iran. They're more concerned about the price at the pump. So call me a cynic, but I think what we're seeing right now is grandstanding from both sides. There's a lot of military assets in the Middle East right now, but I just don't see any escalation that leads to a disruption in supplies, and with that, surging energy prices. So if that turns out to be the case, then 70 will be the ceiling in oil prices for the foreseeable future. But of course, we need to see how things plan out. I might be completely wrong, but I'm just a little bit cynic here, looking at the US domestic situation as a reason why we're not going to see any escalation. So with that in mind, we're still stuck here in the 60s. OPEC are discussing perhaps increasing production again from April. That will add some additional supply. So with that in mind, again, just like the other metal or the other commodities, as we have a long-term bullish outlook. We think we are in a structural bull market. But at the same time, we need to wait for the supply and demand balances to underpin those movements. And I think that potentially could take us at least into the second half, or maybe early next year, before we start to see that play its part. And from that point on, we could see oil prices move higher as well.
Fair point. That's so plenty to watch out for the international markets there. But as always, Ol, thank you so much for joining in and making it a very crisp conversation on all of those commodities and your expectations therein. Well, let's delve deeper into the gold now, because India's growing appetite for gold exchange-traded funds has pushed the trade deficit to a record high of just under $1 billion in month of January. The value of gold imports almost tripled to $12 billion from 4.1 the previous month. Inflows into gold ETFs nearly doubled to over 24,000 crore rupees in January. And if you're looking at overall imports that we saw in case of silver as well, have been on the very, very positive side as well. Talking further about Indian imports and the kind of ETF numbers that we are looking at, is joining us is Sachin Jain, Managing Director at World Gold Council. Sachin, thank you so much for joining in. First of all, your sense on the import numbers, because that is today's number and almost everybody seems to be reacting to this. Financialization is one part of it, but do you think India is smart enough to own gold, not just in the physical sense, but in sense of ETFs as well?
First and foremost, a big thanks, Manisha, for getting me on the platform. We're truly honored to be on the platform as always. You mentioned, the true story of today is what's the impact on CAD. And I'd like to give some hardcore facts. The average that we've seen Jan to January over the last 4 years has been in the tune of about 40 to 45 billion dollars and about 668 tons. What we saw this year, the volume that has been imported is about 621 tons. Now, that's materially low in terms of volume, and that's very, very, very important to be understood in the overall scheme of things. But because of what's happened to the gold value, this is about 12 to 13% higher. So I think there is, I mean, of course, it's picked up the headlines today, but I would not anticipate a big panic around it. It equals out. And the important element is, as you yourself mentioned, that the large inflows happen in organized trade in ETF. We've also seen a big surge in the gold monetization via the gold loans. So a large part of the gold that got used in 2025, 26 in particular, has also helped financializations within the system of organized play. So I think that's a good big plus.
I remember, Sachin, all of last year, you've been pushing for ETFs on how that is very, very important to understand the overall numbers. I know World Gold Council did so many campaigns as well. Do you see it actually showing into the kind of numbers we're looking at right now?
Oh, absolutely. I mean, last year, let me share some numbers with you. And what we saw, 1st January 2024, the AUM was around 40 tons. 1st January 2025, gold-backed ETFs, the AUM was about 56, 57 tons. The AUM on the 1st January of 2026, we were about 97 tons plus, touching 100, which did touch on the 5th of January 2026. So big inflows there. But if you look at 40 tons or let's say 37, 38 tons of inflows that we saw this year, 2025, that might not be so huge, but big sum from the base of the gold-backed ETFs. Now, I think as we go forward, ETFs are really at the cusp of even further growth. And while, Manisha, you're right, on your platforms, I did talk about the strength of ETF, it being a regulated product, transparent, backed by physical gold. And interestingly, what we've seen and analyzed that even in the current times where we saw prices going up and down, we saw that the institutional investors have been very sticky. Most of the investors have been on long-term play, and the retail investor in general is started to know what a gold-backed ETF is all about. So I think times for gold-backed ETFs as they get more popular, as also the Provident Fund regulator has now allowed investment in gold. I also believe that the insurance fund regulator will consider it. I think with all of these institutions being opening up, I think ETFs will get more and more stronger in the investment formats in India.
Sachin, for the longest time, we've been discussing on when and how will gold become as a mainstream in sense of an asset class. And it finally has done that the way we've seen it perform in last 12 months. How would you look at India's growth story? Because we've been buying physical for a very long time. And now the financialization, every country has its own economics and dynamics. Would you say India has found the way it has bought into gold in all forms and all senses in last 2 or 3 quarters?
Well, actually, historically, Manisha, our analysis says that every time there's a 1% increase in disposable wealth in the hands of Indians, we see a 0.9% increase in the demand of gold. Now, what we've seen particularly in the last year, that what was under stress was jewelry demand in terms of volume, but value-wise, of course, it surpassed over 15%. But what we saw is a phenomenal growth in the investment area of gold, both in physical bar and coins, but also in ETFs and digital formats. Even digital gold has done very well. Now, the fundamentals of India depend on the GDP size and how much is the disposable wealth in the hands of every Indian. And that is changing for better. We're not a matured economy like various other markets where things are only shifting. But if you look at the consumption pyramid of India and Indians, there is new wealth that's coming in. And people who aspire to own gold in any format, be it jewelry, be it bars and coins or investment area, that pyramid is having more and more wealth. And I foresee that in the coming time, where we're talking about the per capita income moving from $2,800 to over $10,000 in the coming time, it's going to have a very significant increased consumption of gold. Now, with India getting more and more digital, our median age become 29 and digital savvy, I think consumers will be very comfortable in owning assets on their mobile phones. And hence, products like ETF, which are easy, sort of regulated, you can bank on them, will be here to grow.
Oh, well, absolutely. From sovereign gold bond when it was available to gold ETFs, digital gold, give them gold in some sense and India is ready to buy it. And why not? And the kind of profits that we've seen come in for that as well. Sachin, thank you so much for joining in and making sense of what it really means for India in sense of economics and the kind of growth, of course, that we're looking at in the mainstream asset class as the gold has performed itself to be. On that note, it's time for a break, but don't go anywhere because on the other side, we will be talking about food finally. Total's company's founder Arjun Veer Singh will talk about launch of their latest healthy snack and a lot more. Welcome back to Commodity Champions. And New Delhi-based healthy snacking brand Tariffs has launched a new product called Super Puffs, which it markets as India's first protein chips fortified with essential vitamins and minerals. The brand focuses on clean label positioning and transparent ingredient sourcing, and producing baked low-calorie snacks aimed at health-conscious consumers. Arjun Veer Singh is co-founder of Tariffs and is joining us on the show now. Arjun, hi, thank you so much for joining in. I mean, this really is the brand or the category that really seems to be exciting everyone. What is India's overall market when it comes to diet-conscious, healthy snacking?
So, hi, Manisha. First of all, thank you so much for having me here. It's a pleasure. So, talking about the healthy snacking market in India. So, if I talk about the snacking market in general, that is somewhere around 50 to 55,000 CR, of which the healthy snacking bit is about 20-25%, which turns out to be around 12,000 CR. We are seeing double-digit growth in the healthy snacking segment. The overall snacking market is growing at a CAGR of about 8 to 9%. But the good thing is the healthy snacking part is growing at a CAGR of about 18-19%, which is very promising. Our habits have been changing over the past decade. If you talk about protein consciousness amongst consumers, about a decade ago, it was only restricted to gym folks. Then came COVID 2019, 2020, wherein a lot of people started consuming protein as part of their everyday diet. It started to become mainstream. A lot of D2C brands launched bars, and people started to actually accept protein as the go-to thing. And now, since the past couple of years, protein is now becoming the main thing that people are looking forward in their snacks. Gen Z is actually very conscious about their habits. They want snacks that are actually healthy, that are not just tasty, but add value to them. And that is where we are trying to plug in the gap. There was a gap in the market for a very long time wherein healthy snacks were usually perceived to be not tasty. We at Tariffs are trying to bridge that gap by bringing in snacks that are both tasty and healthy at the same time.
Okay.
And that is what made us launch Super Puffs. So all of that came from the realization that there's a lot of talk going on around protein, but what about other micronutrient deficiencies?
Arjun, I get the point, and we're looking at those products as well that you do, and beetroot to oats and all that healthy stuff is what you're working with right now. What are the kind of investments that you have seen, and what products do you have in your portfolio? Super Puff, of course, is the latest addition, but with that, what kind of SKUs and what is the plan ahead, really?
Yes. So first of all, we have an assortment of more than 25 SKUs. We started with Fox Nuts because that was the buzzword. People are realizing the importance of makhana. There's already a makhana board set up. We have chips made of multigrains like oats, beetroot, quinoa, and all of them are clean label snack products. But we wanted to be different from what is there already in the market. There are a lot of protein chips there. We thought, why not target common Indian deficiencies? Vitamin D, vitamin B12, all of these are very common deficiencies across Indian diets. We thought, why not try to solve that gap through a snack and without making any compromise on taste. So we tried bridging in that gap through our product, wherein people should get the required nutritional benefit without compromising on taste. So Super Puffs is our latest offering, and we are already seeing a lot of good traction. We are now tied up with a lot of vending machine partners. We've launched on quick commerce.
Okay.
There's good trend. People are accepting the product, liking it. The labels are clean, and that is how we are seeing a lot of growth in the new launch.
Arjun, I do know that there's a lot of label reading happening with the youngsters now, not just the youngsters, but major public at large who really wants to eat healthy therein. What are the price points like, and what kind of competition are you looking at, especially in the Indian markets? And not just that, there's a lot of international food available too.
So right in the morning, I was having a discussion with an international partner from Poland, and he was telling me about the trends in the healthy snacking space there. So we are partnering up with them for an international collaboration, and the trends are as promising abroad as in India. We are seeing a lot of new age brands coming in this space, and I'm also seeing good trends from incumbents. The legacy players are also delving into this space by launching products, and I think all of this is actually for the benefit of the market in general. So with the efforts that the entire ecosystem is putting in, I think there's a good future for the country in terms of snacking. We're definitely moving in the right direction.
What are the kind of investments that you're looking at, Arjun, going forward from here? And as you said, from e-commerce to brick and mortar, you're pushing it. The distribution is working from all sides, would you say?
Yes, exactly. So unlike most new age brands, we've already built an offline distribution. We have a good network of retailers and distributors across India now. We've partnered with corporate clients. We are serving institutions. We've already launched on quick commerce. So we already have that ecosystem built, and now it's all about scale. Talking about investments, we are already in discussion with a lot of early stage investors for our new launch. And I think I cannot disclose figures for now, but things are in the final stages of discussion. And we should hopefully announce a fundraise very soon.
Arjun, how are you looking at various products within that? As you mentioned, there's right from macanas to dry fruits to dried fruits to nuts and seeds, and there's just so much competition within the space as well.
Agreed. I won't deny that there isn't competition in this space, and that is where it is important for a new brand to distinguish itself from competitors. There are a lot of brands playing in that space. So when we launched Fox Nuts, the roasted flavored Fox Nuts, there weren't a lot of players. We have always been trying to disrupt the space that we enter in. We launched beetroot oats chips by targeting the bottom of the pyramid. We launched the SKU in the sub 20-30 rupee price point. And I think based on that, a lot of legacy brands also launched in that segment. And now with Superburst, we've entered an altogether different segment where no other player is actually there for now. We want to target these common deficiencies, and I think after us, a lot of players will actually start moving in this space. This is our disruption. This is our disruptor for now. This is our main focus for the next couple of months for sure. So we've always tried to be ahead of the curve by the product launches that we've been doing. We have already had a lot of focus on R&D. A lot of research has gone behind making this product because we wanted to have that perfect balance of nutrition, taste, and crunch, which has been historically difficult to achieve because once you increase protein, the brittleness increases. There are bloating issues. So we had to make that perfect combination. The current product that you see on screen, it has gone through a lot of research, a lot of months of R&D, and that is how this has been launched. And the initial responses have been very
Oh, well, absolutely. If you're getting your health and flavor and good price point, all of that in line, then it clearly does ask for a strong product there. Arjun, thank you so much for joining in and taking us through on what really the Indian market is and what market share are you eyeing in that one. And with that, it's a wrap on this edition of Commodity Champions.